more expensive than they were 2 decades ago. Welcome back. You're tuned into Bazaar Morning Call. As promised, Prakash Diwan joins us to help us out with some fundamental analysis. Hi, Prakash. Morning and good to see you, Ben. We'll get to Reliance Industries in just a bit, but I wanted to understand, what do you make of the banking numbers? HDFC Bank as well as Kotak Mahindra Bank. For Kotak, we have a couple of downgrades as well. Your take on both those names?
Good morning, Nigel. So, absolutely. I think Kotak has come up with numbers which clearly tell you there is bottoming out on most parameters. None of the things that you would want a bank to kind of start showing improvement on have seen that, which means that there's and I mentioned this on the call with Abhishek on Saturday, that this is a bank that has consciously got out of lending growth, has been struggling with some sort of deposit growth, and the metrics now tell you that this consolidation that they've had internally with the new management coming in, all the processes being reinvented, revisited, this probably seems like a consolidation and a bottoming out phase. Hopefully, they'll get some new energy to build into this thing. And they've spoken about branch expansion, the need to kind of raise deposits much faster. So I think the bank will have to do much more, because in the absence of some of the key portfolio growth areas like personal loans and all, and of course, the RBI rap on the knuckles on some of the areas, there will be some time before this takes off. So it's going to be sideways. I don't think the market is going to like these numbers or the commentary, with any immediate effect. HDFC Bank, on the other hand, does show some sign of getting its act together on some of the parameters, the CD ratios that everybody's got worried. So I think that's where the growth will happen. In spite of all of the constraints, they've done some sort of credit growth, which is nice. But going forward, and remember, this is a quarter which usually is quite challenging for HDFC Bank and most banks. So I think going forward, post-monsoon, the season could, the cyclical nature of the business could probably help them. But I'm not very worried about the HDFC Bank numbers, though people have been talking about flat growth and all of that. But Nigel, I think it's a Kotak Bank numbers which will probably take center stage with a disappointing set coming through. But then, of course, the market's not in the mood to reward anything which is less than expected. So you'll see negativity on both, more on Kotak, less on issue.
Okay. I want to ask you about Reliance as well, but we do have a couple of more guests joining us, so we'll do all of that together. In the meantime, Prakash, your thoughts on Indian hotels, because it was seasonally a weak quarter, right? Where there was this heat wave, the wedding dates were on the lower side, etc. So that hit the numbers. But largely, Indian hotels has been a big wealth creator. Do you think that the prudent thing to do would be to buy the dip, or are you cautious here?
Good morning, Sonia. No, absolutely. I think hotels is an area which most investors I see the portfolios are underinvested. And if you had to kind of start looking at getting some exposure, there's no better name than this. And as a matter of disclosure, I do have this in my long-term portfolio. Indian hotels will, actually lead the performance, and it will outperform the market growth rates as we go along, given the kind of properties that they sit on, the kind of growth plans that they have. And, so while we speak about ITC trying to kind of do its bit and all of that, Indian Hotels already has a right to win in most locations. And once the traffic comes back, once, the seasonality is out, you'll probably see the numbers catch up. And what's improved in this quarter as well, like certain other quarters, is the efficiency ratio. So I think the utilization levels, the kind of cost management that they've been trying to bring in, all of that does reflect in these numbers on there. So yes, you're right. If the market gives you that opportunity, please check into Indian hotels for the long term.
Prakash, hi, morning. Broader markets really hammered, right, on Friday. This morning as well, GIFT Nifty is indicating a lower start, at least on the Nifty. Just a quick word on, the big driver. There was also those comments from SEBI chief. So it's a mix of things. It's always a mix of things coming together. I think it's very clear now, some regulations and F&O are coming. It could come, I think, right after the budget, perhaps something as early as this week. But what's your sense on, just a quick word on the market, but also on these market intermediary stocks? You've got exchange listed and you've got a bunch of brokers, etc.
No, absolutely, Prashant. There's lots that's happened over the weekend. But, the market today might give you a little bit of a weak start thanks to some of the heavyweights, the Nifty constituents, not in great shape in terms of the results and all. So, for example, out of your top 10 stocks, 5 are in the red. And most of them happen to be the large ones. So that's one thing. But what happened on Friday, if you ask me, was actually a very clear lightening of positions before you go into budget. And secondly, there's a lot of profit booking in sectors which seem to be a bit overheated, and there's rotation in other sectors. So while all this happened, the advanced decline ratio was fairly decent. It wasn't really out of whack, where it was only declines and no advances. So it was almost equal, which tells you that there are certain stocks where the buildup is still happening, but the sectors could probably be still not being discussed as much. On all these regulatory things, I think it's very valid. It's required. There's a lot of speculative element that's come into the market rather than focus on core investing ideology. But remember, FNO and small cap really don't have much of a correlation. I mean, you could see volumes go down in FNO, but that's got nothing to do with this thing. So I think it's more of profit booking sector rotation at work, and we'll probably see continuation of that today as well. So till the budget throws up new opportunities, probably people are wanting to sit on cash and be ready.
Okay, now let's talk about Reliance, right? So we have two gentlemen joining us to decode the numbers and how you should approach the stock. So Prakash, stay on. We also have Prabal Sen, the energy analyst at ICICI Securities, and Balaji Subramaniam, the vice president at IIFL Securities. Gentlemen, morning to all of you. Prabal, let me start with you because, the oil to chemicals business was on the weaker side. As expected, the macros have been weak. Given all of that, what was your reaction to the earnings and what do you see as the impact overall on the stock?
I think as far as OTC is concerned, what was very evident was that even the outlook that was presented by the management seemed a bit more cautious than it has been in the last couple of quarters. So more than the weakness in the numbers this quarter, my clear sense is that FY25 numbers will probably look a bit weaker than what I think earlier expectations were. So that is clearly the first takeaway from the way that the results came through. The second thing is that if you look at the upstream segment as well, with the segment hitting its peak production of close to 30 MMSCMD now, and the investment multiple, I presume, has gone over the threshold level at which the share of government in the profit petroleum starts to rise disproportionately. Now, this can reverse if they bring newer assets into play or newer asset development plays into play where higher capex is once again allowed. But once again, FY25 at least, the upstream share will also start to decline compared to FY24 because the government share will go up for this period. Thirdly, as far as retail is concerned, again, there was a slightly disappointing number, at least with respect to our and street estimates. So one will have to see how the momentum picks up. Jio remains the one bright spot with the tariff increases that have already been done. So on an overall basis, I think 25 consolidated earnings definitely look a tad weaker, and we have downgraded numbers by about 5 to 6% for 25 in our results note. And I think that is something that fairly sort of represents what has gone on and what we look at the macro going forward for the next 12 months.
Okay, so you're saying that FY25 will look weaker because of the management's guidance and you've gone ahead and downgraded your estimates. Balaji Subramaniam is still with us, as well. Balaji, your thoughts on the numbers? There is this EBITDA, there's expectation of an EBITDA up move because of the tariff hikes that, Prabal was also talking about. And going ahead in Q2, there's expectation of stronger refining margins compared to Q1. But overall, what's your view on, the earnings and in terms of Jio particularly, what kind of growth are we looking at?
Good morning. Thanks for having me on the show. As far as Jio numbers were concerned, they were largely in line. But one can see that, two takeaways for me would be one is that ARPU has been flat for the last 3 quarters or so. And that is because, whatever higher usage is happening in terms of 5G, that is not showing up in the numbers because of 5G having unlimited data usage plans. And I think, unlike, say, Bharti, which has a which has the factor of 2G conversion to 4G still going on. In Jio's case, since all customers are on 4G, the ARPU has kind of flatlined. That said, I think in that sense, in against this backdrop, the tariff hike will come as a much needed ARPU and revenue booster. And we should see some bit of the revenue uptick from the tariff hikes to come in 2Q itself, and in 3Q we will have almost the full impact of the tariff hikes coming in, and that is when one can expect the ARPU to cross the 200 level. And the other thing in terms of these results were that the S&D expenses also seem to have climbed a fair bit. That is probably because of the higher competitive intensity that is happening in the marketplace, especially as far as subscriber acquisition and MNP is concerned. Now that we have Vodafone, who is strongly defending its turf, we may see that also persisting in the near term. But that said, I think the fairly healthy tariff increase should mean that the revenue boost from that should mostly offset any increase in the S&D costs.
So I heard you mention briefly a 200 rupee ARPU. I mean, for the last, I think, 10 quarters, the ARPUs have been between 175 and in this quarter, okay, we've gone to almost about 182, right? So for the rest of the fiscal, what are you looking at for the average revenue per user? And how much of it do you think is priced in? I mean, I didn't get your view on the stock per se.
See, I think almost all telecom stocks, including Reliance for that matter, prices in a significant, ARPU improvement. So my own ARPU estimate is around 201 for fiscal 25, but that also means that the 3Q and 4Q ARPU will be higher than 200 because we are also including the first quarter where the ARPU was just 182. So I would expect the ARPU to comfortably clear the 200 rupee mark by the second half of this fiscal, because if you see, even if we assume that out of the 20% odd tariff hikes that they have done, even if 15% is what gets retained, then we are looking at an ARPU of somewhere in the 207, 208 mark by 4Q of this year.
Okay, so by 4Q of this year, you're saying 207, 208 is what the average revenue per user could look like. Got it. Thanks a lot for that, Prabal and Balaji. Thanks for joining in. Prakash Diwan is also with us. Prakash, of course, we discussed Reliance at length on Friday when the numbers came, but very quickly, on the stock itself, do you expect weakness? And if yes, would you use that as an opportunity to buy?
So, Sonia, as I mentioned, most of these numbers might seem disappointing, but then there was a lot of expectation that there would be softness, and they're exactly in line with that. In fact, the Jio numbers will probably start improving very dramatically, as Balaji was sharing. My sense is, if there's a dip, and there could be, most likely, you buy into Reliance with a view on the other optionality, which is Jio, retail growing, demerging, and of course the new energy business, hydrogen business. So the green hydrogen business we've not spoken about, but that's building up very rapidly, and at some point you'll have to factor that in. So I would definitely recommend this from a long-term perspective.
Okay, let's take a quick break on that note. Thanks, Prakash, for that. On the other side, we have a market to trade as well. So Mitesh Thakkar and Sudarshan Sukhani will join in to give us some technical trades. Stay tuned. Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, we've got the market pre-open kicking off in about 4 minutes or so. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do as we kick off another session. Gentlemen, good morning. Good to have both of you here. Mitesh, just a quick word on the index first. The GIFT Nifty is indicating a cut once again. Friday, of course, was a hammering for the broader markets. Nifty is not broken its 20-day, but the other indices all have, Mitesh. So what would you recommend?
Prashant, on Friday also I was suggesting people to exit because, of two reasons. One, the hourly and the 2-hourly charts were extremely overbought and the indicators had started turning south, suggesting some profit booking kind of a movement could happen. Now, on the Nifty, I think the first level which I'm watching is close to about 24,300 to 80 zones. I think that's very important support seeking. So we're still, after the gap down, could still have some more decline. And if that breaks at 24,100, so I think the market does look like, it will go into some kind of a pullback. Whether this turns into a big decline will be, I think, event specific. I think we'll wait for the budget to figure that out. But in the short term, it does look heavy and does look like, possibly some more profit booking will happen.
Okay, some more profit booking will happen. Got it. Sudarshan Sukhani is also with us. Sudarshan, if there is more profit booking, at what point do you think the Nifty deserves a buy?
Yeah, good morning. Well, Sonia, see, what happens is that tomorrow is a big news event day. Yes. So there is no sense in trying to anticipate the market action and look at a level today to buy. I would have said we should buy on any 100-point dip today. But because of the news event, it's not worth it. We should wait patiently for the budget to be announced and for the market reaction to set in. If the market is willing to go higher, that's the point tomorrow when we should buy. Even if we have to buy 100 points higher, that would be better.
Okay, let's do one thing. Let's take a short commercial break. On the other side of the break, we'll continue our discussion with the guests and we'll get you some, some stock-specific cues as well. Apart from that, Sanjay Lodha of NetWeb Technologies will be with us to put focus on their Q1 earnings. Stay tuned.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We're heading into a brand new day, a day that could be, filled with a lot of red on the screen. So let's get our guests on board, Mitesh Thakkar and Sudarshan Sukhani, to tell us how to approach it. Sudarshan, in terms of individual stocks, what do you do now, especially with names like Reliance, HDFC Bank that could come in perhaps for profit taking? And what does your list look like today?
Well, if you're a positional trader trading for a few weeks and forget about investing, then you want to buy Reliance and HDFC Bank both. I would think they will be much higher than current prices, whatever they get today after 3 months. My own list is mixed, buying and selling both. Bajaj Finserv is a buy with a stop under 1590. Page Industries is a buy with a stop under 39,500. I have two intraday shorts, Exide, stop above 570, and Laurus Labs, stop above 460. So it's a mixed list.
Okay, got that. Thanks for that, Sudarshan. Mitesh, what about you?
I have more of sell calls today. Bharat Forge is a sell with a stop at 1610 for targets of 1505. Sell on NMDC, which I would recommend selling with a stop at 234 for a target of 215. And a conditional sell on Godrej Properties. If it breaks 32.13, it might do that in the opening trade itself. Then sell with a stop at 32.80 and look for a target of 31.10. And one buy call, that's HUL on a mild dip around 27.15.20, buy with a stop at 2685 for targets of 27.80.
Okay, all right. We'll come back to you for more trades in a bit from now. The rupee is open. Rupee, by the way, I was pointing out earlier, on Friday hit a new all-time low as compared to the dollar. I mean, it was a sharp correction. The Nifty is now settling about 100 points down. And I think you've got this the Sensex, which is coming up with some cuts as well, but nothing very large. So finding its feet will kind of pick up from there. But we have a company at hand. NetWeb Technologies is the company we're speaking with. They reported a strong set for the first quarter. Revenues and profit after tax was up 150 and 200% respectively. You know, we've heard about NetWeb Technologies. We've had sort of portfolio managers coming on and talking about how NetWeb is a strong play on the data center build out that India will see. We have Sanjay Lodha, Chairman and Managing Director at the company, joining us now to take some questions. Sanjay, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. I mean, so, you know, we'll come to that opportunity on data centers, etc. in just a bit, but just numbers, 40% growth. You've been growing at 40% CAGR for the last 2-3 years. Can you continue with this kind of growth in FY25 as well?
Yeah, actually, basically, we have been guiding actually 35 to 40% of growth, actually, approximately. Last year also we did it. And every quarter, whatever we indicated, whatever we guided, we were able to overachieve that. And basically that kind of momentum I could see actually in the market. And this is the kind of growth we are not seeing basically in 1 quarter or 2 quarters. We have been witnessing it for last approximately three plus years. And we hope that this journey is going to go on, because, you know, basically the tailwinds are really excellent. You see, basically, I have never seen the data center market, the data center demand in the country growing as fast as it is growing at this point of time. Basically, there is a dearth of data center space. There used to be time 2-3 years back when basically data centers were really struggling to get with their space filled up. But today, basically, new data centers are coming up. and data center definitely is booming. So definitely the private cloud market is blooming. What has happened is that previously the data center was primarily based on more bare metal and all that. But now data center has evolved, and data center requires basically private cloud kind of a thing. And plus the kind of GPU compute, which is really pacing up very, very well. I think all those factors are really boosting the data center growth. And I feel this is happening.
Right. Sorry to interrupt. How much of your end use market is data centers? Is all of it data centers? And so in a way, you're tied at the hip to the growth on that market. I think data center capacity now is about 1,000 megawatt in India. I was looking at projections. It's expected to go up to about 1,700 megawatts by the end of next year, by some estimates. So just your thoughts. I mean, end use for you, how much is data centers?
So basically what happens is that if you see my business is primarily split into three major segments. First is the supercomputing, actually, that is the HPC, high performance computing. That primarily moreover goes into the government segment. That is around 50% of my business, and 50% of my business is from enterprise. So basically the three segments which we work in is, one is supercomputing, second is private cloud, third is AI, and basically AI and AI workstations. So basically, if you really see the HPC part of it is somewhere around 35% of my business. Around 35% of my business comes from the private cloud. So this private cloud piece clearly goes into the data center, because basically the enterprise customers and the large customers, basically primarily most of this goes into the data center.
Okay, all right. Hi, Mr. Lotha. Good morning and good to see you in. A couple of questions. For this year as well, you're telling us that you've grown at 35-40%. We've got that. So for this year as well, will you grow at 40% or will it more than that? And since you mentioned AI systems, I think it's risen from around 7% of your total mix, closer to around 15% of your mix. Where does this number head to?
Yeah, so basically, I will still be guiding you around 30 to 35% growth only, as we have been doing it earlier, because basically this industry is basically we can predict. And if you see my order book, that was around 400 crores in March. And again, my order book is again for around basically similar number again now, even though basically after registering of around 143% kind of a growth approximately. So basically that gives me a very, very confident feeling that I'll be definitely achieving the 30 to 35% growth, which we have indicated very clearly. As regards AI systems is concerned, you know, we are one of the OEMs which is basically signed up directly with NVIDIA, wherein we are manufacturing systems based on their latest architectures and all. So definitely we are seeing a lot of traction around it. And you can see it in my numbers also, that it was basically last year, it was around 7% during this period. It has risen to around 15%. So that is definitely AI systems is again boosting the growth further. And we are very sure that this will keep on boosting further in the future.
Sure. Do you have any acquisitions that you're looking at? Because you have mentioned in the past that you're looking at some strategic acquisitions, but I think you're not closed in on a timeline. Any update that you can give us?
Yeah, so basically the acquisitions, we don't want a general acquisition. We want basically, rather than, we have a very strong R&D team, which was around 54 people while we went for an IPO. It is now around 70-75 people now. So basically, we are looking for some kind of strategic acquisitions in the domain we work. We are still talking to some people. There are some discussions which are happening, but I think you will have to wait for more quarters so as to have a firm news on that.
So just a very basic question, and apologies for that, but in all these segments, this is all equipment, right, that you are supplying? For all these end markets, hardware.
Yeah, so I will tell you, basically, basically our mix is very different. That makes us basically very different, and wherein you find it very difficult to find peers for us. We design our hardware, we manufacture our hardware. This quarter, basically, we inaugurated our state-of-art facility, the new server manufacturing facility, which is one of its kind in the country today. And it was inaugurated by none other than IT Secretary himself. So basically, that was done on 10th of May. So we design our complete systems, our motherboards and everything. We do our manufacturing, and we have our own software stack. We don't sell boxes at all. So basically, the focus is really not selling boxes at all. Our focus from the very beginning has been to sell complete solutions. And I think that creates a differentiator for us. So basically, it's not only the hardware, it's the hardware plus the software. So we sell it in an appliance mode, like basically for supercomputing also, same way for private cloud and HCI, and same way for AI systems. So we have our own software stack, which we bundle along with our equipment and sell it. We don't sell our software separately, and we don't sell our hardware separately.
So this In terms of, so this is a one-time sale, or is there a annuity kind of business as well for maintenance, etc.?
So basically,
that
again,
revenue which trails. Yeah.
Again, there's a very unique factor in this. This is basically one-time sale to the customer. But most of our customers are enterprise customers and high-end government customers, and the technology life cycle changes within 18 months approximately. So basically, within 3 to 5 years, the customer comes back to us for a refresh. So rather than targeting annuity revenue, we target the revenue, the repeat revenue from them. If you see my strategic presentation and all those things very clearly, the repeat business from the customers is pretty high.
All right, we'll leave it there. Thank you very much. Appreciate you joining in, Sanjay. Great speaking, and thanks for joining us. So that's the management of Netweb Technologies. There's 5 minutes to go for the market opening. The pre-open is I think left us with some cuts, and it's on your screen now. 85 points lower on that one. But some 9-10 calls with the pre-open rates also visible now. Mitesh and Sudarshan are back with us. Sudarshan, what do you have?
Buy Bajaj Finserv with a stop under 1590.
Okay, and Mitesh, what about you?
I'll choose a sell on NMDC for targets of 215.
Okay, sell on NMDC. By the way, the pre-opening rates have settled lower, so just brace yourself for that. The stock of the moment on the downside is Wipro. Remember, the numbers were quite weak, and you've had the guidance. The guidance has been muted for Wipro as well. So it's a multi-quarter low in terms of, there is I think the 6th straight quarter of a revenue contraction that Wipro has seen. So the street definitely doesn't like that. Reliance is the other one that's down about 1% post its numbers. Most large caps actually. HUL comes out with numbers this week. So ahead of that, it's down about 1%. On the upside, HDFC Bank is holding up a tad bit. But Abhishek is here to tell us about Canfin Homes and Kotak Mahindra Bank. Abhishek, over to you.
Well, both of them disappointed. So Canfin Homes disbursements have declined by 15% quarter-on-quarter. The AUM growth is at just 9.5% on a YY basis, which is the lowest growth that you are seeing in last 12 quarters. Net interest margin is at 4-quarter low as well, coming in at 3.57% versus 3.96% in the previous quarter. So sharp contraction over there. Asset quality has deteriorated. Gross NPA in absolute value has increased 13.6% on a sequential basis. Net NPA is up 18% on a sequential basis. Coming on to Kotak Mahindra Bank, net interest margin has come in at 8-quarter low, despite the fact that credit deposit ratio has improved. So NIM is at 5.02%, a decline of about 26 basis points sequentially, and about 50-55 basis points on a YOY basis. Deposit growth is at just 15.8% YOY and down about 0.3% sequentially. YOY is the lowest growth that you are seeing in last 6 quarters, and sequentially it's declined for the first time in last 16 quarters. Advances growth at 18.7% is perhaps one of the best in last 6 quarters. Operating profit growth was just 6% on a YOY basis, perhaps the weakest that you are seeing in last 8 quarters. Provisions increased sharply by 59% YOY and about 119% sequentially. So their NII was below our poll, and due to one exceptional gain this time around, PAT has beaten our poll. Back to you.
Okay, thanks for that, Abhishek. Well, let's hop across to Manglam. He's here to tell us about ITC, which has been one of the biggest gainers in the last month or so. Manglam.
Well, one day ahead of the budget, Macquarie has actually gone ahead and initiated coverage on ITC with an outperform rating and a target price of 535 rupees. They say that while the cigarette business of the company has headroom to grow, it's the stronger pace of growth in their non-tobacco portfolio that makes them a lot more positive. So they expect the EBIT contribution from non-tobacco, which is currently under 20%, to be around 35 to 40% over the next 10 years. In fact, they factor in 11% EPS CAGR over the next couple of years as well. And they're valuing the non-cigarette business for FMCG business at around 45 times and the cigarette business at around 20 times 1 year forward price to earnings as well. For them, the key catalyst going forward after the demerger of the hotel business would be the demerger of the FMCG business and rational cigarette taxation. One of those, which is rational cigarette taxation, is something that we'll get some clarity on tomorrow itself.
Okay, thanks a lot for that. Well, Reliance is also in focus. Let me quickly take you through what brokerages have made of the numbers. Remember, it's been a mixed bag for Reliance this time around. The oil to chemicals business has been quite weak, so that could reflect on the stock. Jio was also under a bit of pressure as per some brokerages, while retail was steady. The stock is down about 1%. Nomura says it was an in-line quarter. They reiterated a buy with a higher target price of 3,600 on the stock. They say Reliance is their top pick in the sector at the moment. Jeffrey says revenues missed estimates. It was a weak subscriber addition for Reliance Jio. Macquarie says Q1 was a material miss due to lower than forecasted geo and oil to chemicals business. They continue to see a downside risk to consensus estimates, and they maintain a neutral on Reliance with a 12-month target price of 27.50. Standard disclaimer, Reliance Industries is the owner of the channel that you're watching, and little bit of pressure is what you're seeing on the stock as we head into a brand new day of trading.
Absolutely, and we'll track the opening in just a bit for you. Just a few seconds to go for market opening. Lots to track. It's going to be, the color is a bit red, nothing deep. Friday, of course, was pretty poor for the entire market, broader markets especially. And here we go. First trades, 0.5% lower, 24,410 or so is where we are starting. 394, little over 0.5% now. Sensex is down about 0.4%, 80,296. Nifty Bank starts about 0.5% down. We're at about 52,000, 51,989, 52,000, just sort of blinking up and under and above that number. Mid-cap index is down a little more, so 0.75% down in the Nifty mid-cap index. Both mid and small-cap indices sold off 2% on Friday. Market breadth is negative, but I mean, it's not like one way. 1,200 down and about 730 stocks higher. That's essentially the lay of the land as far as the opening levels are concerned. But this is a negative start, lower start. All about stocks, so let's get to it.
Prashant, the biggest loser right now is Wipro. Just pull that stock up. It's almost 8% knocked down on Wipro. And as we were telling you, the earnings were a miss. The guidance was muted. It is the 6th consecutive quarter of a revenue contraction. And actually, Hormuz very helpfully tells me that it was a 6.5%, I mean, this 8% drop for Wipro is the most that we've seen since October of 2022. So, so that's one stock to focus on. Apart from that, HDFC Bank, let's take a look at how that one is shaping up this morning, post its numbers. HDFC Bank, okay, just holding out on the green line. But there is a downgrade from JP Morgan this morning on HDFC Bank, so keep that in mind. Reliance is the other one that's really dragging its feet this morning, down about 2.5% post its numbers. As I was saying, the weakness in the oil to chemicals business is, the one that is causing all this pressure. Then you have Kotak Mahindra Bank, disappointing earnings. Net interest margins declined to an 8-quarter low. So keep an eye out on Kotak Mahindra Bank. Indian Hotels, Canfin Homes, a couple of other stocks that are reacting to their numbers. For Indian Hotels, it was a seasonally weak quarter, but it's been a stock that has, delivered returns to shareholders. So there's some, some buying interest there. Canfin Homes is the other one that is under a bit of pressure right now, down almost about 3.5 to 4%. So lots of stock-specific reactions at the moment, but I think Reliance is the one that stands out, apart from Wipro, which is the big loser.
Well, that's right. From the broader markets, Yes Bank, that's a stock that's opened up with a gain of close to around 4%. Lower provisions aided the profitability. The slippage ratio is elevated, but at a 7-quarter low. So Yes Bank is one of the stocks that's doing well from the broader markets. RBL Bank as well, the first tick was in the green. Volumes are fairly high on that one as well. So pointing out both those two. Navkar Corp, well, that stock opened up well in the green. There was a large trade that took place on Friday. Stallion Asset had bought more than a % stake in the company from the open market. So that could explain why there is some excitement on Navkar Corp. That was one of the top gainers. Should come up for you on the screen. Kirloskar Pneumatic, well, the revenues grew by close to 14% on a year-on-year basis. However, on a sequential basis, they were down by more than 40%. That's because of a delay in project execution. So explains why Kirloskar Pneumatic, that stock is a little bit low. And Anand Raj, big uptick is what we're seeing on that name. Opens up, I think, with a gain of close to 4%. So a sharp move is what we're seeing on the upside on Anand Raj. I think there was, it signed an MOU with Google for their data center business. So that is the reason why that stock is up and about. But as we took that market check, well, we pulled back a little bit from the low of the day. I think the good news is we're at least holding on to the 24,400 odd mark. Prashant.
No, absolutely. And, lots happening across the board. Yes and RBL are the two sort of banking stocks which have got the most in terms of gains and volumes right now, 2% and 3% respectively. There is, MTNL just been rising. I mean, 73 rupees now, 5%. It's got large, is the third largest volume traded stock. Look at that, some 12 million shares, 12.6 million shares. TTML, by the way, is the top volume traded name now, 107 rupees. It's up 5%. It's just rising on volumes. That is Tartali Maharashtra, TTML. You've got, what else? Oberoi Realty, which is up 4%, a few other names. So stocks at about, 1740 on Oberoi Realty on your screen. Large volumes. Anantraj is up 4%, 500 plus on Anantraj. Just Dial had a very large move. I think it was on Thursday. 2% on Just Dial. Shakti Pumps is back up 5%. Closer to 4,100 once again. Many of these stocks have had whipsaws on the way down and then sort of recoveries now. But it's a quieter kind of session. Quick Heal had a big move, I think, one of these days last week. It's up about 4% right now. Actually, I think Quick Heal had a good week overall last one. SJS is up 10% on some volumes. HG Infra is starting ends. Nitin Spinners has got about 7%. But, that's essentially the bulk of what's rising on some decent-sized volumes. On the downside as well, there is Bharat Dynamics, defense name, 3% lower. Tejas Network is down about 6.5%. 13.18 on Tejas Network on large volumes for now. Apar Industries is down about 5%. There is Canfin Homes, which is down about 3.5%. Credit Access, and you will just hear from the management in just a bit. Credit Access is down 5%, 12.23 on that name. Root Mobile is down 4%. Anand Rathi is down 4%. Raymond is down 5%. And I could go on with a few more names, but more down than up, clearly. 400 stocks are higher, and you've got about almost 1,800 stocks, which are starting the day down and out. Devina Mehra is now joining us. She's the market master for the day, founder, chairperson, and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Prashant this side. It's always a pleasure. Devina, markets have done phenomenally well. Nifty is up 12% from the 4th of June close, the election day. Mid caps and small caps even better. And now we get into the budget. And we also are, of course, not hearing, but the SEBI chief has made it very clear that on the F&O side, there are rules and regulations coming to tighten it. Where do we find ourselves in terms of markets? I'm talking slightly near term, not very long term, but not very short term as well, but shorter term. Devina.
Good morning, Prashant. A very short term is not something that I look at all, and even reasonably short term is not where my focus is. So, as I have spoken earlier on your channel as well, that on a 1-2 year basis, I am not negative on the market, and primarily because you had a whole decade of below market returns. 2010-20, that decade was so far below market expected market returns of 15-16%. It wasn't even 9%. It was pretty close to the FD rate for a whole decade. So 100 rupees in 10 years became only 230 rupees, and which is very different from what happened in the other decades. Of course, the outlier was the 1980s decade when 100 rupees became 700. So that's what gave you the room to grow. So the way we have done it is that we are fully invested in our PMS, but we are partly hedged. Before the elections, we were fully hedged. Now also we are about 50% hedged to take care of any interim volatility. But I'm not negative on the markets. We just finished our rebalance last week. We do a quarterly base zero rebalance. So there have been changes in the portfolio, but we are not negative on markets as a whole. But as I have warned again many times, be very, very careful on the small and micro caps. So in our portfolios also, while we normally used to have about maybe 14-15% investment in stocks between, in 1,000 to 5,000 crore market cap, now we are down to, I think, 6% or thereabouts. So that's because that's a area which you cannot manage risk effectively, because there are two tools primarily of risk management. One is stop losses, and stop losses don't work in small caps. When they go down, it's circuit down every day. And the only other hedge you can use, which is liquid, is a Nifty put, which again does not move in sync with the small cap. So that's where a lot of people watching this may have made a lot of money. Now is the time to go into a steadier portfolio. That would be my advice.
Okay, Devina, hi. Always great speaking with you, and good to see you this morning in your bright attire, brightening our mood for sure. But is there anything in the budget, Devina, that can change the course of the market? I mean, I know every time we speak about it because that's our job, but generally budgets don't really affect the texture of the market in the near to medium term. Do you think this budget would be any different?
I don't think so. I mean, of course, there can be a macro change, like there can be a change in something to do with taxation, for example, either direct or indirect, which affects things across the board. That's one thing, but I don't think there will be a change in corporate tax this time. That's not what I'm expecting at all. So probably not. If there's a change on the personal income tax side, it boosts consumption, which definitely needs a boost. We've had very poor consumption growth numbers. Other than that, if there is specific changes in specific industries that, for example, there are industries where the GST is higher than 18%. If, let us say, two-wheelers, it comes down or something like that, that can impact directly that industry. But other than that, I do not see a budget to be a great event, and it should not be. I mean, in most countries, budget is not the event it is in India.
All right. Hi, Devina. Good morning and good to hear your thoughts. Devina, the last time we chatted, you were telling us that IT could bottom out at some time during this year. It seems the street is calling for that, going by the numbers that we had. How are you all placed on tech?
Yes, so IT is where we were slightly overweight going into this rebalance, and now we are a little more overweight. Yes, so our systems are showing that it has probably bottomed out. And the other thing which I had spoken about was that whether industrials and capital goods, that segment will top out. So that signal has not come. So we've been overweight on that sector, as I have said earlier, also since October 21. So it's getting close to 3 years. We are no longer, of course, very highly overweight, but we continue to be a little overweight. And of course, there have been some changes in stocks in that sector. But we still remain somewhat overweight there too.
Okay, you were a little wary of some banks as well, and that was the reason why you were not going overweight on banks, though consensus was saying that banks are in for a good run. That's not really played out. Now, how are you all positioned on the banking names, going by the numbers that we have had and the commentary as well that's coming in?
So, I mean, on banks, if you look at 4 years from 2020 onwards, banks have underperformed every single year barring 2022. Every single year. All other 3 years, banks, you look at Bank Nifty versus Nifty, Bank Nifty was a huge underperformer in spite of the run in the PSU banks. And as I have said plenty of times, that I am a nervous investor in non-lenders. We remain underweight banks, though. I mean, I would think that given a long stretch of underperformance, probably that, that grave underperformance period might be a little behind you. This time, the changes we have made, while our overall weight in banking has not changed much, so we have moved out of some PSU banks and added some private sector banks. So that's a change. Interestingly, this time our systems did not like all the non-lending financials that we were holding, the asset management companies, the stock exchanges, and anything related to the market. It downgraded every single one. So we are more or less out of that segment. So that was an interesting thing in this rebalance.
Devina, so one thing which you've pretty clear about is that one should rebalance the portfolio if not one has already not done it. Made a lot of money in mid caps, small caps, micro caps. So your advice is take profits if you're doing it yourself and move to slightly larger larger companies and large caps in that sense. So is it possible we perhaps could look at, the most common argument which is thrown at anyone who says, well, maybe one should do that, or maybe we are in for a phase of consolidation or sideways market is, of course, there is a huge recency effect because every time people have called for it, markets have continued to run ahead. And this number two is, of course, liquidity, which is all real. If you get the numbers every month, it's just a big gush. So just your sense, Devina, what we should expect in that sense. Are we, is there going to be a time period where earnings will have to grow into prices, especially in the broader market?
Talking of liquidity, for one, I'm never a votary of that. If money comes, the market goes up. It doesn't show up that way. But more than that, if you look at the recent months and quarters, most of the money has come in certain themes, where it was small caps, it was defense funds, it was these kind of themes. And if you look at the history of thematic schemes from mutual funds, where the history is there for a long time, they always come near the peak of that that cycle, which is not surprising because, after a segment has done well, whether it's an industry, whether it is small cap, whatever, is when the layperson knows about it. So they go and put money in that theme. But if that theme has to crash, it crashes. So, I remember last year someone told me that, ma'am, you keep talking about against thematic funds, but here is this technology fund, which was 2 rupees in 2003, and in 20 years it has compounded X times. And I said, very good. So it was 2 rupees in 2003. Did you see when it was launched? And it was launched exactly 1 week before the tech crash. So in 2 years, it had gone from 10 rupees to 2 rupees. And now you're telling me the compounding from 2 rupees. So be very wary of buying into any theme which has already run up, which is primarily all the new fund offerings that come are in themes which have already run up. So in 2021, I was warning same thing about NASDAQ ETFs and NASDAQ ETFs and funds being launched in India, saying this is also recency bias. NASDAQ has done brilliantly for 3 years. It won't last forever. And sure enough, it fell 40% from those peak. And some people compounded a bad buy with a buy sell, with a bad sell by also selling at that 40% down. So be very wary of themes which have already run up and do not fall for this that someone was telling me, but there will be a unlimited money chasing limited number of stocks. And I really laughed. I said, for 30 years, I have seen this argument. It never works. The stocks which were darlings and everybody was waiting to buy them still will crash if the fundamentals don't hold up.
Absolutely, absolutely. That's a fair point. Devina, always good speaking with you. Thank you for joining in. And tomorrow is a big day. It's the union budget. Hopefully, we'll speak to you post that as well to get your sense on how to approach the markets from here. But always good speaking to you and seeing you this morning. Thanks for joining in.
Thank you.
Okay, well, that's the word on the markets, which, by the way, is not bad. It's actually pulling back. The dips are getting bought. The Nifty is not bad at all, down just about 0.3%. And as you can see, that early morning dip has gotten bought. The market perhaps is sanguine about something, maybe to do with the budget. But there are individual stocks which are still under pressure. Credit Access Grameen is the next management on the show. There is incremental stress in the portfolio, which has risen massively. The disbursals have declined 44% sequentially. To discuss this and more, we have Uday Kumar Hebbar, who is the MD of Credit Access Grameen. Mr. Hebbar, good morning and thanks for joining in. First, if you can tell us what's the outlook on the NPAs, because there is a lot of incremental stress in the portfolio. So can you give us some guidance on what asset quality could look like going forward? I mean, your gross NPA ratio is still around 1.5%. Do you think it can get worse before it gets better?
Good morning. Very happy to be here. So our credit cost is slightly increased. If you look at our guidance, we actually increased the credit cost guidance during the start of the year to 2.4%. Whereas again, today we are at net credit cost of 2.6%, considering some difficulty in the first quarter. But however, we would like to reiterate that our credit cost guidance of 2.2 to 2.4% will remain same. We would be able to manage within that. While we are talking about the increased credit cost, we need to note that our credit cost is based on stage 2 consideration at 15 days DPD and stage 3 considering at 60 days DPD, which means we have almost 116 bips higher provisioning as against our 90 days DPD. So which therefore it's a question of early recognition of risks actually. So we estimated little higher risk compared to last year and guided accordingly. So therefore, we would reiterate again that our credit cost will remain within 2.2 to 2.4%, which we guided for annual FY 24-25.
All right. Hi, good morning, Mr. Hebbar. Got that. So 2.4% odd is what we're talking about on credit costs. Give us a sense about the AUM growth for the year. What are you looking at on a year-on-year basis? It's up by 20%. On a sequential basis, it's mildly lower. So tell us for this year and the next, what kind of growth are you looking at? And also the retail segment, their growth has been quite robust and it's moved up. As a percentage of your total mix, what do you see this book move to, the retail finance AUM?
First quarter disbursement resonates normal, low or a muted first quarter always. So there is not too much variation between FY Q1 24 to Q1 25, which is muted. And when we always keep telling that whenever this election, there will be muted growth because of the operational difficulty during that period, or there are some limitations in due to code of conduct. That's common for the microfinance sector. Therefore, it resonates the first quarter syndrome. And while we're giving the guidance for the year, we guided 23-24% overall growth, whereas microfinance growth we guided as 20% as against 24.7% of FY24. We have actually reduced the guidance for microfinance growth, and overall our growth should be 23-24%, which we don't see any downside risk for that. Retail is definitely robust. We agree that we would be growing higher in retail because we have a large number of retained customers who are vintage customers, and this retail is nothing but giving the differential or what you call product which is needed for them, like two-wheeler loans, individual business loans, LAP or home for our vintage customers. Therefore, we have a large number of customers who, out of 5 million, even 10% of, if you convert, we have 15-20,000 crores potential portfolio in next 4-5 years. Accordingly, we believe that retail should go as usual, and microfinance growth may taper down. This year, we estimated 20%. We are quite within that guidance, and we reiterate our guidance for the year on AUM growth.
Right. So thank you for joining us, Prashant here.
Hi, Prashant.
So on microfinance, sir, are you going slow, or is there sort of slower uptake of credit?
No, it's basically, as our base is increasing, we cannot keep growing at 25-30%. So therefore, we believe that it would taper down a bit. That's why our next 4 or 5 years of guidance, we actually said that microfinance is slowly tapered down by 1 or 2% per year, whereas retail will take that space. So therefore, we believe that it will still grow overall 23-24%, but microfinance would be about 20%, which is what we guided actually, and maybe 1% each year it may come down, considering the base is increasing continuously.
Mr. Hebar, one of the things we've heard from many in the industry is, rising leverage across the customer base for NBFCs, banking, everyone, right? And one of the ways it manifests is multiple loans that each good customer has. I mean, could you just tell us, how are you mitigating some of that risk?
Yeah, it looks like little higher leveraging, but you have to see from FY20 to FY24 or FY19, because there is a dip in the leverage, there is a dip in the GLP per customer, and increase after COVID. If you see from 1920 to today, it may be a 15% increase or a 14% increase. But because we are looking only 2 to 3 years, last 2 years after COVID, it looks little high leverage. So we don't see too much leverage in our industry. Also, growth is not very high. But yeah, little leverage is increasing. Number of loans also increasing. But we put an internal rule that we will not be the more than fourth lender. Maybe some states we may be only third lender. Now that even MFIN, the industry body, aligned with all the members, including the microfinance, the banks, SFBs, and NBFCs together, we decided that we will not be lending more than as a fourth lender. We should not be more than fourth lender. Overall leverage of the client should not be more than 2 lakh. So these are the guardrails MFIN as an association we put in. I think this should further help to strengthen and build resilience in the microfinance industry. This will help further.
Okay, all right. Mr. Hebar, just to reconfirm that number, the AUM growth for the year is 22 to 23%, right?
23 to 24%.
Okay, and retail finance moves to mid-teens as a percentage of your book in the coming years?
So it should be by 28, we estimate it should be about 15% of our overall book.
Got it. All right. What about the NIMs? We've got growth, credit cost, and tell us about NIMs. What's the guidance of that?
We guided about 12.6 to 12.9%. We should be within that. And this year we guided at about 12.6 to 12.9. we should be able to manage that. So we did the risk-based pricing at a district level. We identify the risks at district level. The provision we make at district level. So we align the pricing, the risk and provision all to a district and granular level, which helps us to manage the risk and price accordingly and provide accordingly.
Okay, well, thank you, Mr. Hebar, for joining in and talking about Credit Access Grameen. But JSW Steel is the next management on the show. It reported an in-line set of Q1 earnings. The top line was a beat on better realizations, but there was a small miss on margins. Nigel caught up with Jayant Acharya, the Joint Managing Director and CEO of JSW Steel, and began by asking him about the quarter gone by and how they see growth going ahead. Listen in.
As far as the prices are concerned, I think first on the raw material side, the raw material prices, as we had indicated, has dropped on coking coal by $23 odd. We expect a similar $23 to $28 drop, let's say, in this quarter as well, which will flow into the cost in quarter two. Iron ore prices have started softening in India in line with the international price as well. Some part of that will again flow through into quarter two. So softer raw material prices will again support the margins. Steel prices in the month of June came down, while in the month of May there was an improvement internationally in India as well. But there were corrections in June by and large across geographies. And that resulted in some softer prices going forward into this quarter. We expect now the prices to remain range-bound and margins to be supported through a softer cost structure.
Okay, all right. Let's get a couple of aspects then going, Mr. Acharya. As you said, input cost, you'll see some bit of benefit of roughly around $25 per ton. So that's good news. Steel prices, you're expecting to hold steady. I'm looking at EBITDA per ton for the India operations. Let's talk about the India piece first. It appears that the India EBITDA per ton has improved by around 550 to 600 rupees per ton. Do you believe that the trajectory is upward now and we continue to see an improvement in the India EBITDA per ton?
Yeah. So I would just like to clarify one point here. This quarter, in quarter one, we had some one-offs. So we had an impact of almost close to 2,000 rupees on account of inventory revaluation and some other one-offs in the balance sheet, which will be, let's say, not reappearing again. That's one positive. Secondly, from an India EBITDA perspective, as we discussed, the raw material prices, the softer raw material prices will flow into Q2, and that will support your margin. From a product mix perspective, if you see JSW Steel, we have taken a lot of initiatives to improve the product mix, and that has given us an upside. So in spite of a softer steel price, we could actually take the Indian, let's say the Indian realizations up by about 550 odd rupees per ton. Going forward, we expect that prices will be range bound, but our efforts to continue to improve the value-added piece will continue. Last quarter, it was 64% of our total sales.
Okay, all right, 64%, got it. So that protects you all with regard to the steel prices. A quick word on the international business. That struggled in the past quarter. Do you expect a couple of more quarters of pain? If you could give us a sense on that. And since we're talking about the overseas business, also from India, you'll export steel, and that proportion came down to around 10%. Where do you see this number stabilizing at?
So from an India perspective, I think I would say that if you were to look at our past history, we have been in the range of about 10-15%. Last quarter, we went to 20% because there was a window of opportunity which we got for exports when people were stocking up before the summers. But however, the international prices in this quarter were muted. The demand also was softer, due to which we recalibrated our exports in favor of domestic market. The domestic market was very strong, and therefore we chose to put more tons into the domestic market, and therefore our sales YOY for domestic India operations went up by 14%, which is a very good number. The India operations delivered the highest quarter one sales ever. Driven by various sectors, like especially in the sustainable areas like renewable. We did the highest sale to renewable. We did the highest sale to packaging, which is the tin, which is replacing plastics. We did the highest sale to electrical steels segment, where the energy saving is very efficient, etc. So that helped the India operations quite a bit. As far as the US operations were concerned, I think there was a sharp fall in prices. which basically impacted the operation. The volume has been by and large stable, and we expect that going forward, we expect volumes to be reasonably at a similar level, but the outcome on prices is yet to be seen. Italian operations have been by and large stable in Q4 and Q1.
Okay.
Going forward into Q2, we expect that the Italian operations will remain stable to slightly better.
Okay, all right. What about the net debt number? It's holding at around 80,000 crores. You have a big capex plan as well. Does it move higher from here?
So, Nigel, this 80,000 crores, we actually allowed the debt to increase because we spent about 4,500 odd crores on capex. We paid about 228 odd crores for some of our mining areas where we were to start up the coking coal mines. So that is something which we wanted to do because we wanted to complete our expansion projects quickly. We also repaid about $300 million of acceptances, which is about 2,500 crores. So that basically resulted in the debt going up a bit, but and some working capital build-up, I would say, for the operations which are coming on stream. So from that perspective, the debt got built up, but I think it's well within the range, and as the working capital gets released, you will see an improvement in the ratio levels as well.
Got it.
The net debt to equity remains flat. I think it's still below 1.
Okay, all right. Are you looking at any inorganic growth? I need to ask you that question because Mr. Agarwal is saying that he's a seller, but he's a seller at more than $1 billion for 1 million tons of steel. Are you interested in that asset? And any movement on NMDC Steel? Last time you said that maybe post-election something could move. Have you heard anything?
So, Nigel, on the first one, I think we remain interested in the mining assets, but not in the steel asset. In the second one, which is NMDC, we are hearing something from the media, which I think you are reading as well. We will wait for any official announcements to go ahead. We have anyway given our expression of interest, and we will see how it goes. On any other inorganic assets in India, no. Our interest on our mining areas in coal remains for prime hard coking coal, which, as we discussed last time, we continue to look for assets which make strategic sense for us.
All right, final question. What about the budget 2024? What do you expect?
So, no, I think the good thing about post the elections, the government has now come back. We see a renewed interest and focus on the oncoming budget on 23rd. We expect that the infrastructure and capex spend which the government has been doing will continue. The focus on manufacturing and energy transition will continue. They may take some steps to improve consumptions and general welfare and social initiatives, which is good. On the specifically for the steel industry side, I think I would say that the Indian steel industry is really trying to come up to the National Steel Vision policy and the vision of the Honorable Prime Minister to make in India and be self-reliant. A lot of capex is going into the creation of capacities. We should not allow, because India is growing at a very fast pace, the surplus steel which is now finding its way into India, we should not allow that to happen. Rest of the countries have blocked it. India should take proactive measures quickly to see that this unfair trade does not take place.
All right. Well, that's Mr. Acharya guiding for better times ahead. He's saying that steel prices will stay stable, but they'll get some benefit on the back of lower costs, and also calling in for some measures to protect the domestic steel industry. Well, time to move on then. Let's talk about Indian hotels. The stock is buzzing today despite a seasonally weak set of numbers in the last quarter that was impacted by elections and a heat wave. The MD and CEO, Mr. Puneet Chhatwal, spoke to CNBC. He said that he was positive on growth going ahead. He also gave an outlook on their expansion plans and on demand going ahead. Let's hear him out.
This was a good quarter, keeping into account that every 5 years when there is elections, there is a dip in the business. The international delegations don't come in. Everybody waits for the outcome of the elections. There is a code of conduct that is put in. There was extreme heat this year, and there was no one-off like the G20 last year. So keeping all that into account, I think showing a growth was a positive. But what is happening is that has created pent-up demand for the second quarter. And what we saw in the first 17, 18 days of July was like a 20% increase over July of last year. Our focus remains on the Indian subcontinent for all our brands.
All right. Well, that's the management of Indian hotels with some perspective. We'll take a quick commercial break here with news that markets have staged a very, very strong recovery. I mean, we're down only 20 points now. The Nifty will come up on your screen. And we're at 24,500 plus once again. Take a look at that. The Sensex is down only 70 points. Nifty Bank is actually in the green. The mid-cap index is up 0.25%. And market breadth is completely flipped around. It was almost 4:1. 4 down as opposed to 1 up. And now you've got 1,400 stocks which are higher and about 1,000 stocks which are lower. So a sea change as far as the screen goes over the last 45 minutes or so. We'll take a break. We are back with the management of ICICI Lombard. Stay tuned, that's coming up.
Welcome back. Well, let's get straight to the next management on the show, which is ICICI Lombard. It reported a mixed set of numbers. To discuss what went on in the past quarter, what's the way ahead, we have the company's CFO and Chief Risk Officer, Mr. Gopal Balachandra, who joins us on the show. Hi, Gopal. Thanks a lot for joining in. Well, though the premium growth has been strong, your underwriting loss only increased by around 8%. So what's the strategy to improve the underwriting performance, and what could be the kind of improvement we expect on a sequential basis for the remainder of this fiscal?
Just to kind of refresh, I would only say that the more the businesses grow, given the fact that the earnings, as you rightly mentioned, happens over the contract period of insurance, whereas the costs are front-loaded. So to that extent, when you look at it from an absolute underwriting outcome, in times of growth, obviously you'll obviously see that number slightly showing an elevated outcome. And that's exactly how it has played out even for us. But I think the larger thing that I would keep saying is a better number to look at is more the combined ratio outcome. And there, if you would have seen, let's say for Q1 of last year, we were at roughly at about 103.8 in that range. And the current quarter has been about 102.3%. And if you look at, and that's where we get a lot of positive from, given the fact that there has been an improvement in both growth in revenues. I think even equally the loss ratios have been largely maintained, and the fact that the expense of management has been within the regulatory stipulations that has been laid out. So I think, which is where if you look at the combined ratio trajectory, I think that's looking very well for us, in line with what we have been talking to the market as well. And for the exit of Q4 of FY25, we have spoken about a combined ratio exit of about 101.5. So if you look at in that context, I think directionally, for us, the combined ratio trajectory is moving in that direction. As I said, aided by renewed growth momentum, obviously a lot of focus on the loss experience, and more importantly, efficiency and productivity in the way we are running our operations. But from an absolute underwriting outcome, given the fact that the expenses are taken upfront, whereas the earnings of premium happen over a period of the contract of insurance.
So the combined ratio has improved to 102.3 versus 103.8. Which segments saw the biggest improvement this time in terms of combined ratio, and what's the FY25 target on the combined ratio? Also, what will that journey look like quarter on quarter now?
So again, if you were to put that in the context of the market, I think if you look at the market is, as I said, still elevated at an aggregate level as 102, 112. Within that, I think if you look at motor as a category, which by far is of course the second largest to the industry revenues, that has obviously seen some improvement from 121% to let's say 118, but it is still elevated. Now, obviously, the trajectory that motor combined ratio takes and the industry combined ratio takes is something that we will very, very closely watch for. But at this point of time, I will take the second question first of yours in terms of how do we see the exit of combined ratios for ICICI Lombard towards end of FY25. At this point of time, we are sticking to the thought process that we have spoken to the market, which is, as I said, trying to get to a combined of 101.5% by exit of Q4 FY25. This obviously is in the context of how the market environment plays out, and that's something that we will very, very closely watch out for. Your first point on where have we seen the improvements in the combined ratios? I think, as I said, it's been all round. I think in general for us, we have been able to see an improvement in our combined ratios on commercial lines. Even for us, motor, I think the combined ratios improved relative to the last year. And even on the health side, I think on the corporate health specifically, given the fact that we are able to win accounts at our price, again, I think the combined ratios have been positive. On retail health, I think at this point of time, given that we are making those investments in expansive distribution, obviously the combined ratios for the time that we continue to make these investments, the combined ratios will stay elevated. But what we are happy about is the fact that it is running at a loss experience that we are comfortable with.
I've got it. Gopal, now loss ratios in health segment spiked to 83.6% as compared to 78.7%. Was it because of individual or the group segment? And what would be the target to reduce the loss ratios in the health business too, both retail and group? If you could detail that out for us.
Again, as we kind of put out even as a part of the earnings call, on the health side, again, if you look at for Q1, specifically of this period, I think what we have seen is possibly some elevated increase in frequency of claims. And obviously to some extent also an increase in the average claims cost as well. But that's something that we will watch for. Q2 in general for health is slightly elevated consequent to the monsoon season. So therefore we do see some increased incidences of claim. But having said that, I think for the rest of the year, insofar as both the segments that you kind of talked about, whether it is corporate health or whether it is retail health, I think the loss ratios range that we're comfortable on the corporate side is generally in the range of about 94 to 95%. And on the retail side, I think we're comfortable operating at a loss ratio of about close to 70%. So the good news is I think the kind of the portfolio book that we are building up possibly gives us a confidence that we should be able to end the year at those levels of loss ratio ranges.
All right, Gopal, for health, the growth in the premium for retail segment moderated, whereas the employer-employee was strong. What's the management's intention to grow retail or the employer-employee? And what share do you see retail and group by the end of this fiscal?
So if you ask us, health as a category is a preferred segment for us. Now that obviously kind of includes both, as you rightly mentioned, employer-employee as well as, let's say, the retail health. Now, when it comes to employer-employee, effectively as what I was talking about, in the past, there have been challenges from a market perspective. The market, because the loss ratios for that segment was significantly elevated. Now, obviously, thanks to some of the improvements in pricing that the market has seen, which is why I talked about the fact that for ICICI Lombard, we have been able to win accounts at a price at which we are comfortable with. And hence, that gives us the confidence that we should be able to run that book broadly at a loss ratio range anywhere between 94 and 95%. But if you ask us, is that an area of thrust? Of course, it's an area of thrust, given the fact that there is an improved pricing sentiment that is playing out in the market. So hence to that extent for ICICI Lombard, that's a very, very preferred segment. On the retail side, again, as I mentioned, that's an area where currently we are in an expansive mode. And thankfully, the way we have been kind of expanding the book, as I said, again, is leading to a loss outcome broadly at a loss ratio range that we're comfortable with, which is at about 70%.
Are you looking to take any price hikes in your health portfolio?
If you ask us, I think at this point of time, we believe we are fairly priced in terms of the health insurance offerings that we have, particularly on the retail side, given the fact that that's a solution that we have kind of recently put into practice. But having said that, obviously, that's something that we will keep looking for in terms of the loss outcome of the portfolio that we're underwriting. At this point of time, as I indicated, I think the loss ratio range that we are largely comfortable with is operating on the retail side at about 70%. And to that extent, we believe, I think we are kind of fairly priced. But obviously, we will see the experiences play out over the subsequent quarters. And should there be a need for us to do any kind of a price revision, obviously, we will come back and talk to the market specifically about that. But more importantly, I think if you ask us, a larger focus for us is also on trying to manage the cost of claims. And to that extent, I think there's a lot of focus that the company has been kind of doing in order to make sure that we are also able to keep the cost of claims under check.
Got it. Now, loss ratio in the motor segment has also come down. It's down to about 66.8%. And in the property and casualty segment, is down to about 74.9%. Is there further scope, as you see it, to reduce loss ratios in these segments, and to what point?
On motor as a category, I think generally we are comfortable running at a loss ratio range between 65 to 67%. And within that, we have talked about on motor own damage, a loss ratio range of between 60 to 65. And on third party, a loss ratio range between 65 to 70%. So that's in motor as a category. On the property and casualty, which is largely, let's say, the commercial lines, I think, again, we would keep saying that I think it's very difficult to look at it from a quarter-to-quarter basis, primarily because some of these catastrophic events can have an impact in the loss numbers for that particular given quarter. So let's say, for example, in a given quarter, you see 2-3 flood events or catastrophic events. But naturally, given the nature of the business, obviously, we will see some losses. But when you look at it over a longer period of time, which will kind of play out in terms of averages, I think at this point of time, commercial lines for us has been one of the best ROE generating segments of businesses as well. And that's a segment where for ICICI Lombard, we have been continuing to increase market share as well. And hence, therefore, to summarize, both on motor and the commercial lines, the loss ratios range over periods are kind of well within the range that ICICI Lombard is comfortable operating at.
Gopal, we'll leave it there. Thank you very much for joining us and running us through all of that detail and a fair bit of guidance as well as you see it. Thank you for your time. Well, let's talk about the next company, JSW Infrastructure, the ports companies in focus. They saw a muted start to the first quarter. Their volume growth in Q1 has been impacted by maintenance shutdowns. To discuss some of this in detail, we're now joined by Arun Maheshwari, Joint Managing Director and CEO at JSW Infrastructure. Mr. Maheshwari, great to have you with us here. Thank you for your time. Prashant this side. Soft start to the year, we understand that volumes were impacted by maintenance shutdowns at Dolvi. Is that back up again? Is it up and running now? And second quarter onwards, can we expect volumes to come back to the 30 million ton run rate?
Yeah, the shutdown is over, and we'll maintain our guidance of 10 to 12% growth year-on-year basis for the full year volumes.
Okay, do you stick to your guidance that you gave earlier of 10 to 12% volume growth? And the second half, will we see a resumption of the Dolvi plant? Also, what is the kind of inorganic volume growth that we're looking at?
So, Navkar capacity, we are not adding up to our volume guidance, what we had projected earlier. But rest of the year, we expect 10 to 12% for sure. We'll be able to achieve that.
Well, tell us about the agreement with JSW Steel. This is sizable to your business, 30% of FY24 sales. You say it will generate mid-teen IRR. What's the rationale? And you envisage that shareholders push back from JSW Steel. What is the quantum of EBITDA contribution that you see from here?
Connectivity deal, because if you see our journey, we have been getting into the port connectivity, whether Navkar we talk about or whether slurry pipeline we talk about. It adds volume to our overall business, and to our port businesses becomes more and more robust by virtue of such deals. So this is one deal, such deal, which will greatly add value to our stakeholders. And it's completely in sync with our target of port connectivity projects. So I expect this to add decent volume and decent growth to our bottom line and top line both.
Mr. Maheshwari, give us a sense of the tax rate that will be applicable Q2 onwards, the effective tax rate going forward, and any tweaks to sort of, your internal assessment of PAT estimates.
So PAT remains as robust as it was. So this quarter PAT, if you see, it is a bit compromised. This is largely because of accounting entry. Last year, same quarter, we had a forex gain of about 87 crore rupees, which was not there in this quarter, which was an unrealized gain, and it's more to do with the accounting entries. So I think we remain as robust operationally as we were earlier. Going forward, our tax rate, if we say, in some ports, our Section 80I benefits are getting exhausted. So we'll maintain around 24 to 25% kind of tax rate would be there.
Okay, sir, but tell us about the rationale behind the acquisition of Navkar Corp. How does it aid your portfolio? How much JSW Group volumes was it handling? And also give us a couple of operational metrics as well as financial metrics, the improvement that you're looking at.
So if you see our journey, we started in 2002, 2004 as a captive port company. Till good 15, 16 years, we were doing only captive businesses. Thereafter, we ventured into the third-party businesses, which was 6% in 2019, grew to 50% in Q1 FY25. This is a natural extension of Navkar. You serve through the port to our customers, and thereafter you have to get into the last mile connectivity, last mile delivery, customer delight, and making the customer more and more stickier to you. So this is one such step we have done. It's a natural progression for any port company to get into last mile connectivity. This is where we are getting into the phase now, and Navkar is first such acquisition for us. So we would like to make operationally very, very robust this particular company. Very, very strategic locations. They are rail connected, whether it's in Mumbai or whether it's in Gujarat. So far as JSW volumes are concerned on Navkar, it's very minuscule. Rather, I would say maybe around 5% of the total volumes would be JSW Steel. Otherwise, it's a very, very independent, and it is largely targeted towards the inland deliveries for containers or stuffing, de-stuffing, or cement players and other people.
So you've mentioned a lot of scope of growth after signing the concession agreement with Chidambaram Port in Tamil Nadu to develop a new 7 million ton cargo berth, and also further discussions are underway for equipment specs and ordering. Can you tell us a little bit about that?
It's one of the very, very fine acquisitions or bidding, securing a winning bid over there. It's an operating terminal. This is an operating port. So hinterland is very rich. About 10 to 12 million ton of cargo is immediately seen within next 20 to 50 kilometers of that port, and there is absolutely no competition nearby over there. We expect it to be operating almost 80 to 100% in the first year of operation itself. So we feel it's one of the finest bidding when what we have done in the recent past.
Mr. Maheshwari, you had mentioned a 30,000 crore capex plan, rupees 30,000 crore capex plan. Can you confirm this figure? And what are the other new opportunities? You said in last mile connectivity, Navkar is the first such step. What are the other opportunities to deploy this money?
So these 30,000 doesn't include any of the acquisitions, because acquisitions we don't know how much we'll do and what we will do as the opportunity comes in. These are the defined and identified project which we have done so far. Few of the things we have already mentioned in our previous calls, whether it's a Keni or Jatadhar or upgradation of Tuticorin or upgradation of Jaigarh Port, Dharamtar, JNPA. Then a few more investments into nearby Navkar and other terminals. So these are defined projects what we have, ancillary pipeline I just mentioned. So these are defined projects what we have laid down till 2030. Any acquisition or any further bidding to any of the terminals or any other opportunity coming up, it would be over and above 30,000 crore rupees. It all depends upon how the balance sheet fares and how we see the leverage ratios in our system.
Okay, well, that is on the capex. But I also wanted to ask you about these reports indicating that JSW Infrastructure is set to win the Murbe port deal. What is the official word here? What capex is required? How is the location good for you? And what volumes can be seen?
So we are awaiting, as of now, Maharashtra Maritime Board's outcome. If it comes to, then it would be a very good value addition, because the way our Dolu plant is expanding, the way we see our Wasin and Tarapur plant expanding, and the nearby hinterland what is there, this port will certainly help us to develop that. But as of now, we are awaiting feedback from Maharashtra Maritime Board.
Okay, thanks a lot for joining in. We'll slip into a quick break. On the other side, we'll connect with Nitish Ranjan, the Executive Director of Union Bank of India, to discuss their Q1 earnings. Stay tuned.
your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other...
Welcome back. We are continuing with our earnings analysis, and now we focus on Union Bank of India. For the first quarter, the bank saw elevated write-offs which have aided bringing down their GNPAs. Also, their provisions, the overall provisions are up 40%, but NPA provisions are down. In fact, provisions are up 120% sequentially. To discuss more about the performance, we are now joined by Nitish Ranjan, the Executive Director at Union Bank of India. Mr. Ranjan, good morning, and thank you very much indeed for your time. Well, let me start with the NPA, since that's something that's gone down significantly. Your guidance was actually 4% and still at 4.54. When do you hit 4?
Yeah, good morning. So far as the NPA is concerned, we have given a guidance for the current financial year that by March 2025 will be below 4%. And in line with that, we have been able to bring down the gross NPA further to 4.5% for the quarter ended June. And we are very hopeful the kind of delinquency guidance we have, recovery pipeline that we have, that will be able to achieve our guidance of below 4% gross NPA by March 25.
Okay. But I must remind you that the Reserve Bank put out in June the financial stability report, and there the average for the whole country, banking sector, the GNPA is 2.8%. You're almost double that figure. So one would expect a faster reduction of NPAs. Do you hit 4 in the first half itself, or will it take the whole year? Will you go up until the fourth quarter?
Definitely the endeavor would be to achieve below 4% well in advance of the guided timeline. But I also request you to appreciate the fact that if you look 2 years back, our gross NPA used to be over 10%. And from that high level, we have been able to bring it down to around 4.5%.
No, I agree. The whole sector was almost at 10%, if you remember. So all banks have had this problem, and one is only looking for a faster reduction. Your NPA provisions have gone down significantly, now at 1,600. Is there more scope for those provisioning to go down? I mean, for credit costs generally to come down.
Right. So credit cost last year was around 0.7. This first quarter also, we have been able to maintain at around 0.7. But I think it has the downside potential to go down further.
Okay. Your write-offs are fairly significant. Should we expect a similar number to continue?
I think write-offs, if you look at the average basis, whatever we have done in the last full year, compared to that, it's very low. And hopefully we'll be able to maintain the similar trend during the current financial year.
No, the reason I'm asking is that your restructured book is still big. Although it's coming down, it's come down 11%, it's still a nearly 12,000 crore book. So there is always this fear that there can be higher write-offs, but the advantage can be there can also be higher recoveries. Can you give us some guidance on recoveries?
Yeah, so for recovery this year, we have given a guidance of 16,000 crores of total recovery. of which in the first quarter we have done close to 3,350 crores. And we are very hopeful that we will be able to achieve that target, given that we have around 41,000 crores of gross NPL on the book, and off the book we have close to around 80,000 crores of written off accounts. So around 1.2 trillion of pool is there from where we have to do the recovery of 16,000 crores. Last year also, you'll note that we did a recovery of 18,500 crores. In fact, we surpassed our own guidance. So we are very hopeful and sanguine that this year also we'll be able to surpass the guidance of 16,000 crores of recovery.
Okay, no, that's very good to hear. Let me come to the other number also, which was extremely encouraging, that your slippages, the pace of slippages is falling. Can you give us an idea whether there is any stress at all? See, you know, in some of the banks, it looks like the fall of the NPA has bottomed out now. Even HDFC Bank reported a minor rise in GNPAs. Of course, it's seasonal. It's quarter one. Do you think you have more downsides? Or do you think that retail NPAs, for instance, can start rising?
No, we are not seeing any kind of trend, particularly in the retail, agri or MSME, that it is rising. If you look at even the quarterly incremental delinquency, even in agri and the MSME segment, it is close to around 2.5% only incremental delinquency, which shows that the asset quality at the current level is quite good. And the total slippage guidance we have given for the full year is 11,500 crore around. And we have been able to maintain on an average basis, if you look at Q1, around 2,300 crores. So that's quite possible that we'll be able to contain these slippages within the guidance level of 11,500 crores.
Okay.
We do not see any kind of signs of stress in the retail segment particularly.
Got it. That's good to hear. Your OPEX fell. Scope to fall further? I mean,
see,
fell quarter on
OPEX,
quarter.
we have always been guiding that the growth rate of OPEX will be in the range of 8 to 10%. This quarter, it has shown 10% YOI. So going forward, one can factor in 8 to 10% growth rate. And therefore,
Okay, got that. Just wanted to know about your non-NPA provisioning. That is high. Is there a chance that that can taper off?
Yeah, that will taper off. There was some one-off provisioning that we have made during the current quarter, but going forward, that should taper off and it should normalize.
Okay, just one word on margins. What do you expect it to be better, or do you think deposit cost is really hitting you? Anyway, first that number also. How much may your cost of funds go up in the current quarter, and therefore margins?
So if you look at 12-month basis, cost of funds have almost gone by 40 basis points. So a lot of repricing has already happened. But over the next 2-3 quarters, some maybe 15-20 basis point inch up in cost of funds might happen, given the deposit repricing that we are seeing in the market. But given all these, we have given a guidance of NIM for the full year in the range of 2.8 to 3%. We are making our best efforts to ensure that we contain and we maintain our NIM in the upper range of this guidance, close to 3%. This quarter, we have been able to achieve that, and our endeavor would be to maintain it above 3%.
All the very best for that. Thank you very much, Mr. Ranjan, for joining us, and hope you have a great FY25. Okay, so that's the word from Union Bank, and the stock, as you can see, up 1.5%. Well-received numbers, especially the ROA of 1%. We have to take a break on that note, but now we have a lot more results to analyze. HDFC Bank, Kotak Bank, and a whole host of mid-cap banks, RBL, Yes Bank. So many have come recently. Shantanu Chakrabarti, India analyst of BFSI at BNP Paribas, joins in a minute after this break.
Gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Testing.
Welcome back. Let's put the spotlight on the banking space since we have had a bunch of very iconic banks announcing their numbers. Like I told you, HDFC Bank, Kotak Bank among them over the weekend. To decode the numbers, we have with us Shantanu Chakrabarti, the India analyst, BFSI, Banking Finance Companies at BNP Paribas. Shantanu, good morning. Always a pleasure having you with us and thank you for your time. Let me start with the big boy, HDFC Bank.
Thank you.
The stock itself is a bit in the green, but there are at least 10 reasons to be disappointed whether, whatever you pick other than margins. What's your first take? Just the margin increase, does it condone the miss on several other parameters?
So, I mean, Lata, the most of the bad news actually came in the pre-quarters, and incremental news on the quarterly release is what has positively surprised the markets. Now, this forms a nice counterpoint to the structure that we had last time, where the initial deposit mobilization and loan growth looked quite favorable to people, and then when the profitability numbers came in, they were disappointing. Now, look, I mean, the moment you looked at the fact that they had shed more than 5% of their corporate loan book in just one quarter, the fact that it would be constructive on margins was not, that much of a stretch. In fact, therefore, we had expected numbers. Numbers are actually 1.5% below what we had expected, but higher than what the street had expected. It's not surprising for us. As far as the highlights go, two things stand out for me. One, which the company itself acknowledged in its quarterly call, which is that in the last 2 years, despite fairly tough circumstances, as far as incremental market share goes in the deposit space, it would have been hard to fault HDFC. It was not HDFC's fault that, that their proportions on CASA, etc., could not be shifted too fast, because the system level numbers were fairly anemic. This is the first quarter where we can say, at least at an aggregate deposit level, the market share performance has not lived up to the standards set in the last 2 years. The other point which struck me a little bit, and I get it that this is the seasonally weakest quarter and there would have been some disruption because of elections, but CRB numbers being as low as they were, which was my key disappointment from the pre-quarterly release as well, is a little off-putting, especially given their relevance to both margin defense as well as PSL compliance.
Sorry, your abbreviations are beyond me. What did you say? CRP?
So, CRB, Commercial and Rural Banking.
Okay. You're disappointed with the growth in commercial and rural banking.
Rural banking, that was only 0.8% sequential.
Okay. So do you think that the fact that they have to make up for some of their priority sector shortfalls in individual categories, though overall they meet, of course, do you see that being impinging on their margins? Is that a long-term worry for you, or at least a medium term?
I don't want to extrapolate just one quarter's performance, but what I would reiterate is this segment is crucial in two ways, just as you have mentioned. One is the simple priority sector compliance. The other is it's a fairly high yield sector, relatively high entry barrier vis-a-vis a lot of other prime categories. And they have made so much of investments into, setting down new branches. So, from that perspective, the performance of this segment is something we have to watch very closely, because a lot of the bull thesis depends on this.
Okay. Very quickly, what's your price target and call on the stock?
Yeah, so it's our topic within the banking space. Our price target is 2470. At least until I looked about a couple of weeks back, it was the highest on the street. And
okay, obviously
है इस पवित्र दिवस पर एक महत्वपूर्ण सत्र का प्रारंभ हो रहा है और सावन के इस पहले सोमवार को मैं देशवासियों को बहुत बहुत शुभकामनाएं देता हूं। आज संसद का मानसून सत्र का भी आरंभ हो रहा है। देश बहुत बारीकी से देख रहा है कि संसद का यह सत्र सकारात्मक हो, सृजनात्मक हो और देशवासियों के सपनों को सिद्ध करने के लिए एक मजबूत नींव रखने वाला हो। साथियों, भारत के लोकतंत्र की जो गौरव यात्रा है उसमें ये एक महत्वपूर्ण पड़ाव के रूप में मैं देख रहा हूं। व्यक्तिगत रूप से मुझे भी, हमारे सभी साथियों को भी ये अत्यंत गर्व का विषय है कि करीब 60 साल के बाद कोई सरकार तीसरी बार वापस आए और तीसरी पारी का पहला बजट रखने का सौभाग्य प्राप्त हो। ये भारत के लोकतंत्र की गौरव यात्रा की अत्यंत गरिमापूर्ण घटना के रूप में देश इसे देख रहा है। ये बजट सत्र है, मैं देशवासियों को जो गारंटी देता रहा हूं, क्रमशः रूप से उन गारंटियों को जमीन पर उतारना, इस लक्ष्य को लेकर के हम आगे बढ़ रहे हैं। ये बजट अमृतकाल का एक महत्वपूर्ण बजट है। हमें 5 साल का जो अवसर मिला है, आज का बजट हमारे उन 5 साल के कार्य की दिशा भी तय करेगा और ये बजट 2047 जब आजादी के 100 साल होंगे तब विकसित भारत का जो हमारा सपना है, उस सपने को पूरा करने की मजबूत नींव वाला बजट लेकर के हम कल देश के सामने आएंगे। हर देशवासी के लिए एक गर्व की बात है कि भारत बड़ी इकोनॉमी वाले देशों में सबसे तेज गति से आगे बढ़ने वाला देश है। गत 3 वर्षों में लगातार 8% ग्रोथ के साथ, 8% ग्रोथ के साथ हम आगे बढ़ रहे हैं, हम ग्रो कर रहे हैं। आज भारत में पॉजिटिव आउटलुक, इन्वेस्टमेंट और परफॉर्मेंस एक प्रकार से अपॉर्चुनिटीज की पीक पर है। ये अपने आप में भारत की विकास यात्रा का एक अहम पड़ाव है। साथियों, मैं देश के सभी सांसदों से, किसी भी दल के क्यों न हो, मैं आज आग्रहपूर्वक कहना चाहता हूं कि हम गत जनवरी से लेकर के हम लोगों के पास जितना सामर्थ्य था, उस सामर्थ्य को लेकर के जितनी लड़ाई लड़नी थी लड़ ली। जनता को जो बात बतानी थी बता दी। किसी ने राह दिखाने का प्रयास किया, किसी ने गुमराह करने का प्रयास किया, लेकिन अब वो दौर समाप्त हुआ। देशवासियों ने अपना निर्णय दे दिया। अब चुने हुए सभी सांसदों का कर्तव्य है, सभी राजनीतिक दलों की विशेष जिम्मेवारी है कि हमने दल के लिए जितनी लड़ाई लड़नी थी लड़ ली। अब आने वाले 5 वर्ष के लिए हमें देश के लिए लड़ना है, देश के लिए जूझना है, एक और नेक बनकर के जूझना है। मैं सभी राजनीतिक दलों से भी कहूंगा कि आइए हम आने वाले 4 साढ़े 4 साल दल से ऊपर उठ करके सिर्फ और सिर्फ देश को समर्पित होकर के संसद के इस गरिमापूर्ण मंच का हम उपयोग करें। जनवरी 29 जब चुनाव का वर्ष होगा, आप उसके बाद जाइए मैदान में, सदन का भी उपयोग करना है कर लीजिए। वो 6 महीने जो खेल खेलने खेल लीजिए, लेकिन तब तक सिर्फ और सिर्फ देश के गरीब, देश के किसान, देश के युवा, देश की महिलाएं, उनके सामर्थ्य के लिए, उनको एम्पावर करने के लिए जन भागीदारी का एक जन आंदोलन खड़ा कर करके 2047 के सपने को पूरा करने के लिए हम पूरी ताकत लगाए। मुझे आज बहुत दुख के साथ कहना है कि 2014 के बाद कोई सांसद 5 साल के लिए आए, कुछ सांसदों को 10 साल के लिए मौका मिला, लेकिन बहुत से सांसद ऐसे थे जिनको अपने क्षेत्र की बात करने का अवसर नहीं मिला, अपने विचारों से संसद को समृद्ध करने का अवसर नहीं मिला, क्योंकि कुछ दलों की नकारात्मक राजनीति ने देश के संसद के महत्वपूर्ण समय को एक प्रकार से अपनी राजनीतिक विफलताओं को ढांकने के लिए दुरुपयोग किया। मैं सभी दलों से आग्रहपूर्वक कहता हूं कि कम से कम जो पहली बार सदन में आए हैं, ऐसे बहुत बड़ी संख्या में हमारे माननीय सांसद हैं और सभी दल में हैं, उनको अवसर दीजिए, चर्चा में उनके विचारों को प्रकट करने का मौका दीजिए, ज्यादा से ज्यादा लोगों को आगे आने का अवसर दीजिए। और आपने देखा होगा कि पार्लियामेंट के नए संसद गठन होने के बाद जो पहला सत्र था, 140 करोड़ देशवासियों ने बहुमत के साथ जिस सरकार को सेवा करने का हुक्म किया है देशवासियों ने, उसकी आवाज को कुचलने का अलोकतांत्रिक प्रयास हुआ। 2.5 घंटे तक देश के प्रधानमंत्री का गला घोंटने का उनकी आवाज को रोकने का, उनकी आवाज को दबाने का लोकतांत्रिक परंपराओं में कोई स्थान नहीं हो सकता है और इसका कोई पश्चाताप तक नहीं है, दिल में दर्द तक नहीं है। मैं आज आग्रहपूर्वक कहना चाहता हूं, देशवासियों ने हमें यहां देश के लिए भेजा है, दल के लिए नहीं भेजा है। ये सदन दल के लिए नहीं, ये सदन देश के लिए है। ये सदन सांसदों तक की सीमा तक नहीं है, 140 करोड़ देशवासियों की एक विराट सीमा करके ये लिए है। मैं विश्वास करता हूं कि हमारे सभी माननीय सांसद पूरी तैयारी के साथ चर्चा को समृद्ध करेंगे। कितने ही विरुद्ध विचार होंगे, विरुद्ध विचार बुरे नहीं होते हैं, नकारात्मक विचार बुरे होते हैं। जहां सोचने की सीमाएं समाप्त हो जाती है, देश को नकारात्मकता की जरूरत नहीं है। देश को एक विचारधारा, प्रगति की विचारधारा, विकास की विचारधारा, देश को नई ऊंचाइयों पर ले जाने वाली विचारधारा से हमें आगे बढ़ाना होगा। मैं पूरा ही आशा करता हूं कि हम लोकतंत्र के इस मंदिर का भारत के सामान्य मानवीय की आशा आकांक्षाओं को पूर्ण करने के लिए सकारात्मक रूप से उपयोग करेंगे। बहुत बहुत धन्यवाद साथियों।
Okay, that was an unusually long Parliament introduction speech. And at the start, when he spoke about the 5 years laying the foundation for a developed Viksit Bharat, the Nifty and more importantly, the mid-cap index did see a slightly higher level. But if you pull up the mid-caps, it lost some of it, I think, as it became a slightly political speech. But there you are. There is chance that the budget will announce something which is valid and giving us a 5-year roadmap. On that hope, wrap up on Bazaar Chart Busters coming up.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector, the CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key, those are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to be is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether, whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could. I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is...
You're watching us here on Chartbusters, and as we speak, all the frontline indices back in the green. The market opened in the red. Thereafter, there's been a stellar recovery. The mid-cap index, most notable of them, has risen to the high point of trade with a gain of almost 600 points right now. Way more stocks advancing than the number of stocks which are declining. I'm Manglam Malu. With me, as always, Nigel.
Well, hi, Manglam. And we pointed out on the Nifty Bank that the 51,800 mark becomes crucial, and it bounced off that 51,850 odd mark. But plenty of companies came out with their set of numbers. So let's get straight to one of them. Rossari Biotech reported a record-breaking number in the first quarter, with the company delivering its best ever revenue, profit, as well as EBITDA. To decode those numbers as well as the way ahead, we're joined by Mr. Sunil Chari, the co-founder and the managing director of the company. Hi, Mr. Chari. Good morning. Always good to have you on the show. Well, last year you grew by close to around 10%. This year the start has been quite good, and you're optimistic on the growth prospects. What can you guide us for in terms of a growth outlook for FY25, and also give us some color on exports? There have been some challenges with regard to the Red Sea, talks of slowdown globally as well. I think that's 25% of your mix. What was the growth in the past quarter, and are you seeing any kind of headwinds?
So we did about 24% of our sales in exports. We had some issues with the prices of the freights and the delays in our consignments reaching our customers. But we have taken that into stride, and I think we are confident of doing 25% of our sales as exports for the current financial year. The domestic market also is picking up. And in fact, our volumes in domestic market in the last quarter were higher than in the fourth quarter of the previous financial year. So we are happy that, on both the fronts, the domestic and the export front, our volumes are growing. The HPPC, which is our driver, it is now nearly 3/4 of our sales, which is at 75% of our sales. And the last 5 quarters, we are consistently growing, both in terms of top line and in terms of EBITDA as well. At 35 crores, we had the highest ever PAT in the history of Rossari Biotech Limited.
So, Mr. Chari, you're saying that exports will constitute around 25% of the mix. The consolidated growth will be what for the year?
At this moment, times are very uncertain, so I'm not able to, give you a number on what we will grow. But I think we should grow at a good speed this year.
Good speed. Would the first quarter numbers sustain into the next couple of quarters, or would it be, around these levels itself?
Yeah, I think we should be around this levels or higher. There is no possibility seen to go lower than these numbers.
All right, so at least 19%, and at higher levels you can see growth anywhere between 20 to 25% as well. And this at the same time you have a lot of capacity coming up in phases as well. I see the expansion on the Dahej facility. There is the commissioning for your ethoxylation capacity, etc. as well. So on what phases do these capacities come on board, and what does that do to your incremental revenue at peak? What is the potential here?
So the expansion will be completed by March of 2025. So the next year we should see the increase in our production and increase in sales due to the new expansion which is coming up. This depends on we getting ethylene oxide from plants, and we are expecting a good growth in next year because we put up good capacities for ethoxylation and surfactant manufacturing. Even at Rossari Biotech Limited, Dahej site, we have put up backward integration into some of our key raw materials for Unitop, and that should also show us in numbers in the next year.
So, if you could simplify this for us, what is the increase in your gross block going to be because of these phased capacity expansions, and as a result of which, what could the incremental revenue be? What are typically the asset turns in these plants that are coming up?
So as on 31st March 2024, our gross block was 415 crores. we think by March 2025, on a consolidated level, our gross block should increase by about 100 crores. And at a peak, we expect every rupee of money we invest in capex to give us 4x minimum in terms of sales.
So 400 crore in terms of incremental sales, that is likely to play out over FY 26-27. That's correct?
Yes.
Okay, all right. What about animal health? You know, there appears there is still some pressure. Revenues were down by 7% as well as 21%. What is leading to this? And when do we see growth come back to this segment? Which quarter?
So we are putting up a vitamin and a trace mineral premix plant at the Rosari Dahej site, I think, which should be also on an operational by end of this financial year, means March 2025. So the next year we should see uptick. There was overproduction in the poultry segment where we are present mostly, and we are very conscious, of not losing any money, debtors days. We never had any bad debt in the history of Rosari in the last 27 years. So we've been very conservative. We have maintained the same amount of volumes. Our profits are higher in AHN than in the past in the quarterly figures. So we feel that this segment has the highest growth potential in the years to come because the base sales are much less compared to other segments.
Right. Just finally, before we let you go, your institutional cleaning business, you had said earlier that this is a cash-consuming business in terms of both costs as well as working capital. And until it reaches a certain size and capacity, there will be a bit of a push in this business. So if you could tell us, one, how much does this contribute to your business right now? And at what level does it, become a lot better for you in terms of operations, etc.? What's the plan over the next 2 to 3 years here?
So the last year, the institutional chemicals business we call Rosari Professional now, which it was called Buzil Rosari earlier. And this we did about 150 crores. And this year, we are expecting that to become 250 crores. So it will be nearly a 60% growth over last year. This requires a lot of investment in terms of people to service, to audit, to maintain and train the workforces. We primarily deal in products which are for the cleaning, hygiene and disinfection segment. And this goes into airports, malls, hospitals, offices. And there is a lot of unskilled, staff and workers and with the facility management companies who are our primary customers. And we need to train and maintain. For example, if we go to a 5-star hotel, we need to check the microbiological load on the dishes we wash or, the linen we wash and help them wash at their sites. And because of this, the competition is not very big, but the competitor who is there with us in this segment is a leader for the last 40 years. And we are breaking new grounds everywhere, primarily because we are continuously investing in putting up people everywhere so that we are able to service it better always.
All right. Thanks a lot, Mr. Chari, for joining in. 250 crores from that business this year. But of course, you are investing out here. So maybe we'll see growth out there going forward as well. And maybe, your return ratios would improve once these assets sweat. While you were speaking, at the bottom of your screen, there were some flashes coming in on Garden Reach Shipbuilders. They've signed an MOU, and as a result of which the stock's seen a bit of a spike. It was anyway higher since morning and now has moved to the high point of trade. But we slip into a short break, and as we do that, let's tell you that we'll get you the best of market and micro voices ahead of the union budget. Tune into CNBC TV18 at 9:05 a.m. onwards on budget day tomorrow. We'll be live from the National Stock Exchange with Morgan Stanley's Rhythm Desai. There's Nilesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSC MD and CEO Ashish Kumar Chauhan. So a star panel right from where the action begins, the National Stock Exchange budget opening bell, only on CNBC TV18.
Is energy, and these energy stocks pay good return dividends. That they're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own.
Right.
So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EM.
Well, let's take note of Patanjali Foods. The company reported its numbers. There was a turnaround in the oil business, the edible oil business as well. The stock opened mildly lower. From there, it has seen a good recovery now at the high point of trade. And we have the management with us sitting with a gain of about 1%. Sanjeev Asthana, who's the CEO of the company, joins in to discuss the numbers in detail. Thanks a lot, Mr. Asthana, for joining in. You know, the turnaround business, of course, was the edible oil business. So just a couple of details is what we want for this business for this year. What is the volume growth that you're targeting here? And as a result of which, margin target as well? And more importantly, how have the prices been in the first half of this year? How do you expect that to be in the second half? So price, volume and margin.
So overall volume, typically this is a low quarter sort of month that we have. So volumes actually have marginally declined. But this, our estimation is that the volume growth that we target typically between 6 to 8%, we are pretty much on course for that during the year. So the next quarter, the festive season picks up, the wedding season starts to pick up. So we will build up on that volume part. The price-wise, overall, the benefit that we clearly saw that the prices were very stable during the quarter, which has helped us sort of make reasonable margins in the edible oil business, which are more prone to volatility. And my estimation is that our guidance for between 2 and 4% margin in the edible oil business, we should be able to pretty much sort of stay within that range. And we will certainly try and do better than that. So, for example, this quarter we've done better than 4%. But overall, if we can stay at 4 and better, it'll be very good sort of way of running around the business and growing that.
Okay, lovely, great. So we have got color on that. Tell us a little bit about the FMCG business. You know, you had the expenditure because of the ads to IPL. So could you quantify what is the total amount? And X of that spent, which I am assuming is one-off in nature, what can margins look like?
So the margins, during the quarter, I mean, they've had a slight sort of tapering off, that we saw in the margin. Primarily, this was on account of very exceptional two events which happened. One was the excessive heat that we had, especially on the Indian specialty food segments like, Chawanprash and ghee and honey, etc., that we expect will stabilize. And the second one was the inventory overhang of the previous quarter when we had a pretty exceptional sort of business that came in, which drove the prices, which allowed the inventory to build up, and there was not a sort of too much of evacuation. So this, we believe, is going to go forward, will stabilize, and guidance pretty much that 11 to 12% on a blended basis for the overall FMCG segment, which is comprising of biscuits, the Indian ethnic foods, consumer staples, nutraceuticals, and Nutrela, the soya products. I think will be pretty much there.
11 to 12%. I remember you had earlier said that the food business steady state margin would be around 15 to 16%. And one would assume that with the home and personal care business coming in, the non-oil margins could be a lot higher. Why just 11 to 12%?
Oh, no. So I think I'm just, it's on a blended basis. So there are margins across the board. For example, our Nutella margins are 16 to 18%. Nutraceutical margins are 25%. Our biscuits margins are about 12%, which are consistently showing remarkable growth. Our margins on the Indian sort of specialty, foods like Chyawanprash and ghee, etc., are, between 16 and 18%. The consumer staples category typically is around 4 to 5% margin businesses. And that tends to pull it down a little. But overall, with the expansion of the higher margin businesses, we should get pretty much in that category of 16 to 18%, which is what we've always projected. So if you carve out and take this out, typically, business run rate of about, on the consumer staples, then margin is pretty much in the 16, 18% profile. On a blended basis, I was saying that 12% is what we can, aim for on the overall FMCG portfolio. And with the HPC portfolio coming in, this should tend to get closer to 16% on an overall basis.
Final question, Mr. Asthana, before we let you go. Food business is around 30% of the mix. By when does it get to 50%? And by when do you complete the acquisition of this HPC business?
So the answer to that is that our stated strategic intent, which we declared last year itself, that we want to get it closer to 50% in 4 years' time. So I'm reasonably hopeful that between 3 and 4 years, the FMCG and the edible oil portfolio should be 50-50. And to the second question, our application for the shareholders' approval is already there, which we're anticipating that in 3 weeks' time, we should have it with us. The application for the regulatory approvals have already moved, and we are hoping between 4 and 6 weeks' time, we should have the business pretty much in our fold.
Just before we wrap this up, if you could give us a sense of what could be the contribution from this business in FY25?
So FY25 on this, if we get it for the 2 full quarters, for example, I'm estimating that, it depends on how the sort of approval comes in, but we should be able to add a top line of anywhere between 1,200 to 1,300 crores and a margin base of about 18% within this fiscal itself.
All right. Thank you so much for stopping by and giving us all those details. 12 to 1,300 crores with 18% sort of margins coming in from the acquired businesses this year. Steady state margins for the consumer business between 11 to 12%, including consumer staples, and around 2 to 4% margins for the edible oil business, with 4% as the base, at least for the next couple of quarters. That's about Patanjali Foods, and we're out of time on this edition of Chartbusters on that note as well. And as we wrap up, let's tell you a quick programming note. At 11:40 a.m. today is a special discussion that we've lined up for you, where we will have gentlemen like Rajesh Baheti, Deepak Shenoy and Jimit Modi joining in on the regulatory red flags that have come by on the sharp surge in F&O volume. The clamour to increase the clampdown on F&O trading has increased. So let's talk about this at 11:40 a.m. on CNBC TV18.
Yes. So this is an example of another emerging sector.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discount
discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and the countdown is on. 1 hour to go for the economic survey. 25 hours before Finance Minister Nirmala Sitharaman presents her 7th budget, and that's going to be a record for any finance minister. 7 successive budget, and look at the markets. We had the big morning dip, and the Nifty has recovered more than 200 points. So the investor appetite is truly strong. The mid-cap index is up more than 1%. Very strong advanced decline ratio. And pull up the contribution plate, Surbhi. HDFC Bank and Reliance Industries are pretty much, offsetting each other, evening themselves out. So that contribution plate will bring that up. PSUs are seeing a lot of buying. So the Nifty CPSE index is again about 1.6%. Fertilizer stocks as a pocket has come in for buying. So whether it's NFL, RCF, Madras FUD, and PSU banks too. So in that CPSE bucket, particularly PSU banks too are shining.
Absolutely. I think, yes, last week we had consolidation and that Friday was a big slam dunk. But I think we're going into this event with hope, and that's what the screen is telling us, because the dips are getting bought all over again. And fingers crossed from the market perspective that there's going to be no major tinkering with the capital gains tax, and more announcements, more outlays for, of course, all the capex intensive, infrastructure intensive sectors, because that's what's really playing out. And the mid-cap bounce back is very interesting to note as well. The index is up a whole 1%. You're looking at a very, very, good-looking screen in terms of the advanced decline ratio. The breadth is very positive. Over 1,600 stocks advancing at this point in time. And who are the winners? Well, Reema mentioned PSU banks, but even other PSUs. That whole part of the market is thriving once again. Look at Mazgaon Dock, 5.5% higher. You've got stocks like Shipping Corporation of India up about 6%. Some of the fertilizer names are very, very excited on perhaps, some sort of policy hopes coming through. So your FACT and RCF, a lot of these names are up and about national fertilizers. So this is the side of the market which is quite excited, which is obviously on the PSU side. But even non-PSU and Indian hotels, the numbers are being very well received. It wasn't a breakaway quarter. Steady growth coming in, but the market's choosing to be optimistic. About 5% up on that stock. You have some of the other names as well that are standing tall. In terms of good result reactions on the mid-cap screens, also look out for Oberoi Realty, blockbuster numbers. So, we'll talk more about this, but the short point is that the market is looking fairly resilient at this point in time. We will start with earnings reactions because it was a very heavy weekend after markets closed out on Friday. We had so many big numbers coming in. So we'll talk about all of the big Nifty heavyweights, starting with the troubled child, the problem child, which is Wipro. The stock is still reeling under pressure. Last I checked, it was still down about 7%. Yeah, Wipro is still looking at a cut of over 8% at this point in time. So, Rima, I guess it had set itself up for very high expectations given TCS and Infosys, right? So what all went wrong, do you think?
Well, there are two reasons. One, as you said, the expectations were high. The stock run-up was too much. So at the beginning of June, the stock price was 440. And last week, it went to levels in excess of 570. So it was a 30% rise in a span of 45 days. So that's one. And the second is the earnings were a miss. Q1 was a miss and the Q2 guidance. So on the top line, the company's revenue growth has fallen for the 6th straight quarter. And even the Q2 guidance is not very inspiring. They're guiding for -1 to +1%. So brokerages are saying that Kotak, I'm specifically talking about Kotak, they're saying at 21 times forward multiple, the stock is expensive, no margin of safety. UBS says the softer than expected Q2 guidance suggests that it's getting difficult for the company to convert its large deals into revenues. There is a delayed conversion of large deals, which means the drag on growth will continue, resulting in Wipro lagging its peers. But on the other hand, there are many believers in the Wipro turnaround story. So Nomura has a buy rating. They retain the target price at 600. And the other one is CLSA. You remember CLSA with a double upgrade? Well, they continue to keep the faith, outperform rating 588 on Wipro there. But the reason is miss on the earnings, and plus the stock had run up too much, and some of that is being shaved off today. But let's talk about HDFC Bank now. That's a stock which is doing very well, 2.5% gain in terms of the stock price. Abhishek joins in with the details.
Well, to begin with, the surprise on net interest margin expanding on a sequential basis is perhaps what has worked out, for SDFC Bank in terms of investor reward. So P&L, take a look. The NI and PAT is a beat on our poll. NI is a beat of 0.9% and the PAT is a beat of more than 3%. Net interest margin improved on a sequential basis by 3 basis points. Largely, analysts were expecting a flat net interest margin. Now, other income declined by 41.3% sequentially. Treasury gains were about 7,600 crore in the previous quarter. So that's a one-off that has come in this time around. Operating profits declined by 18.4%. However, if you remove the treasury gains, operating profit grew by 9% on a sequential basis. Provisions were down 80.7% sequentially. PAT declined by nearly 2% on a sequential basis. Asset quality has seen marginal deterioration given the fact that agri portfolio is a seasonal in nature. It deteriorates in Q1 when compared to the Q4 numbers. So gross NPA has increased by 6% on a sequential basis. Net NPA has increased by 17.5% on a sequential basis, suggesting that the provision coverage ratio has declined to 71.2% when compared to 74% in the previous quarter. However, as a ratio, gross NPA ratio and net NPA ratio remain under control for the bank. Back to you.
Okay, Abhishek, got that. So that's HDFC Bank. Basically, growth is not happening, but at least margins have surprised on the upside. And that seems to be working for the stock. For Kotak Mahindra Bank, in fact, it seems to be the reverse, Abhishek. Isn't that true? A bit of a margin question over here?
Well, the Kotak Mahindra Bank's results did throw up that the net interest margin is at 8-quarter low. This, despite the fact that the credit deposit ratio has actually improved on a sequential basis, and operationally, it looks like a weak quarter that Kotak Bank has had. So, if you take a look, net interest margin has come in at 5.02%, which is at an 8-quarter low. This is a decline of about 25-26 basis point on a sequential basis and about 55 basis point on a YOY basis. Now, deposits are up only 15.8% YOY and they are down 0.3% sequentially. So deposit momentum on a YOY is the lowest that you are seeing in last 6 quarters, and deposits have shrunk on a sequential basis for the first time in 16 quarters. On the good side, the advances growth at 18.7% YOY is perhaps one of the best that you are seeing in last 6 quarters. Sequentially, the advances growth was 3.7%. Operating profit grew by only 6.15% YOY and they have declined by 3.8% 8% quarter-on-quarter. This is the weakest growth in 8 quarters with respect to YOY growth rate of just 6%. Operating profits, if you remove the treasury part, it has grown by 11.5% YOY, but it has declined by 7.9% sequentially. So provisions are up nearly 59% YOY and about 120% on a sequential basis. This is the worrying factor. They have had an exceptional item this time around. They have sold stake in their general insurance arm, which has got them around 3,520 crores. So that is why the PAT is up 81% YOY and about 51.2% sequentially. So in terms of PNL versus ARPOL, the NI is a miss. The NI is below ARPOL. However, due to this exceptional gain, the PAT is ahead of ARPOL. Take a look at the asset quality. Gross NPA in value-wise has increased to by 3.8%, while net NPA has increased more than 8% sequentially. However, as a ratio, gross NPA ratio and net NPA ratio have remained stable on a sequential basis. Back to you.
Okay, got that, Abhishek. Thanks very much. Yeah, I think the commentary from the Kotak management was also noted by the market, because in the conference call they spoke about some pressures on the credit card side. Reason why they're going quite watchful on that side of the book at this point in time. Unsecured lending continues to be a major area of focus for the RBI and, of course, for banks as well. Thank you, Abhishek, for a detailed analysis on both Kotak as well as HDFC Bank. Now, let's come to the big boy, Reliance Industries. We have Sonia with us to round up exactly how the first quarter played out. Sonia.
Well, thanks a lot for that. So, Reliance's numbers were a mixed bag this time around. While the oil to chemicals business was on the weaker side because of macro concerns, there was a stable set of numbers coming in for the Jio as well as the retail business. So if you look at the core numbers, right, the numbers were largely, you'd have to say, in line with estimates. 11.5% growth is what we saw for the top line at 2.32 lakh crores. The EBITDA went up 1%. The margins were under pressure, and that's where the disappointment has come through. Margins coming in at 16.7% versus 18.4%, while the profits were down about 5.5%. But let me tell you what brokerages have made of the numbers. It's a mixed bag from brokerages as well. Nomura said that it is an in-line quarter. They reiterate a buy with a higher target price of 3,600 rupees. Now, Nomura points out that Reliance is their top pick in the sector. But on the flip side, you have brokerages like Jefferies that believe that it was the revenues that were missed estimates this time around. The subscriber addition for Reliance Jio was weak. They say that Macquarie says that Q1 was a material miss because of lower than forecasted Jio as well as the oil to chemicals business. Macquarie also continues to see a downside risk to consensus estimates. They maintain a neutral with a 12-month target price of 2,750. Back to you.
Thank you very much for that. Those were the big stocks of the day in terms of earnings reaction. Get into a break. But as we do that, we strive to get you the best of the market and macro voices ahead of the union budget. So tune in to CNBC TV18, 9:05 a.m. onwards on Budget Day tomorrow. We will be live from the National Stock Exchange with Morgan Stanley's Rhythm Desai, Dinesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and the NSE MD and CEO Ashish Kumar Chauhan.
Entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back. ITC is a bit nervous in today's trade, so that's down 1.5% ahead of the budget tomorrow. Though Macquarie has actually come out with a positive note where they've initiated coverage with an outperform rating. They've put the target price at 535. They believe the cigarette business has headroom to grow. But there is some anxiety, nervousness ahead of the big event for ITC tomorrow in terms of cigarette taxation. But let's get to the commodity space now. Manisha is now joining in and she's focusing in on sugar prices. Hi, Manisha.
Hi, Rima. Thank you for that. Well, yes, if you look at the international markets, we are now in the negative for this current month as far as the sugar prices go. The global sugar is also trading at a 5-week close right now, and we've seen that decline come in for the Indian markets as well. This is happening because the global sugar stocks for the year 2024-25 are expected to be in the surplus after a deficit that we saw in the previous session there. If you look at the Indian markets itself, well, we are looking at a higher sugar reserve at around 9.1 million tons, and out of this, 3.6 million tons is seen as a surplus as well. So not just India, you are looking at a higher crop in Thailand, in the European Union as well. And as far as Brazil goes, which is the largest producer of sugar, the numbers do look quite encouraging and of course bearish for prices in that sense. So there is a report from Unicab which says that the Brazil sugar output for the month of June actually gained up by nearly 15%. And Conab, which is the agency which comes out with agriculture produce in Brazil, says that the Brazil as a country is looking at a record output up by nearly 12% as compared to the previous year, to a record 46 million tons this time around. So for this year now, there are a couple of agencies which have put out numbers. One is Zarnikau, which says that they are looking at a surplus of almost 8 million tons here. And the way the USDA has done their calculation in sense of production and consumption numbers, you can see that the production is much higher than consumption. So it's almost around 8 to 9 million tons of surplus that USDA also seems to be looking at. The other agencies also are looking at higher production and higher consumption going forward. And this is something that could keep the sugar prices globally under pressure. We also have seen a lot of speculative activity actually wrap on its long positions. The open interest has been declining as well. So some more pressure could be coming in for this commodity.
Okay, thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Soni Patnaik of JM Financial Services will join in with her top trading bets.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these?
Welcome back. Some stocks you should keep on your radar. Oil marketing companies, so BPCL is higher, 3.7% in the frontline pack, but even HPCL has a gain of close to about 3.5%. Indian Hotels, Oberoi Realty and Fertilizer as a pack we've highlighted. But now even Chambal Fertilizer has a gain of more than about 5%. So that's a pocket of strength. And in terms of banks, you've got Federal Bank You've got a Union Bank post numbers, RBL Bank up 1.5%. So banks too are higher. Dodla Dairy's numbers are up for you on your screen. It's a massive 86% jump in the profitability. The stock is up 10% right now. But as promised, let's invite Soni Patnaik from JM Financial on the show now. Soni, big day tomorrow. What's the setup looking like, and what would be the stocks that you would advise trade on?
Good morning, Reema and Surbhi. Thank you for having me on the show. I think Nifty has shown a good bounce back from lower support levels of 24,400, 350. That range is still acting as a very strong support. And on the higher side, 24,600, 650 may act as a resistance. So this is going to be much of a consolidation range, and either side break of these levels can determine a further trend. Any close below 24,400 on closing basis only can determine a correction in Nifty, which can take it towards 24,150 odd levels. So I think that's how the levels are playing out. It's a good short covering today, and on similar lines, even Bank Nifty, you can see 52,000 is acting as a very strong support on closing basis. So as long as it's holding and defending on closing basis, Bank Nifty may bounce back. But if it's able to close below the 52,000 level, you can see correction in Bank Nifty towards 51,500, 51,000. So I think these are the levels to watch out for. As of now, it's just wise to stay away from the indices and look for stock-specific strategies. And in stocks, we have two buy picks today. One would be from the pharma space, Dr. Reddy, which is showing a good 6% fresh longs today. So one can buy in July futures in Dr. Reddy, keeping a stop loss of 66.60 and a target of 68.50 can be seen in Dr. Reddy. The second buy pick is in PI Industries. So it's also showing a very strong fresh long built-up position of 21%. It's quite aggressive, and it's also given a good range breakout today. So PI Industries in July futures, one can buy keeping a stop loss of 38.60 and a target of 39.50 to 4,000 can be seen.
Okay, all right, got that, Soni. Thank you very much for that. So those are some trades that perhaps viewers can work with. By the way, look at Dodla Dairy go. I mean, that's a really, milk-powered performance coming in. Stocks anyway done really well this year. It's up almost 45-50% this year. And then this is a superb surge coming through. The operating performance is absolutely smashing. And that's why that stock is flying away 15% up at this point in time. Pull up a one-year chart on Dodla Dairy as well. And it's done, let's see, about 67-70% in the last 1 year. It's been quite a high flyer. There we go. All right. With that, let's move on and talk about the big story ahead. The budget session of Parliament begins today with Finance Minister Nirmala Sitharaman all set to present the Union Budget tomorrow. The Finance Ministry will also present the 2024 Economic Survey later today. Sapna is joining in with key expectations. Sapna.
Well, this will be the second economic survey of the Chief Economic Advisor, Dr. Anand Nageswaran. He's a straight batter, and of course, the big focus in the economic survey is going to be on India's growth story. We know what the numbers have been like for FY24. For instance, the CA in his previous economic survey had said that the economy may expand by around 6.5% in FY24 with an upside, but the economy has clocked 8.2%, so to say. Also, in the current financial year, the RBI has already raised India's growth forecast to 7.2%, while other important agencies like the IMF, ADB, Fitch, they are somewhere around 7%. World Bank is slightly lower, 6.7% average growth rate over the next 2 to 3 financial years. So it may just be possible, keeping all of this in mind, a 6.75 to 7% growth rate could be penciled in by the economic survey with a leaning towards an upside, or maybe even a 6.5 to 7%. Now, beyond FY25, the CA has already indicated earlier in his various statements that it's easy for India to grow at a healthy clip of around 6.5 to 7%. But beyond FY25, and in the long run, maybe he doesn't want an extremely high growth rate because that can be inflationary. Some of his statements indicate that, but just coming back to the current financial year, 6.75 to 7% with an upside, or 6.5 to 7%. This could be the likely number in the upcoming economic survey. Second, of course, the focus could also be in terms of job generation. Now, the government has been putting out a lot of data on this front. There's a lot of narrative in terms of how the employment story is changing in India over the last couple of years, even last couple of months, which are those sectors. But what else needs to be done? Investment in skilling is very important. The CA has been talking about this. So going forward, you will find a lot of mention in the survey. Last but not the least, in terms of the fiscal side of the story, well, the CA has also been indicating earlier in his earlier statements that the best kind of fiscal stimulus is basically when you maintain fiscal discipline, because that will help bring interest rates down. With inflation trending off, probably there could be some more commentary on this front. We'll have to wait and watch. Last but not the least, in terms of infrastructure development and manufacturing, there could be some mention in the upcoming surveys. So all of this is going to be very important, especially the fact that the survey always comes generally between, just a day before the union budget.
Okay, all right, Sapna, thank you so much for that. We're expecting the document to be tabled this afternoon in Parliament. There's also a press conference. CA will be holding a press conference at around 2:30. And of course, we will keep you up to speed with all the latest. For now, a quick break. We'll come back on the other side and discuss market fundamentals with Ashi Anand of IME Capital.
Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the Income Tax Department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment grade corporate sector, the CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment grade bonds do not mature until after 2029. So those, I think, are the two key, those are the key.
Welcome back. Let's talk markets then. Ashi Anand, CEO and founder at IME Capital, is now with us. It's a PMS company. He manages two funds. One of them is the Microtrends PMS, where he's got holdings in Shobha, Shriram Finance, Zomato, State Bank of India, Infi, Axis Bank. And the other one, which we've often discussed, is the Digital Disruption PMS, with holdings in names like Zomato, PB Fintech, Nykaa, InfoEdge, Paytm, etc. Ashi, thank you very much for joining in. Let's talk about the Microtrends portfolio, right? There's a big event coming up. Have you made any changes in your portfolio in the last 1 month? Because I was comparing your recent fact sheet with the prior one. It appears that you've increased your cash position, brought down your stake in stocks like Bharat Electronics. So what's the construct looking like?
Firstly, thank you so much for having me on the show, and you've been quite attentive, it seems, in terms of our fact sheets. Yes, we have been kind of repositioning a bit going into the budget. I think at the first level, what is it that we're looking for from the budget? What you have seen is over the last 3 to 4 years, you've consistently seen kind of the budget prioritize capex over kind of revenue expenditure. Now, given the election results and given the fact that consumption has been weak for many, many years, you are expecting some kind of a shift in terms of the current budget, right? And you are probably looking at some level of consumption expenditure increasing. So a combination of kind of sorry, if I can just rephrase. So you're looking at consumption expenditure kind of being increased, but you are also expecting the overall capex momentum to really continue. And I think the whole RBI special dividend, which would have come in this year, would actually help this combined continued focus on capex as well as strong consumption demand. Now, the reason we have repositioned the portfolio a bit going into the budget is last year you've seen very strong growth in overall capex spends, in real estate, in all forms of capital formation. Those parts of the markets have actually done very, very well. And we are expecting some kind of a balance this year in terms of sectors like consumer, IT, pharma, some of these really coming back, and possibly some moderation in the strong outperformance of these capex heavy themes, which is where you've kind of seen. So what we've done in terms of portfolio repositioning in the previous kind of month, what we had done is we had reduced some of our capex and moved towards consumption. Going into the budget, we have booked some profits from real estate and increased cash to really kind of position based on how the budget comes in.
Okay. So, Ashi, hi, good to have you on the show. Now, what is the thesis and the base case expectation on capex? I mean, capex is already, the thing is, stocks have already run so much. We may still get good announcements tomorrow, and that could create more of a sentiment boost. Look at the market today, right? It's still celebrating the same PSU stocks. But once the event is out, what do you think is your medium-term positioning going to be on this part of the market?
So I think our medium-term positioning continues to be very robust, right? What you are seeing in terms of capex is after a decade of very, very kind of muted capex spends, you are coming back to kind of an environment where there are multiple kind of drivers of capex, which are all kind of firing at the same time. Partly this is PLI incentives. You are seeing some kind of very interesting spends coming in terms of new energy. There is a larger shift in terms of a value migration happening away from China towards India. A lot of these kind of sub-trends which are playing out, all of these should lead to a very favorable medium to longer term outlook in terms of capex. The main call, however, is in terms of shorter term price momentum. I think a lot of this medium to long term story is already partly kind of priced in, and possibly a lot of the short term momentum in the space has been very, very high. So we're probably kind of expecting some kind of a possible time correction. So if you're just looking at it, possibly capital goods companies may not perform as well in the near term, but over the medium to longer term, we still see a lot of kind of value. Now, all of this is just purely focusing on kind of fundamentals. Market sentiment in the space and market momentum in the space continues to be very high. If stock prices continue to be driven more by a narrative than near-term valuations, the space could continue to perform.
You said you've raised your cash holdings. So once the budget is out of the way, will you look to deploy it, or do you see an imminent correction in the market and that's when you will look to utilize this money?
No, so I think the cash that we have created is driven more by being able to have some amount of liquidity available to position ourselves on the kind of budget day or immediately after the budget. It's not that we are seeing any imminent correction in the markets. I think the longer term outlook for Indian equities continues to be extremely robust. You are likely to kind of see rates starting to kind of decline towards the end of the year. There's no real reason we're seeing for sharp decline in the overall markets. In certain pockets like small caps, etc., there may be some level of froth. But I don't think so. This is not a structural cash holding. It is kind of tactical creation of cash to be able to position ourselves going into a key event.
Okay. And then one final word then on your digital disruption portfolio, since you track all the listed companies very carefully. Any interesting trends that you've observed in any of the stocks that you'd like to highlight for our viewers?
So I think more than specific stock, right? I think core parts of the thesis are really playing out very, very well. So just to kind of recap what the core thesis is, we believe they are very strong enablers for sustained high levels of revenue growth for these companies over the coming decade, not just over the short to medium term. This accompanied by a shift towards not just profitability, but high levels of profitability should lead to very strong value creation. I think you are seeing this play out very clearly across companies. Growth is sustaining at high levels. Profitability as compared to what people were looking at a year back, right? I think across the board, people are now beginning to realize and understand that these companies are turning profitable. What I think markets possibly yet are underestimating is how profitable they can become over the longer term. How attractive return ratios are going to be, how attractive cash flow generation is going to be. Now, a combination of both of these itself is enough for very attractive value creation. But the whole additional kind of trigger comes in when we're really looking at them entering adjacencies. So if you look at Zomato's entry into Blinkit and the kind of value creation that's happening there, we believe once a platform is built, these companies have the ability to enter adjacencies at a relatively low cost.
Right.
And if successful, this can create a lot of value. So I think we're seeing this very clearly across companies.
Indeed, that's played out very well for you. Thank you very much, Ashi, for joining in. We'll continue this discussion another day. For now, we need to slip into a very short break. But on the other side, we've got a special discussion lined up. Jimit Modi, Deepak Shenoy and Rajesh Baheti will join in to weigh in on the regulatory red flag on the sharp surge in F&O volumes.
Sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there.
Welcome back, and it's now time to discuss the big story. Market regulators in India, as well as the banking regulator actually, seem to be concerned about the rise in F&O volumes and the increased speculation that we've seen in the stock market since COVID. In fact, we'll put the numbers up for you. There's been a marked increase in options trading, both when it comes to index options as well as stock options, compared to FY21, which was the COVID year. So now the numbers have absolutely ballooned and gone through the roof. This is something that SEBI chief Madhvi Puri Butch actually picked up on. She was speaking at an industry event. It was a SBI mutual fund event, and she went on to say that it is perhaps time to consider if household savings are going into speculation instead of capital formation. She also said that the surge in volumes across futures and options is now a macro level issue. It's not just an issue about investor protection or investor safety at an individual level. Listen to this.
Micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity? What has changed over the 3 years, the facts that have changed, is it has gone from being a micro issue of an investor to a macro issue of the economy itself. Every time we introduce something new, it's because we say we recognize that there is a market demand for it. We need to give a good regulated environment to the investor to meet that demand. So it's clear to us the investor wants to take derivative positions. Why are we leaving him without an option to do it through a professional fund manager? So that was one of the factors that drove that consultation paper.
And the flight of capital from household savings to other financial instruments has got the RBI governor worried too. In fact, both the regulators spoke at different events on Friday and they both aired the same concerns. Now, speaking at a Financial Express event, RBI Governor Shaktikanta Das said slowing deposit growth can create structural liquidity issues. Listen in.
Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks.
All right, so those are both the regulators sounding off a lot of concern on what's going on in the F&O market. Now, we got reactions from a whole host of market participants, experts through the weekend on this, because this matter has stirred up a massive debate on social media. People are really asking the question that, is the increase in F&O volumes really such a big concern? Should regulators be so concerned as long as the markets are behaving in an orderly fashion? However, a lot of participants from the mutual fund world definitely are concerned, and those comments are on your screen. Nilesh of Kotak AMC says that the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. From a macro point, there are issue of savers becoming speculators rather than investors. And from a micro point of view, there is a need to create a level playing field between local and global participants in the F&O market. Basically, global participants which have access to big algorithms, high-frequency trading versus retail, which perhaps doesn't have access to that level of technology to trade in the F&O market. That's Nilesh's point of view. Look at Swaroop Mohanty of Mirai. He's saying the number of people who have started return chasing is scary. While the market capitalization and the number of available stocks and free float seems to have widened, what does not change is the liquidity status of the market. Everything is okay until inflows are higher than outflows. The day that changes, it can go in a very wrong direction. We'll keep playing more and more of these reactions that we've gotten some very interesting comments coming in and keep looking at that screen for more. We also, of course, have a live panel to take this issue forward. Jimit Modi, founder and CEO at Samco Securities, is with us. We'll also have some other guests joining in. I think we've got Rajesh Baheti as well. Rajesh, welcome to this conversation. And Deepak Shenoy of Capital Mind. Gentlemen, I don't know if you saw your Twitter feeds or social media feeds over the weekend, but I think the regulators really set a whole debate in motion. Let me come to you first, Jimit. I think the issue here is this is happening before the budget, remember. There's a lot of speculation about whether there's going to be a change in STT, whether tax should be used as a policy to keep retail away. Now, I don't know how you distinguish between retail paying STT and institutions paying STT, but your thoughts on the matter?
So, first of all, thank you so much for having me on the show, Surbi.
if I was to sort of look at the movement in options trading, and I think bulk of the challenge with the and the comments that the regulators have sort of referred to comes in the option segment. I think that is where the concern lies. And it's important to understand that this shift in the past 3-4 years that has happened, where options volume has increased, is not because of some random increase in speculative behavior. I think a lot of it has been the first order and second order effect of regulatory changes that have happened in the past. There was a new margining framework in 2020. There were peak margin regulations that were introduced in 2020-21. And those regulations resulted in an indirect move of people moving from the future segment to the option segment. That's point number one. The second thing is, do I believe that this is a macro issue? So, if you look at the data and the data where how many people actually participate in the options market on a monthly basis, that number is about 40 to 45 lakh on a monthly basis. So 40 to 45 lakh unique PANs participate trading in index options or stock options on a monthly basis. And this is based on NSE data. Now, is the participation of 40 to 45 lakh individuals out of a population of 140 crore people a macro issue? I think probably to some extent the fact that there has been excessive speculation, yes, but it's not that this is a issue that is impacting crores of households in the country. So this is a small segment of the market which is indulging in very, very high activity. And obviously the regulator is right to look at seeing which are the manner in which they can avoid this excessive speculation. But the fact remains that this is a small micro market of 40-50 lakh people engaging in this business activity every month.
Got it. Rajesh, come in on this. Do you think it's too early to call it a macro issue that Jimit was pointing out? And secondly, what could be the steps? Because collectively, increasingly, we are hearing all the regulators, whether it's the government, whether it's the RBI, SEBI, all of them appear to be cautioning, raising the red flag on this. So what might come out? And especially in the budget, should we expect anything?
So I think it's fair to accept that SEBI and the government is seeing a situation which they don't like. It's something that we need to recognize as an industry. But what's more important is that if you have a problem statement that says that it's the lowest rung of retail or the large retail participation that is bothering you, the steps you should take should be targeted at preventing that portion of the retail segment that you think shouldn't be trading in the F&O segment to prevent them from trading, rather than put some kind of curbs that will kind of dampen the overall market activity and take us back 5, 10 years, 15 years into the past and really damage the entire industry as well as the MIIs. To that, I would have said, and I've said that before, that the best way to target the retail or the lowest rung of retail is two ways. Either put some kind of course, market lot adjustment to 20 to 25 lakhs would be one of the key variables there that would prevent the smallest rung of retail from participating, because whether you're buying options or selling options, I think the cost of margins would go up. The other way to look at it is set a minimum capital adequacy criteria of 10 lakh rupees as margin, irrespective of whether you're buying options or selling options, that you've got to have a balance of 10 lakhs with the broker in order to trade the market, F&O market. You set a criteria like that, I think the lowest rung of retail will go out of the market. Look at the number of UCCs that are trading pre these changes versus post these changes. And if you think you've achieved your end in terms of the number of people accessing the market rather than market volumes, then I think you'll have achieved your end. I think looking at market volumes is not the right way, because we've had technological advances from which market volumes have gone up. More importantly, the important variable to look at is the number of UCCs trading the market.
Fair enough, and I think that's the point that Jimit also made, because the actual number of PAN holders, he said, as per NSE data, is about 40 to 45 lakhs. So is that really such a huge number to get worried about? It's a smaller set of people indulging in a lot of speculation. That's his point. But let me bring in Deepak as well. Deepak, now we'll get to the more in-depth, the broader picture, moral debate on the regulator's role in just a bit. But before that, for a moment, let's admit that this is a problem, because that's what a lot of industry participants are also saying. So how should one fix it? Rajesh is saying do it via change in lot sizes, not necessarily maybe tax. Do you concur?
I don't think, see, if people lose money, they don't pay tax. So I don't think that's a deterrent. In the sense that you will look at the lot size, I like the lot size idea very much because when, SEBI introduced lot sizes, or I think NSE introduced lot sizes, the argument was roughly 100 shares in the US would constitute a lot. Roughly the average stock price that was originally the US market was designed for was $40 a share. So it was $40 into $100, $4,000, 50 rupees to $1 roughly. So 2 lakh rupees was our lot size. Our GDP has gone up 10x since 2003 or 2002. And then, so 22 lakhs should automatically have become 20 lakhs, but it has become only 5. And secondly, the US average stock price is now probably $200 to $300. So a similar argument would lead to roughly $20,000 equivalent as a lot size that you would have in India, which is about 16 to 17 lakhs. So I think having a 20 lakh or 25 lakh lot size would be appropriate given the relatively higher volatility in the segment, and you need the sell side of the options at least to be a lot more financially viable. The buy side is, just limited by the amount they put in. But the other arguments are also sound in the sense of, I would say, even reduce the number of option expiries by instead of one every day to maybe 2 a week, one for each exchange, which is probably more viable because then you reduce that, the footprint of unbridled speculation. Speculation is not bad. It's a good thing. I think even it's a business. A lot of people in this business have come out from next to zero and made a lot of money in the F&O business by doing so. It is not therefore akin to a casino where the casino keeps almost all of the profits made here. Here it is actually spread out between a lot of people, and a lot of people can come in from relatively humble backgrounds and still make a lot of money. So I don't think it's worthwhile to ban it. You should just make it a little bit higher in terms of raising the bar in terms of entry, so that some of the least, the lowest end is raised by a little bit, so that you have to spend at least 50,000-60,000 rupees just to participate, and that will deter a lot of the smaller players here.
Got that. Deepak, we've been running your court play too, where you've said the speculation in F&O does not cause a banking problem. Could you explain that a little bit?
Yes, so let me run this by, if you look at it, no matter how, if I take my money out of my bank account and use it on F&O, I give it to my broker who's got a bank account. That broker will upstream it to the clearing corporation, which has a bank account. All this money is invested again in some kind of banking asset, right? So it's still part of the banking system. So there's no structural liquidity problem at all. The RBI governor actually said it in a different way. And he said there's no liquidity problem per se, but you have a problem at a single bank level where you depend so much on CASA, your current account, saving account, where you give no interest. And therefore, people get smarter and say, listen, let me put it in money market funds. Let money market funds invest in wholesale deposits for banks, which come at 7% rather than the CASA, which comes at either 0 or 4%. So the cost of your funds is going to go up. And if you keep depending on CASA, you will have a liquidity problem at an individual bank level. But the banking system is not going to see a liquidity crisis at all. And it doesn't make any sense for a banking liquidity crisis to be created by something moving from one bank account to another bank account within the banking system. Liquidity crisis either comes from money going out of the banking system, either by the government collecting too many taxes and keeping the money and not spending it, or people turning their money into cash, which moves money out of the banking system. It doesn't happen this way. Speculation will not change the way bank liquidity is as a systemic at a systemic level, but individual banks have been very lazy. They don't raise deposit rates and they crib that people don't put deposits in them. So I think this is not a banking liquidity problem at all.
We hope it stays that way, though that's a different debate altogether on, if it were as simple as just raising interest rates and getting a lot of deposits. I don't think any of the banks would be complaining. That's a different debate. Gentlemen, I think we need to do a longer one on this. We're constrained by a lot of earnings also coming in today and all the pre-budget stuff. We promised to get you back to answer the bigger sort of moral issue around this. Should regulators really have a role as long as the market is orderly? Thank you so much for joining in. As we take a break, I just want to pull up that quote plate from Ajay Bagga, who answers that question. Maybe we'll have him on the panel. He says, and I quote, regulators' mandate is market stability and integrity and, yes, investor protection from Ponzi schemes. But their mandate is not investor returns protection. Then you will always have infantile behavior-oriented investors who take credit for bull market returns and blame regulators for losses in corrections. I feel this is a regulatory overreach. This is a big debate. It isn't ending now. We'll have the panel back here and maybe Ajay as well to take it forward. Right now, a quick break. More on the markets in just a bit.
Frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could... I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return, dividends. They're defensive, but they could be like tobacco stocks. From a US perspective, Donald Trump will be risk-on for equities, because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested, as at the moment, in fiscal retrenchment. So in my view, you should assume it will remain out.
Welcome back. Here with us on Trading Hour. After regulators spoke out against the surge in F&O volumes in equities, fears have risen that the government too may weigh in with higher STT, securities transaction tax on futures and options. Lata is here with the likely impact cost. Lata.
Well, I just want to point out that the STT was never imposed with the idea of making too much money or putting hurdles. It is a very minute tax, and I'm just giving you 3 examples. For a delivery-based sale of share, the percentage is 0.1 of the price of the share. But look at the option. A sale of option in a security is 0.6625% of the value of the premium, not of the strike price and not of the final lot as well. So if you, and then of course where it is exercised, it goes a little higher at 0.125% of the settlement price. There it may be a little more. But let me tell you what the impact is. Take for instance premium of a Nifty option. The range is anything from 20 rupees to 4,000 rupees, depending on the strike price. Now, at 0.0625%, the tax on one option, even at 4,000 rupees, works to 2 rupees 50 pice. A lot size of 25, that multiply it will become 62 rupees 50 pice for a total premium value of 1 lakh. Now, even if you double it, do you think it is going to impact the cost of a person who is hell-bent on doing this option? So tinkering with the STT, I don't think will be something the government will embark on. It may go for something else, like STCG only on option gains could be increased. We don't know if a subcategory would be created. But as, Deepak Shenoy just pointed out, hardly anybody is making any gains. So, short-term capital gains on that won't help. No, if it is for foreigners, if they are coming through the Mauritius route, will the tax apply? So, you have to think on a different line, but I don't think STT will be the way they'll go ahead.
Okay, well, thank you for revising the rates for us. Important to keep in mind. Anything can happen. We're just 24 hours away from the impact line. Thank you so much, Lata, for joining in. And that is the big issue around retail speculation. With that, we're completely out of time on this edition of Trading Hour. Many thanks for watching.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also,
good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu. With me, as always, Ekta Batra. We're flitting between red and green on the frontline indices. The mid-caps doing a lot better. So let's talk about these earnings itself. A lot of them on our radar. The first one, of course, is JSW Energy. The first quarter was operationally good for the company. Their profits surged, aided by net interest cost and depreciation, while net generation also increased by about 18%, and as a result of which the stock holding up with a gain of about 1%. Our colleague Vivek Iyer caught up with Sharad Mahindra, who's the joint MD and CEO of the company, to discuss their first quarter's performance. The stock, after having a 13-14% sort of rally over the last couple of months, is now sitting with a 1% gain. So the obvious first question would then be, what does the company see in terms of FY25 panning out? Listen in.
Quarter one, if we see for the country and also for JSW Energy, for us has been a very, very happening quarter. The demand growth, when we talk at the country level, has continued to be robust after exhibiting a 7.5% annual growth last fiscal. In the current year, we have seen a demand growth of almost 11% in quarter one, which has been primarily driven by, of course, the weather conditions, Also, the manufacturing sector growth, which is there, which is robust and is driving the power demand. So overall, the power demand scene looks to be very good. And going forward also, we expect this momentum to continue in the full current year also. As regard to our performance against country's demand growth of 11%, what we have seen, our demand growth has, sale growth has been 18% in terms of generation, primarily driven by higher thermal and renewable assets. Hydro has performed extremely well. The growth in the hydro power generation has been 61% for us. Though at the country level, the hydro generation has remained muted when we compare with last fiscal Q1. But on Sutlej Basin, where our Karchamwang 2 and Baspa plants are situated, the hydro generation has grown by 38%. But better availability and reliability of our plant, we have exhibited a growth of 61% in hydro generation, which has been one of the major drivers. In addition to that, the new capacity addition, what we have done in the renewable energy space, also contributed along with the better machine availability of the existing assets. Overall, our demand growth of 18%, these have been the major reasons. As regard Vijayanagar, what you said, the PLF has remained low. It is primarily because of the issues related to the water availability because of the extreme weather condition, which has normalized in early July. So that was the reason that the generation was comparatively lesser when we compare with last fiscal.
Understood that, sir. So thermal PLF during the quarter improved to 76.4% versus 70% Q1 FY24. How do you see thermal PLF trends panning out for the rest of FY25? Like you mentioned, hydro PLF has been very, very strong. Now, the other question is merchant tariff for the quarter was at 5.27 rupees a unit. Can it stay at these elevated levels? How do you see merchant tariffs panning out?
Yes, sir. In fact, if we come to merchant tariffs, which despite very, very good availability of power supply from all the thermal stations, because of the intervention which Government of India has taken in last 1 year, the coal stocks at most of the thermal plants in the country was at a very comfortable level, resulting in higher generation and meeting a strong demand growth of 11% what we have witnessed. Going forward also with so much of solar capacity additions happening, round-the-clock power solution, till the time the storage starts contributing in a sizable manner, thermal PLFs are expected to remain at elevated levels around the same numbers what we have witnessed, barring the seasonality when we see apart from that. But on an annualized number, we expect increase in thermal PLFs going forward.
Okay, so you expect increase in thermal PLFs going forward. Now, FY25, now you're much better placed to give us a sense of the guidance. So what do you expect to see in terms of top line, in terms of EBITDA, in terms of PAT? Also, the second unit of Utkal Bharat, 350 megawatt is yet to come on stream. Has it come on stream as we have begun Q2, or do you see some more delay over there?
There are always some teething issues when we come, but we are happy to tell that we have already lighted up the unit, and it is in the process of stabilization, which generally for any new plant, especially based on low CV domestic coal, takes some time to stabilize. But we expect during this current quarter, definitely this unit will be online and will be start contributing to our revenue and margins.
Okay, and so a word on the guidance that you want to give for FY25?
Yeah. See, as we have earlier said that FY25 to reach a number of 10 gigawatt, we are very well on track. When we have ended Q1, we have crossed 7.5 gigawatt, and the work which is in progress of the projects which are under commissioning during various stages of the current year, along with commissioning in the current fiscal of our 240 megawatt greenfield hydro power plant in Kutehr, Himachal, along with the second unit of Ind-Bharat, we are absolutely confident that we will be crossing this 10 gigawatt number in the current fiscal. This is what the guidance we had given earlier also. Over and above that, if we see that the amount of bids, which I have said earlier also, which we have won during Q4 of last fiscal and in the current year first quarter, our total logged-in capacity, which include the running capacities plus the work in progress and the other letter of awards what we have won, we have reached a number of 16 gigawatt, which will be commissioned in coming years.
Okay. You're also constructing Asia's largest battery energy storage system with close to 1 gigawatt capacity, which has already been tied up with SECI. When will it be commissioned? Explain to us the unit economics over there, and also what kind of top line and EBITDA contribution can you see from this particular development?
See, this is a very, very highly remunerative project, the work which we have started on ground. And we will be definitely commissioning this entire 1 gigawatt hour, which is Asia's largest, as you said, battery energy storage capacity by June 25. In terms of when this bid was won and the tariffs which were discovered, after that we have seen a significant moderation in the prices of battery cell, which makes this particular project highly remunerative for the company.
So newspaper reports also indicate that you're interested in the likely acquisition of Sinnar Thermal. Can you give us a comment on the same? If you are interested, what kind of valuations will you be reasonably comfortable with? And also, what does it add to your portfolio, given the fact that you have very aggressive capacity addition plans?
Yeah. See, the thing is that there are many platforms, assets keep coming in the market. It is a routine process that we do assess each and every opportunity which is present in the market, and rather than commenting on any particular opportunity which is there, because there are multiple opportunities on which we are working and evaluating, as and when we are confident that the benchmark returns are protected, we will definitely be keenly looking towards any such possibility in the market space rather than commenting on a particular asset.
Okay, well, the big news now is that the Finance Minister has tabled the economic survey for FY24 in the Parliament. Shireen is here with more details on it. We're still waiting for more details from the wires, but nonetheless, Shireen, your take.
Well, I just have managed to get my hands on the economic survey. We're still going over the details, but this is what the Chief Economic Advisor, Anant Nageshwaran, is saying in his second economic survey. He says the economy continues to expand. The Indian economy is on a strong wicket and stable footing, demonstrating resilience in the face of geopolitical changes. High economic growth in FY24 have come on... Sorry, this is, no, ignore this. This is not, this is the older survey that we have managed to get. But what we are getting at this point in time is that the economic survey has been tabled in Parliament, and this is going to potentially project a baseline growth rate of 6.5 to 7% with a potential for an upside. That is what our colleague Sapna Das has been reporting. As we've been suggesting here, this is of course going to be the economic survey that precedes the budget, and in many ways one of course is the growth assumption that the survey factors in, but more importantly it will also set out a path in terms of potential ideas that the government could look at, or priorities that the government could look at, and the expectation is that it will continue to build on the themes that this government has prioritized, which is manufacturing growth, which is focusing on capex, public capex to drive investment, and the expectation is that perhaps on things like technology and AI, the Chief Economic Advisor could present what the government's roadmap could be and what the government also views as potential concerns when it comes to the fast-scale adoption of artificial intelligence and the impact on jobs. But 6.5 to 7% with a potential for upside is what the expectation is as far as the growth number is concerned. As we get more details, we'll come back to you, but for now, back to you.
Okay, all right, Shireen, thanks very much for that. So yes, all eyes will be in terms of the growth target and what it is put out by in terms of the economic survey, as well as the capex, the current account deficit, the rupee. So they're going to cover all the macros within this. We'll take a short break, but we'll get you more on the markets. We'll keep our eye out on the economic survey. Be back in a jiffy. Stay tuned.
Details of all the interest income that you've earned, Always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Big US tech companies have huge cash balances, so they're getting 5% where they were getting.
Welcome back. Well, in wait and watch mode for the markets when it comes to the economic survey as well as the budget tomorrow. So currently the Nifty is just about consolidating with a little bit of a negative bias. We have the mid caps which are higher at this point in time. But let's talk about specific stocks while we wait by for the economic survey and more details from that. HDFC Bank is in focus. It's up over 2% after beating street expectations. So Abhishek is here with more details on what the street liked about it. Abhishek.
Well, to begin with, the surprise on net interest margin expanding on a sequential basis is perhaps what has worked out, for SDFC Bank in terms of investor reward. So P&L, take a look. The NI and PAT is a beat on our poll. NI is a beat of 0.9% and the PAT is a beat of more than 3%. Net interest margin improved on a sequential basis by 3 basis points. Largely, analysts were expecting a flat net interest margin. Now, other income declined by 41.3% sequentially. Treasury gains were about 7,600 crore in the previous quarter, so that's a one-off that has come in this time around. Operating profits declined by 18.4%. However, if you remove the treasury gains, operating profit grew by 9% on a sequential basis. Provisions were down 80.7% sequentially. PAT declined by nearly 2% on a sequential basis. Asset quality has seen marginal deterioration given the fact that agri portfolio is a seasonal in nature. It deteriorates in Q1 when compared to the Q4 numbers. So gross NPA has increased by 6% on a sequential basis. Net NPA has increased by 17.5% on a sequential basis, suggesting that the provision coverage ratio has declined to 71.2% when compared to 74% in the previous quarter. However, as a ratio, gross NPA ratio and net NPA ratio remain under control for the bank. Back to you.
All right, Abhishek, thanks a lot for that. That's about HDFC Bank, but we can't take our eyes away from the macro data right now, which is coming in terms of the lines from the economic survey. The biggest headline here is that the survey conservatively projects a real GDP growth of 6.5% to 7% with risks evenly balanced. Steady as she goes is what the headline of the economy, the state of the economy is. Let's go back to Shireen. She has more details out there. Shireen.
Well, that is bang on track. That is exactly what our colleague Sapna Das had reported. 6.5% to 7% is the baseline growth rate that the survey is projecting as well. And chapter 1 of the survey, state of the economy, steady as she goes, as you correctly pointed out, Mangalam. That is the headline that the chief economic advisor has attributed to chapter 1. Also, of course, talking about the fact that India has been fairly resilient when we talk about what is happening as far as the global scenario is concerned. If you just were to look at some of the other numbers, inflationary pressures are declining across countries, including here in India. That is what the economic survey is pointing out. The current account deficit is projected to be at about 0.7% of GDP. In fact, the current account registered a surplus in the last quarter of the financial year. Foreign exchange reserves are ample. The environment for foreign direct investment to grow in the coming years is not highly favorable for many reasons. Interest rates in developed countries are much higher than they were during the pre-COVID years. And this not only means a higher cost of funding, but also a higher opportunity cost to invest abroad. So that's one of the red flags coming in there as far as FDI is concerned. And if you notice, this is what the data is also suggesting, that we have seen FDI declining in the last few quarters. And that is something that the CA is pointing out as a concern, that the environment for foreign direct investment to grow in the coming years is not highly favorable on account of higher interest rates in developing countries, which will lead to a higher cost of funding, but also a higher opportunity cost to invest abroad. Growth, again, as we pointed out, conservatively projecting a real GDP growth of 6.5% to 7%, with risks evenly balanced, cognizant of the fact that the market expectations are on the higher side, including, of course, what the RBI is projecting as far as growth estimates are concerned. So certainly much more conservative. That is the economic survey when we talk about the headline growth number that it is assuming. We just need to look at some of the other ideas and the headlines that are coming in from the survey. It is a voluminous document at this point in time. We are perusing the fine print, of course, talking about the election outcome as well. The fact that this is now a third term for the Modi government, but it is a different complexion as far as the government is concerned. And we do have geopolitical uncertainties which are on the rise, which are likely to exert a bigger influence on capital flows, notwithstanding other reasons for preferring to invest in India. Overall, the Indian economy looks forward to FY25 optimistically, anticipating broad-based and inclusive growth. So clearly, as far as growth is concerned, the survey continues to signal confidence, continues to signal optimism. The real GDP in FY24 was 20% higher than its level in FY20, a feat that was only achieved by very few major economies, also leaving a strong possibility for a robust growth in FY25 and beyond. Growth has been inclusive, with a reduction in unemployment and multidimensional poverty and an increase in labor force participation. So the survey is suggesting that there has been an improvement both in terms of a reduction in unemployment as well as labor force participation. And overall, the Indian economy looks poised for a robust FY25, anticipating broad-based and inclusive growth. That's the bottom line there coming in as far as the survey is concerned. Whether there are big-ticket ideas that the survey is prioritizing as possible ideas that the government could take forward, we will have to just peruse the details for that. But let me bring Lata in for a quick check. Lata, fairly conservative there as far as the GDP number is concerned, on the lower side of what most others are projecting.
Oh, absolutely. I think that is the standout feature, that they have not tried to get into the rah-rah idea of, trying to go from 7 to 7.5 when the Reserve Bank, a usually conservative body, is itself standing at 7.2. To desist from that is very important, which means chances are that the budget also will take into account a nominal GDP growth of just about 10 or 11% that the previous, interim budget did. If you're not even assuming a real GDP of 7%, given that the Reserve Bank's forecast is 4.5% for inflation, the overall nominal GDP that they will, and the nominal GDP is important because fiscal deficit is a percentage of nominal GDP, that also is likely to be just about 11 to 12%, and therefore pretty conservative. The important paragraph, the outlook paragraph, goes on to say that the Indian growth trajectory is a little better than what it was pre-pandemic. Again, here, they are not going into a rah-rah of 8%, which is the average of the last 3 years. Rather, they have said that pre-pandemic, the 10-year average was 6.6, and now we are getting very close to that, and that is why the 6.5 to 7. They point out that, the survey points out that there are a lot of positives in the global environment as well, with many advanced economies on the verge of cutting their interest rates. But they go on to say that there is always a geopolitical fear, and then, things can get tough even at the global front. Domestic drivers, they are very clear that clean balance sheets of both private sector banks as well as the private sector companies indicates that there is scope for very good investment. And the rainfall, of course, is still expected to be normal. We will have to look for it. Measures like GST and IBC are now mature. So you can't expect outsized gains, and that is why this modest number of 6.5 to 7. That's what the Outlook chapter says.
That is right. Just for the benefit of our viewers, before we bring our guests in, want to highlight two quick pieces of information that have come in from the survey. As far as the asset monetization is concerned, and remember, this has been something that the government has been talking about, but has underperformed on that front. The National Highways Authority of India has identified and published an indicative list of 33 assets to be monetized in FY25. This will help improve capital allocation by investors while aiding the government in pursuit of fiscal consolidation. That's one. The survey also flagging the concern that many have expressed when it comes to data related to employment. The lack of availability of timely data on the absolute number of formal and informal jobs created at an annual interval, let alone at higher frequencies across sectors, precludes an objective analysis of the labor market situation in the country. So those are two important aspects that the survey is highlighting. But let's bring our guests into the conversation. Nikhil Gupta, Chief Economist at Motilal Oswal Financial Services, Satyanandan Shukla, Group Chief Economist at L&T, Kaushik Das, Chief Economist at Deutsche Bank, with us. Gentlemen, thanks very much for joining us. Kaushik, first, the headline growth number assumed by the survey, your take on that?
Hi, Shirin. Good morning. As Lata mentioned, the Ministry of Finance actually has been quite conservative with their forecast, which is, I think, pretty prudent from a fiscal management point of view. And even last year, when they gave the nominal, in the interim budget, when they mentioned the nominal GDP growth for FY25, they just took 10.5% growth, which I felt was on the lower side. So I think they're going a little conservative given the amount of global risks that can suddenly hit you. And they don't want to, come across as too optimistic and then having to revise the growth forecast down. What has happened in the last few years is that whatever growth forecast has been given, we have done better than that, which I think is a better way to approach the fiscal calculations. Markets kind of are sanguine that whatever number the government would give on the fiscal side, they will meet that. Market borrowings will be in line with estimates. So these are all positive things. Only thing is that we should be optimistic about growth going forward because of the capex recovery that is supposed to take place from the private sector side. We've had a increase in private sector capex, but what we are looking for is a broad-based capex recovery from the private sector now that the elections are behind us. And that itself can easily help us get 6.5–7% growth for the foreseeable future.
Yeah, let me bring in Satyanandan into the conversation as well. Both as far as the growth number is concerned, but also what the survey is pointing out in terms of inflation. Short-term outlook is positive, long-term requires a clear vision. The medium to long-term inflation outlook will be shaped by strengthening of price monitoring mechanisms and market intelligence, as well as focused efforts to increase domestic production. They're talking specifically as far as food items are concerned. But on inflation, believe that the RBI and the government have done a good job. Core inflation declining to a 4-year low. Satyanandan, both in terms of growth as well as what the Chapter 3 on prices and inflation under control. That's the headline. Your take?
So thank you, Shireen. I think this is a very, very well-reasoned and mature take on growth and inflation from the CEA. And this is very, very reassuring. I think Kaushik already pointed out, typically we see the executive arm being very, very, positive on growth, whereas the central bank typically is a bit more cynical or more reasoned on the growth prospects. With the chief economic advisor now talking about growth being in the 6.5 to 7 corridor, and inflation being around 4.5 or thereabout, which is what every private forecaster is saying, and also the RBI is talking about, I think we are in a well-charted territory. I just wanted to highlight that if you look at the trajectory going forward, the budget is going to be very, very critical and the litmus test. It doesn't need to be either radical nor irresponsible, and it has to be just balanced. And that is what everybody is going to be looking at. In terms of growth, again, I think the thing is, do they come out with some sort of medium-term or long-term vision or strategy? This being the first budget of this coalition government, it is going to be acting as a guidepost for 3 years, typically, before the pre-electoral concerns or the strategy takes over. And therefore, I think if they sound us about how they will make the economy run from here, so far it has been trying to make the economy just resurrect and walk. Now, if they can come up with some strategies on how to make it run and keep this sustainable, I think this augurs very, very well for the economy. Back to you.
Okay. Okay, thanks for that, Sachin. But I do want to once again come to the point of the conservative tone that the survey is striking as far as the growth outlook is concerned, and for the benefit of all of you, Nikhil, Samir, Sachin and Kaushik, just see how the first paragraph of the outlook even starts. The Indian economy recovered swiftly from the pandemic, with its real GDP in FY24 being 20% higher than the pre-COVID FY20 levels. So 20% higher than FY20. This meant a CAGR of 4.6% from FY20, despite a 5.8% decline in FY21 due to the pandemic. Analysis in this chapter shows that the current GDP level is close to the pre-pandemic trajectory in Q4 FY24. During the decade ended FY20, India grew at an average rate of 6.6%, more or less reflecting the long-run growth prospects of the economy. This is the background against which we see the prospects of FY25. So they just taken the long-run average FY10 to FY20, that's 6.6. They've removed the COVID and the post-COVID spurt in growth and simply projecting that 6.6 as the long-run average for the economy. I mean, what do you take away from this, Nikhil? Are we likely to see, therefore, a more conservative budget as well, not assuming too much by way of nominal GDP and therefore fiscal deficit? Nikhil.
Hi, Lata. Thank you very much. Okay, so Lata, I think, yes, they are being a little more conservative than what the RBI has forecasted for FY25. But we must understand that be it 6.5% or 7% growth in FY25, it is on a very good base, and 6.5% or 7% does not make too much of a difference in FY25. What matters is, are we going to sustain 6.5% or 7% going forward? As far as the implications for the budget is concerned, I always believe that it's better to be conservative in terms of your receipt estimates and hope for the best, or hope for additional resources during the year, which can help the government to either spend more or post a better fiscal deficit at the end of the year. So even if we are 6.5% to 7% growth without any fiscal stimulus, I consider it to be a very strong economy after 3 years of 7% or higher growth. I broadly do not see too much need for the budget to be extremely aggressive in terms of its stimulus or the other way around. I still believe, I hope that this budget would be in continuation to what we have seen in the past 5 years. I understand that the government has some extra additional resources this year and they may want to spend it. But principally, I think the broad message should remain the same, that it is going to be a fiscally prudent 5-year period from the fiscal policy perspective, and I hope they continue with that.
Yeah, and that is exactly what we've been reporting as well, Lata, as we heard there, that, the expectation is that this is not to be treated as a new budget. This is to be treated as a continuation of what the government's projections were in the interim budget. What we are given to understand that there's unlikely to be any deviation or departure from the fiscal math, from the fiscal arithmetic that was presented in the budget. But I just want to highlight for our viewers as well as for our guests who are here with us, the growth vision that the economic survey is projecting. 6 areas of priorities that the economic survey talks about. Number 1, boost private sector investment to 35% of GDP through a conducive policy and regulatory environment. Number 2, strengthen India's MSME sector through deregulation at the state and local government levels. Push for sector-specific tailored skilling of MSME entrepreneurs and develop a clear-cut export strategy. My sense is that perhaps we could see something on this front in the budget tomorrow. Number 3, remove growth impediments in the agriculture sector and allow markets to function in the interest of the farmer. Number 4, secure financing of the green transition in India. This has been something that this CEA, particularly Anantha Nageshwaran, has been focused on. Number 5, bridge the education employment gap. And number 6, build state state capacity and capability. So the growth strategy for Amrit Kal, as is being highlighted by the economic survey, focuses on 6 priorities, and that is what we'll get our guest to comment on. I would imagine that this is going to be something that we will see being taken forward in the budget in terms of prioritization and perhaps find mention in the finance minister's speech as well. But going back to inflation, Lata, and again, the survey very clearly talking about the fact that prices and inflation are under control. Headline inflation the lowest in FY24. India's inflation is lower than emerging markets. India has one of the lowest average deviations from the inflation target. So building that case that the government and the Reserve Bank have done well on taming inflation, tackling inflation, Lata.
Okay, yeah, I take your point. There is also a detailed paragraph on aviation. I mean, almost a chapter. So we will have to see if there are anything specific coming for that sector. But, this employment education gap to be bridged, the need for financing of green transition, we're probably going to see something on all these. Samir Narang, Shireen read out those 6 strategic areas where they are hoping to concentrate, focus on private investment, boosting private investment, growth and expansion of MSMEs, the potential of agriculture as a future growth engine, the need to secure financing of green transition, education employment gap to be bridged, and focus on state capacity and capability. Now, anything that strikes you as likely in terms of a policy tomorrow, Samir?
So I think one of the things that will be in the budget, which will see a lot of emphasis, would be job creation, manufacturing. Under BLI, we have seen a lot of success in a few key areas. We've seen a large expansion of domestic supply chain in electronics. And I think that will be a focus area in terms of job creation. And I think they're just trying to capture the entire value chain from skilling so that the individuals who are joining the workforce are fairly skilled. And there is an easy introduction of those skilled workforce in the manufacturing sector as demand picks up for this segment in India, as India is becoming part of global value chains. We are also seeing some of this emphasis in terms of apprenticeship in Maharashtra budget as well for younger workforce. So I think there will be some continuity in terms of what we should expect in the union budget. A bigger play would be also on green financing, because India is now looking at power deficits for the next few years, given the power demand that we have seen. So you should see a much larger, expansive program on green financing and achieving our power objectives, as manufacturing intensive growth is more energy intensive than what we've been seeing in the last decade.
Kaushik and Sachin, just to come back to you all, since it's a very, modest or moderate forecast in terms of growth, do you want to guess anything in terms of fiscal deficit? See, we all know that there is a 1.3 lakh crore of RBI money, which is a one-off. And, that's a different proposition. But there is also an expectation that they can up the tax number for the simple reason that even last year's RE is indicating some 26,000 crores more than what the revised estimates indicated. And if you go by the first 4 months, April-July tax collection, it's standing at about 19%, the overall net tax collection, not even GTR. So, Kaushik, first to you. Do you think that, therefore, the government will not do anything, ultra spending, considering the modest tone in the survey? You think they'll be fiscally more conservative?
So, Lata, I mean, being professional forecasters, we are in the job of, guessing the number. So I'll guess that tomorrow you'll probably get a pretty, nice fiscal deficit consolidation path, and probably the number would be lower than the 5.1 that was indicated in the interim budget. We are going with a 5% baseline expectation, but we think it can be as low as 4.9% of GDP as well, even after the government spends higher than what the interim budget estimate suggested. So given the fact that the government has got more funds from RBI to the tune of 1.3 trillion, plus the FY24 actual budget deficit has been 5.6, compared to 5.8, you could easily go down to 4.95% even after spending some money to boost consumption and with some tax cuts. So I don't think it will be that big a problem, even with a 10.5-11% nominal GDP growth number, which we are assuming in our calculations. And about 70% net market borrowing as a percentage of fiscal deficit. We think that the fiscal deficit could be lower. So we think that there would be some consumption boost, not in any particular item, but over the different items that are there, agriculture to rural welfare, different important components. There would be some increase compared to the interim budget. That would be about 700 to 800 billion INR worth of increase compared to interim budget. But because we have this 1.3 trillion extra funds from RBI, you can still have 400-500 billion reduction in fiscal deficit, which could be to the tune of and bring fiscal deficit down to 4.9%. So I think it's a very, very good economic survey, kind of guide path towards the budget, with the nominal GDP or real GDP being very realistic numbers. 6.5% to 7% is something which we can believe for this year. Our own forecast is 6.9%, and after that we have assumed a 6.5% real GDP growth for the next 7 to 8 years, and that itself could take India to become a $7 trillion economy, doubling in size, doubling of per capita. So all this structural story remains, and on top of that we are going to have fiscal consolidation, and we can surely reach 4.5% target that has been set for next year, and in fact we can do better than that, is what I would guess.
Well, Kaushik, that's exactly what we've also been picking up on. And of course, all will be revealed tomorrow. But the indication that we get is that there is the likelihood of improving on that fiscal deficit number. And it's very clear that the government intends to stick with the fiscal consolidation roadmap. And they do have that revenue cushion that Lata was also alluding to. But I want to go back to the survey and highlight two chapters in particular. Chapter 12 on infrastructure, lifting potential growth. And of course, the survey talks about the fact that public sector investment has played a pivotal role in funding large-scale infrastructure projects, what they've done on the national highways, what they've done on capital expenditure on railways, aviation, and so on and so forth. But here are the new ideas that the survey is throwing up as far as infrastructure is concerned. And I'm quoting from the survey: given that infrastructure creation efforts in India are currently predominantly public sector-led, a higher level of private sector financing and resource mobilization from new sources will be crucial for India to continue down the path of building quality infrastructure. Facilitating this will require policy and institutional support from the central government, also state and local governments. Also, existing databases fall short on assessing the demand for infrastructure and tracking the utilization of facilities. The construction of an index that tracks the utilization rates would shed light on subsectors where there is either an oversupply or a shortfall. Nikhil, to you first. On the government capex side, industry bodies have basically asked the government to do a higher capex than what was provisioned for as far as the interim budget is concerned. Do you see that as a possibility? Do you believe that the budget is likely to take that forward? And what do you make of what the survey is highlighting on resource mobilization from new sources, Nikhil?
Yes, so Shireen, the government had budgeted 11.1 trillion rupees as total capital spending in the interim budget, which implies a 17% growth over FY24. 17% growth after 3 consecutive years of 30% plus growth on an average, which is a very, very good number according to me. But what matters, again, this is something that we have highlighted again and again, that center's capex is only one part of the entire budget capex. There is something called internal and external budgetary resources, which means simply the capex done by the CPSEs. The companies owned by the central government, and we have seen CPSE's capex declining massively in the last 3 to 4 years. So what matters from the economy perspective is the combined capex of the central government and the CPSEs. And if you look at the combined budget, combined capex of these two entities, central government and the CPSEs, it was 3.6% of GDP last year. It is budgeted at 3.6% of GDP for FY25, which is actually slightly lower than what it was in the pre-pandemic years, which was close to 3.8% of GDP or so. So the central government is doing whatever it can to boost the capex in the country. But again, we must understand that central government is only one participant in overall investment story. The corporate sector, the household sector are much, much bigger investors in the country. And I think you mentioned that the economic survey mentions that they want the private sector capex to go up to 35% of GDP. Did I hear it correctly?
Yes. That's
so
right.
That's private sector.
Right.
They're talking about private investments, which means if you add another 5% capex by the central and state governments, they're talking about 40% investment to GDP ratio, which we have never seen. Of course, I need to go into the details and understand clearly what they are talking about. But if we want that kind of capex or investment to GDP ratio in the country, then we must be very clear about the financing of this investment as well. Otherwise, as we are seeing in the historical episodes as well, higher investment to GDP ratio leads to worsening the external balances, which means we will not be able to sustain higher investment to GDP ratio. So that is something that we need to keep in mind whenever we talk about investment recovery in the economy.
No, that's a fair point that you make, and you're absolutely right in pointing out that we have seen those record numbers coming in as far as government capex is concerned. But I want to go back again to Chapter 11, which really talks about the contribution of the services sector, accounting for about 55% of the total size of the economy in FY24, estimated to have grown by 7.6%. But here's again what the survey is throwing up, and I imagine that in some form or fashion we are likely to hear the finance minister allude to this. The emerging jobs demand in the services sector entail greater and more focused skills. Focus areas should include blockchain, artificial intelligence, machine learning, Internet of Things, cybersecurity, cloud computing, big data analytics, augmented reality, virtual reality, 3D printing, and web and mobile development. Remember, even in the interim budget, we did hear the finance minister talk about AI. Of course, the government has also articulated an AI roadmap, but the survey also now talking about the fact that job creation will also need to be matched with the requisite skills development, and focusing on these areas. Upskilling through government and industry collaboration can enable India to become a high-value partner in areas like cybersecurity, enterprise management, and other specialized areas. So, Samir, both on infrastructure as well as services, some of the highlights that we just pointed out.
So I think, Shireen, on the infrastructure side, even the last survey spoke about NAFID as a key agency which can fund a large infrastructure trust in the country. Earlier, we used to have infrastructure development financing agencies, but that model was given up, and then we had some of those agencies being converted into banks. I think we've again reshifted the model back to certain key trust infrastructure financing agencies led by NAFID. And I think that could be one of the areas which can, look at funding through both global, going into global markets and taking the requisite resources, as well as monetization of a number of projects which are actually generating cash flows. So there could be two-pronged strategies in terms of funding. On the skilling and services side, I think there would be a broad focus on tertiary education in terms of skill development, wherein we focus on right skills so that the candidates that are coming out of our education system are actually job-oriented and can get into the workforce much more easily. We do hear these discussions coming from corporate sector that the candidates are not skill ready, they need to be trained for 2 years or 18 months. I think that bridging of gap, but perhaps the budget will look at over the next 4 to 5 years, how the other Southeast Asian countries have bridged that gap through apprenticeship. There could be a broader thrust towards that area as we move ahead in the next 4 to 5 years.
Okay, thanks for that, Samir. Sachin, would you want to add, in the infrastructure chapter, the conclusions only show that the survey is asking for all databases to be integrated. The point the CEA is making is that, the central government spend, the state government spend by the various, NBFCs, banks and other entities. There isn't any consolidated base available, but they're not talking about new ways of raising money. I was hoping that because there is this, bond index inclusion and therefore more debt money coming in, maybe something about capital market development for infrastructure would be in the cards, but there is nothing like that in infrastructure. From a capex point of view, how would you read this fairly modest, explanation on infrastructure? No brave ideas.
Nata, I think we need to work with the resources at our disposal much better. I think there is a bit of slack in the way we do things. I think what is very heartening is to hear that they're talking about a 35% to GDP as the capex ratio. I think there is some confusion. Nikhil said it's only private, but I'm assuming it is the overall capex to GDP number that they're talking about. And there, Lata, I think we have this issue between in terms of the absorptive capacity of the center and the states. For example, F24. The central government was able to spend nearly 99% of the capex target, whereas the state governments put together, I mean, by and large, the larger states put together were able to spend only 81%. So I think we have enough mechanisms, we have enough agencies. So capital definitely is not an issue. We need to be working a lot more on the absorptive capacity of the administrative machinery. We need more coordination between the center and the states, and between the various agencies. And I'm sure once we do that, we'll be able to really move forward. Another point, Lata, that I wanted to make is that it's very heartening to see the way the fiscal consolidation is happening. This year, we've seen a hand of God via the RBI dividend. I mean, Governor Das and RBI have handed out a bonanza to the government. But typically, if you see the way we have done or gone about fiscal consolidation, is via compressing expenditure. We are in that positive phase where we are actually doing fiscal consolidation via the revenue side. And this is a good space to be in. If this continues, and you did mention about how they've been conservative on the numbers, I think the motto is that promise and over-deliver. And I think we will really do well to first align on the data bits. There are massive gaps. We need to look at the utilization levels and also the absorptive capacity. And I think we are in a happy space.
Okay. Well, actually, I'm trying to read only the conclusion paragraphs of all the chapters of the 6 thrust areas that Shireen earlier spoke about. There aren't any new ideas that the CEA is trying to project. Maybe the medium-term growth outlook is the only chapter where perhaps something new may come. So let me just wind up this conversation by asking you all, going by the meager leads we have from the economic survey, what you guys are expecting by way of fiscal deficit. We know that the government has about 1.7 trillion more, 1.5 to 2 trillion more to spend in the current year compared to the interim budget estimates, 1.3 from RBI and maybe another, half a trillion from higher taxes. So what are you all expecting in terms of welfare, capex, fiscal deficit? Will it be equally distributed or will it be a giant two fiscal deficit? Samir, you go first. As brief as possible, we want to wind this up.
No, sure, Lata. So I think, first of all, we believe the extra personal income tax may not happen because some of that will be given away in terms of change in standard deduction or slabs. So the remaining, which is 1.3 trillion, which you said is coming from the RBI dividend, will be split with 30,000 odd crore higher capex. Remaining would be higher revex. And revex will be mostly in terms of welfare spending towards key areas such as healthcare, such as education.
Got it. And no change in fiscal deficit.
No, we have marginally tweaked it lower by 10,000 crore, no change, 5.1%. As you clearly said, it's continuity.
Okay. Sachin, yours? I just want 3 sentences on each of them.
Right. No change in the fiscal deficit. I think they will try and distribute some money towards the needy pockets and segment of the economy, and at the same time, up the capex number a bit.
Up the capex number. Okay. Nikhil?
20 to 30% towards further reduction in fiscal deficit. Capex, if you include anything towards job creation in capex, then 15 to 20% capex, and then the remaining for the welfare or revenues.
Okay, so basically one third you're expecting. So maybe a 5% fiscal deficit is what you're going with. Kaushik, you said 4.9 fiscal.
Yeah, I think I'm the most optimistic. My base case is 5, but I think my heart says it can go down to 4.9. Out of the 1.3 trillion extra, I think 80,000 crore would be spent on revenue expenditure. Capital expenditure, 11.1 trillion. It's quite a lot to spend within the 8 months that is there in this fiscal year after the budget and all. So I think mostly it's revenue expenditure, but you still have 50,000 crore then savings in fiscal deficit. As a percentage of GDP, you can easily go down to 5% or even lower. I hope it happens tomorrow. And then India would be set for a ratings upgrade sometime soon.
Oh, rating upgrade. That will be great, of course. Gentlemen, thank you very much. I'm giving you time to look up the economic survey. Sorry, Shri.
No, I was saying that ratings upgrade has been much anticipated, Lata, and I think all eyes will be on whether that finally transpires or not. But, just a point that all of our guests were making, and this is what the survey highlights, that the fiscal balances of the general government have improved progressively despite expansionary public investment, tax compliance gain driven by procedural reforms, expenditure restraint, and increasing digitization have helped India achieve this fine balance. So it tells you that there is elbow room for the government should it choose to act at this point in time. And remember, while there is an element of continuity, and that seems to be the message that the government is sending out, this is also for the very first time in 10 years a coalition, a true coalition government. You've already seen Andhra Pradesh put down very specific asks in terms of the expectations that they have from the government, from the finance minister. And just yesterday at that parliamentary meeting, the JDU also talking about the need for Bihar. Of course, none of that, at least it's in the many pages that we've gone over so far, found mention in the survey, but we will, of course, have to look at this more closely. But that is certainly going to be something that we will have to factor in as well when the finance minister rises to present her 7th budget, of course, creating history with that 7th consecutive budget as well. So, gentlemen, finally, before we let you go, of what we've seen so far, the survey put out, and Kaushik, I'll start by asking you, the expectation is that perhaps a little bit more on capex, perhaps a little bit less as far as the fiscal deficit number is concerned, but on tax, and the hope and the expectation is that this could be the budget that the taxpayer will be provided some sweetener. Is that your expectation? Is that your best case scenario as well?
Shane, everybody wants a tax cut. It's nice to have a tax cut. I hope they cut taxes and then you can manage expenditure as well. But let's see, if there are some tax cuts, it will only be at the margin. So I'm not going to, assume a big tax cut as such for everybody. And even if there's a tax cut, I don't think the government will show any reduction in revenues because they'll assume that part of that extra money that people will have would be consumed, and then you'll get that money back through higher GST and indirect taxes. So I would assume some bit of tax cut on the lower margin, but that would not lead to a reduction in revenues as such. So we can still manage 5% fiscal deficit or lower, along with some tax cuts and higher expenditure out of the bounty that the government has got from the RBI.
Sachi, Kaushik, they're alluding to the fact that there is an expectation that there could be some sweeteners on the tax front. But what about something that could perhaps potentially sour sentiment, and that is the possibility of higher taxes? We don't know whether they will touch capital gains and review the regime in any form or fashion at this point in time. But what we've heard from the two regulators, SEBI and the RBI, over the weekend, potentially, any higher taxes, especially as far as the F&O side is concerned, what would the expectation be?
Shirin, I think there is some scope for the government to really provide something to really nudge them on the new tax regime side. But this does call for some sort of sweetener from the government, and that's probably the only thing that would come about. I do not hope that anything comes on the capital gain side. As far as F&O goes, Shirin, when you have the SEBI, when you have the regulators looking at something like that, I don't see why the budget should be really coming with some measures trying to contain some irrational exuberance over there. So I think the SEBI is fully empowered and it has a lot of tools to really do whatever is needed. So I again don't really think that the fiscal policy or the budget especially should be doing something to address that.
Okay. Well, that may well be the case because STT is anyway a minor tax. But Sachin and other economists, please stay on. Shireen, there's one important paragraph which you all might find very interesting. This is actually the chapter on farmers and farm-friendly policies, but it goes on to say whether one of the ways in which to help the farmer is by re-examining, guess what, the inflation targeting framework. The point the CEA is making is that very often the Reserve Bank goes after inflation when it is food price induced, as in the current situation. And that hurts the farmers' interest because that is the only time they are making money, since most of our farm price increases are supply induced. Not my words, the words of the CEA. So he is asking the question whether the inflation targeting framework should be re-examined to exclude food and make the MPC target something excluding food. I'll read the lines so that I'm not misquoting. Food constitutes a very high portion of the CPI. This is par for the cause. Hence, when central banks in developing countries target headline inflation, they effectively target food prices. So when food prices rise, inflation targets come under threat. The central bank appeals to the government to bring down prices. Okay, let me come to the operational word. Deploying these tools to deal with inflation caused by supply constraints may be counterproductive. Therefore, and watch this, it is worth exploring whether India's inflation targeting framework should target inflation rate excluding food. Hardships caused by higher food prices for poor and low-income consumers can be handled through direct benefit transfers. So this is a very big thing, especially because now the 4-year term of the external members ends. So, you know, last time there was a relook at the inflation targeting framework at that time. And of course, for all you know, Governor and Dr. Patra also could end their terms. They could be extended. We don't know. But, you know, is the CEA indicating that there could be a review of the inflation targeting framework? Well, to you first, Kaushik.
Yeah, Lata, this is a very interesting debate. And I remember that last time this was relooked, I was of the opinion that India should have some weight given to, you know, core inflation, and you cannot just, you know, do inflation targeting based on headline, and which is basically a reflection of food, because ultimately then what you end up doing is, you know, reacting to tomato prices and onion prices, and that is 50% of the food basket. So I think you should you should not make inflation targeting just based on core inflation in India. That has its own, you know, negatives. But you should give some bit of weight to core apart from looking at headline and then take a call overall, you know, whether to, you know, reduce rates or not. As of now, RBI has to, you know, target headline inflation as per the rule. And that kind of, you know, binds them into a very difficult position at times. And they're not able to, you know, ease even when core inflation is at a record low. So to that extent, I think some bit of flexibility on looking at both core and headline can help, because end of the day, I mean, all these vegetable prices are not in the control of RBI, and all you can hope is some government support. Once the, you know, vegetable prices go up, then they can take some steps. But in order to get, you know, proper monetary policy, you know, kind of reaction function, it has to be based on core inflation at the end of the day, because that is what matters most, and that is what the central bank can actually affect. Now, we understand inflation expectations play a big role in RBI's thought process, and food prices, you know, kind of determine that inflation expectations. But that's why I'm saying it cannot be just core inflation like some advanced countries. It should be a mix of both core and headline is what I would, you know, recommend once the next time they're looking into this framework.
You know, gentlemen, we're also joined by Suman Berry, the Vice Chairman of the Niti Aayog. We'll get to him in just a second, but we were just discussing this, and one of our guests pointed out that perhaps the budget may not be the appropriate mechanism to address this issue of what is happening in the stock markets, and something that both regulators have alluded to. Here is what the CEA, the Chief Economic Advisor, is saying when it comes to retail investors rushing into the stock markets. It says the financialization of economies has not ended well, even for advanced economies. The global financial crisis of 2008 is an obvious example. Developing countries face debilitating crises when financial market innovations and growth run ahead of the economic growth. Goes on to say there is a significant rise in retail investors in the stock market, which calls for careful consideration, possibility of overconfidence leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is is in lockstep with economic growth. India can ill afford economies over financialization at this current development stage. Let me welcome to the program the Vice Chairman of the Niti Aayog, Mr. Suman Berry. Mr. Berry, many thanks for joining us. We wanted to talk to you about the growth assumption that the survey makes, but let me get you to address what we've just pointed out, something that the survey has highlighted, something that we've had both the Reserve Bank Governor as well as the SEBI chief also allude to over the weekend. Significant rise in retail investors in stock market calls for careful consideration. Possibility of overconfidence is leading to speculation and expectation of greater returns. The financial sector should expand at a pace that is in lockstep with economic growth. India can ill afford economies over financialization at its current development stage. What do you make of what the survey is saying, particularly on this front, Mr. Berry? And would you expect that we could then perhaps see some measures being brought in to cool things down?
Shirin, these were matters on which I used to take an interest, but they're not part of my current responsibilities at Niti Aayog. But just as a development economist, a few reactions, if I may. First, India has a much lower credit to GDP ratio than other countries, certainly China. And so I think gradual increase in financialization is a reasonable prospect. And how to create safe assets and how to make sure that the casino dimensions of markets don't overwhelm their resource allocation role, that is certainly what the joint actions of the RBI and SEBI are directed to, and I think we've been doing it fairly well. I would make one point, which is that, having been around at the RBI at the time when we abolished the control of capital issues and started opening up equity markets, we opened up equity markets, but not debt markets, to foreigners on the ground that they would bring discipline, and when they exited, if they exited in a rush, they would bear capital losses. What is happening at the moment, and I think this is the thing we need to prepare for, is that even as foreign investors, portfolio investors, head for the exits, now there are a lot of domestic investors, so as it were, the impact is not showing up on equity prices. And so there is a risk that less experienced, less professional investors will be left, as it were, carrying the can as the more experienced investors exit. So briefly, we must aim for greater financialization of the economy, because otherwise, coming to something that the economic survey in Chapter 5 does talk about, we are not going to have the depth to finance our increased investment requirements, and that is going to have to come domestically. So that's a good, not a bad. India could, in time, even be a provider of financial services to the world if the world becomes safer. But there are short-term issues that the regulators need to keep track of.
Yeah, Dr. Berry, thank you very much for that. I nevertheless want to add to what Shireen has said about the stock market. Shireen, actually in page 64 of the report on financialization of markets, the CEA goes on to say that India's market capitalization has seen a remarkable surge, and market capitalization to GDP ratio is now surpassing that of other emerging market economies like China and Brazil. And that's where he says, and I'm quoting from the report, it is essential to strike a note of caution. The market capitalization to GDP ratio is not necessarily a sign of economic advancement or sophistication. Financial assets are claims on real goods and services. If equity market claims on the real economy are excessively high, it is a harbinger of market instability rather than market resilience. Now, this is not really going to F&O. He's only talking about the stock market, the cash market surge. And even over there, he's pointing to instability. And then, of course, goes on to retail participation, not just through mutual funds, but also outside the mutual funds. I just thought I'll add to what you pointed out.
No, absolutely. But let me bring Mr. Berry back into the conversation. Mr. Berry, let's talk about what the survey now suggests as far as growth is concerned. And by all accounts, on the lower side of what other private forecasters are forecasting at 6.5% to 7%. And the 6 priority areas that the survey has highlighted, which the government as well as the private sector need to focus on in order for us to be able to get that sustainable 7% plus kind of growth rate to achieve the Amrit Kal objectives. Your take on the growth roadmap as well as the fiscal roadmap that the survey alludes to?
Yes. Well, first, the survey coincides with our findings at Niti Aayog, which is that for at least the last couple of decades, we have ups and downs. We have maintained a long-term average growth rate of 6% already. And that is, I think, very impressive and speaks to maturity of institutions and maturity of a decision-making structure. Now, the question or the distinction I want to draw for your audience is between the 6 or 7% that you and your earlier commentators were talking about for the coming year and the kind of growth that we are concerned about and thinking about Viksit Bharat. Broadly speaking, short-term cyclical fluctuations are driven by short-term demand, including demand from abroad, exports, and what have you. But when you have 6% sustained growth over 20 years and more, I'm talking about pre-COVID, obviously, this reflects developments on the supply side, and more detailed work that has been done by the RBI and I think by the World Bank as well suggests that actually it's been a reasonably healthy growth story with productivity increase playing quite an important part. Indeed, when I was chief economist of Shell and I looked at India, amongst other countries, the thing that struck me is that India is a pretty balanced economy. We don't have, except for one area, fiscal, which you raised, and which I'll come to, namely that we don't have large current account deficits. As the economic survey notes, our growth inflation trade-off has in recent years been better than the pack. So the point I'm making is that in the issues that arise in Chapter 5, which is financing longer-term investment, largely domestically, what is it that we need to change, or what is it that needs to change on the macro side, quite apart from the micro issues that the survey raises. So, I think 7%, I would say that the overall tone of the survey is commendably balanced, sober. It's not a rah-rah document, and I don't think it has been for the last couple of years. But still, we see ourselves as aspiring to becoming an advanced economy in the next 25 years. And so the questions are, what does that take on the supply side? And I think we'll get some answers to that in the budget tomorrow. I hope that the budget will pick up on some of the themes of the economic survey, which I think are very well chosen and very succinctly put.
Okay. Dr. Berry, I just wanted to ask your own view, or Niti's view as a macroeconomist. The survey is only looking at 6.5 to 7, and they actually point out that FY10 to FY20, that is pre-COVID, the average has been 6.6, and that is why they are looking at 6.5 to 7. Do you think they're being too conservative? Do you think that it would be better? RBI's estimate is 7.2 for the current year. Do you think that you would have given a higher target or a higher forecast?
As I say, enough people, including those people on your panel, follow these, as it were, cyclical things. So I think the underlying question is, longer term, can we aim to up the 6.5 to 8? And what would that take? And there are discussions of that in the economic survey, with which I agree. A lot of it has to do with energizing the MSME sector, having a skill development agenda which is more impactful, remediating some of the shortages of skills and human capital in our university graduates. Look, I mean, the fundamental is very clear. This is an Amrit Kaal because of our labor force, our demographic dividend. India's essential asset are its human resources, as was the case with Korea, to some extent was the case with China. And the question is, do we have a machinery that is able to get the most out of these human resources at rising levels of productivity? A lot of that labor is, I wouldn't say trapped in agriculture. Indeed, it's now the case that for rural households, agricultural income is a smaller part of their income. But the fact of the matter is there are productivity gains to be unleashed if our human resources, both current and prospective, can be better matched to new opportunities. That's the long game, and if we get it right in a more complicated world, I do think that we can aim for more than our historical 6.5, 7. So another way of putting it is all that is happening geopolitically around the world a reason to lower our domestic ambitions? And my answer would be, I don't think so.
Well, speaking of, what is happening globally, and here's an interesting take from the economic survey, Dr. Berry, and I wanted to get your comments on that, on dealing with China. And the survey is essentially calling for a review of India's strategy on FDI from China. In fact, it says, will China +1 result in total movement of trading relations away from China? This may not be the case. Take, for example, nations like Mexico, Vietnam, Taiwan, and Korea, who've been direct beneficiaries of US's trade diversion from China. It says India faces two choices to benefit from China plus one. It can integrate into China's supply chain or promote FDI from China. Among these choices, focusing on FDI from China seems more promising for boosting India's exports to the US, similar to how the East Asian economies did in the past. Chinese companies invest in India and then export the product to these markets rather than importing from China, adding minimal value and then re-exporting them. Your view, Dr. Berry, on the call for a review as far as the China strategy is concerned?
Well, you know, we share a common border, unfortunately a contested border, with the second largest economy in the world. Okay? Mexico shares a border with the largest economy in the world. Now, it is certainly unfortunate that for reasons that we have no control over, that there are diplomatic issues with China. And it is unfortunately also the case that some of these, if you like, disagreements have arisen because of the very large economic gap that has opened up between us and China. The question now is, and it's an important question, it's a question even the great United States is grappling with, how is it that you benefit from being a neighbor to a technologically sophisticated and substantial market on your border without losing strategic autonomy? I think it can be done. This may not be the best time to do so, but I think over the longer run, one should be looking to a future where the Indian and Chinese economies are perhaps even more integrated than they are, noting the fact that after the US, I think I'm right, China remains our second largest trading partner. And the question is, I know Nifty has not explored what it would mean to de-link ourselves from China, to demote its status amongst our trading partners. I think I just happened to glance briefly at the economic survey, but if I heard you right, there is a concern about being part of value chains that end up in China. I think that's a reasonable concern, and I think that that was one reason why India chose to go a different direction of higher domestic value added and not being part of global value chains. And I think this was probably also one, although not the only reason, why we chose finally to back away from the RCEP agreement when we did. However, let me point out make two other points, if we're not out of time. First, let us be clear that our services sector is already a very important part of global value chains. The so-called global capability centers, the GCCs, what is that other than being a part of a global value chain? And let me also say that both with Prime Minister Modi's visit to the US, the state visit in 2023, and and the External Affairs Minister's very energetic diplomacy with Europe, with the creation of IMEC, that there are value chains directed to the West that we should be exploring and making sure that our domestic policies and our domestic lobbies, to be honest, don't prevent us from being part of those value chains.
Fair point. I think that is what the survey is suggesting as well. But Dr. Berry, before we let you go, at this point in time, we will, of course, know what the fine print of the budget looks like tomorrow. But is there a case, to your mind, that there be a higher number as far as private capex is concerned over what the interim budget had suggested? Is there a case to do more to provide sweeteners to the salaried class by way of tax SOPs? I just want to understand from you where you believe there is a legitimate case for the government to spend some of the additional fiscal cushion that it is now provided with.
Shirin, my only response to that, I mean, I am a taxpayer and I have a vested interest, but I would just say that firstly, I mean, they talk of a review of our policy towards China. For a long time, review of our direct tax code has been pending. And what better time than the start of a fresh administration, a new government? Because I think the compliance dimensions of our tax code are very, and not to mention the GST as well, these are high burdens compliance, not just the incidents, on our MSME sector. So if, as the survey rightly argues, jobs are to come from the private sector, and much of our private sector is in the MSME area, I think simplifying the tax code is frankly more important than giving away SOPs, although I know that will be all of the attention in the pink papers when, once the budget has been presented. And, there was a direction of change, and I think it hasn't, which is that indirect taxes are regressive. Direct taxes, if paid, are a way of getting progressivity. And so if we can return to a steady path of, on the whole, with higher tax ratios, moving from indirect to direct, I think that's the direction in which policy should move.
All right, Dr. Berry, we will leave it there. Appreciate you joining us here today to help us make sense of the economic survey. We look forward to speaking with you tomorrow when the Finance Minister presents her 7th consecutive budget. Appreciate you joining us here on CNBC-TV18. That is the Vice Chairman of the Niti Aayog, Dr. Suman Berry. Well, a quick check as far as the markets are concerned. At this point in time, you've got the Sensex down by over 100 points, 109 points, and the Nifty Bank is just flat at the moment. We are going to take a break and return with the market coverage and more analysis of the economic survey. Don't go anywhere. We're back in a moment.
Although those cash balances are now coming down because they're spending a lot on Nvidia chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. From a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform?
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. For the markets, it's a day of consolidation. We did see a massive recovery from the lows, from the starting lows, but from then we have fallen a bit. So the Nifty absolutely flat with some negative bias. It's down 15 points. The Sensex is also flat. Midcaps are flying today after that decline that we saw in last two trading sessions. So that index is up around 800 points, but Bank Nifty is the one which is in the green but underperforming the benchmarks. But again, as I said, all the action in the mid-cap index, Vivek.
All the action in the mid-cap index, and like you mentioned, the opening dip was bought into quite significantly, and the Friday lows and the Friday fear that we saw is something that's not being replicated today. Quite a lot on our show lined up. First up, this is our special segment, Mid-Cap Movers, where we have Hormuz to take us to the mid-caps that are moving in the session.
Some bit of rebound coming in within the broader markets after the fall that we saw across Thursday and Friday. So good going there, but can't say the same for the benchmark indices, being a little bit on the edge ahead of the budget announcement tomorrow. But some earnings reactions, there are plenty of them. So Indian Hotels, the top gainer on the mid-cap index right now, 8% higher after its results. Oberoi Realty as well having a good day, 4.5% higher there. Dodla Dairy's results came out today. The stock is off the highs of the day. At one point was up almost 15-16%, but that still trades with gains of around 7%. And Canfin Homes is also reacting to results on the negative side, down almost 2.75%. PSUs are staging a rebound in today's session, and shipbuilders are the ones that are leading the charge. Masgao Garden Reach signed an MOU today, so a couple of them actually, so 5% there as well, and Cochin Shipyard as well, another 5% upper circuit. The non-shipbuilding PSUs are also having a good day in today's session. Most of the stocks on the PSE index are trading with gains. HAL has snapped a 3-day losing streak. It fell almost 15% in 3 days, up 5% today. BHEL, REC also having a good session today, gains between 3 to 4%. Some stocks moving around on the back of volumes, and those will come up on your screen. Kenpla Samnar is back on that list now, 4.5% higher on strong volumes. Alembic Pharma has been having a good last couple of sessions, was up around 6 to 7% on Friday as well. That's up another 3% today. Atul, after its results, is up almost 6% in today's session on strong volumes, and Chalet Hotels 5% higher today as well. Some stocks that are not doing well within the broader markets, and Oil India is one of the PSUs that is bucking the trend in today's session, and some of the other losers as well on your screen. But Oil India is one of those stocks that is not having a good day in today's session.
Okay, all right. It's run up so much so far, right? So some profit booking is something that is on the cards. Thank you so much, Hormaz, for joining us as always with that list. Let's talk about some earnings reaction now. Supreme Industries is the first management on the show, reported its decent set of Q1 numbers just a while back. We have Mr. MP Tapadia, the managing director of the company, joining us now. Mr. Tapadia, good afternoon. Thank you, sir, for joining us today. But it's a good set. You have seen a 17% volume growth this quarter. Do you stick to the 20% volume growth guidance that you had given for FY25? And also in terms of pricing, the polymer prices, have they corrected now in the second quarter? What is the trend that you're seeing in prices so far?
We are maintaining still the volume growth of 20% for the company and 25% of plastic piping. And the raw material prices, the PVC price has gone up. Now we are seeing correction taking place. So we remain quite comfortable on the range-bound pricing of polymer going forward.
Mr. Tapadia, could you quantify the kind of softness that is being seen from the last quarter to the previous quarter as far as the raw material price is concerned? And second question is, how is the demand being as far as the plastic piping segment is concerned? What is the total contribution it has as a part of the overall top line?
Now, plastic piping business may reach around 8,500 crore. Total turnover of the company may be between 12,000 to 12,500 crore.
Okay. So, as my colleague also asked, how are the demand trends now? Is Q2 so far turning out to be better than Q1? Because now we've started seeing that rainfall come back and no deficit so far. And what about the rural area in particular? Are you seeing green shoots come back there?
Normally, in second quarter, demand from agriculture segment goes down with this rainy season. But from demand from housing side is quite okay. We anticipate good demand now emerging from infrastructure, especially for drinking water supply and for irrigation purpose. And now we are entering into gas pipe system. So we anticipate good demand growth coming from infrastructure.
Mr. Taparia, the guidance that you have given for the volumes actually comes off quite a strong base. So you're continuing to stick to the 20% volume guidance, number one. Number two, can you give us a sense of what will be the contribution of the value-added sales to the overall top line? Because we understand that you enjoy higher margins over there.
You see, value addition in the first quarter, we have grown by 21%. And overall, for the year, we maintain that we will have a 20% volume growth. And in plastic piping division, we will have 25% volume growth. For this year, now we have got several expansions taking place brownfield. So these expansions are taking place month after month. Apart from brownfield expansion, when we opened the account result this year, we announced 3 greenfield sites. Now we expanded to 6 sites. Principal among them is we are putting a new site at Jammu in Kaswa district. We are putting a new site in Malanpur, and we are negotiating land parcel 31 acre near JNPT port. So we will be now working this year on 6 greenfield sites, 5 plastic pipe division, and 1 for our packaging division.
Yes, the press release also talks about a lot of capex which is coming on stream, sir. Just wanted to understand, is it all that you'll be doing in terms of capex? You have 1,500 crore rupees capex planned as well. Does it cover all that you told us about, the 6 greenfield expansion plans coming in, or there are more on the cards, something that the street can look forward to?
No, when we say 1,500 crore capex plan, that means commitment we expect to make in this year. All the money may not go in the ground because machine delivery takes time. And last year, we invested in the ground more than 550 crore. This year also, we anticipate our investment in the ground may be close to 1,000 crore, actually. But our commitment will be 1,500 crore. We had a cash balance of 1,245 crore as on 1st July this year. So everything will be done from our internal accrual.
Okay. Mr. Taparia, 2 questions that I have, if you could answer us. First one, talk to us about the kind of order win that you've got from IOCL as far as the composite LPG cylinder division is concerned. We believe that you have a 2 lakh, LOA that's already been signed. What is the size of the total order and what is the opportunity that can come ahead? And the second question, a quick comment on what our expectations are from tomorrow's budgets. Most of the brokerage highlight your particular company as a key beneficiary of any capex that could come about as far as housing is concerned.
First question is about the IOC. We are very happy on this IOC order of around 235,000 cylinder worth 55 crore rupees. And we anticipate the economy will get further boost in the upcoming budget tomorrow. Government is going to give more incentive for manufacturing. Government is giving more incentive for infrastructure. That you recall very much that on the day the government took over, they first announced new housing construction for poor people of 20 million numbers. And we anticipate the number of housing they will construct this year may be more than 20 million number, and each housing additional requirement will give further boost to our plastic piping division. So we remain quite optimistic on the budget which is going to come tomorrow.
Yes, all eyes will be on the budget. Mr. Taparia, last question before we let you go. You have expanded and introduced various new models of chair and cabinet in the furniture segment. You've added around, the total showrooms are around 319 right now. Will some of the capex go in more store additions this time? What is the plan with the packaging segment where we have seen a big increase in margins and this particular segment as well?
We are investing more money in protective packaging division. We are also investing in a new product, cloth plastic, in this year. We are also going to expand capacity of cloth laminated film. So in packaging segment also we are going to make further investment. We are actually going to invest in all the remaining 6 segments, also some small money, but major money will be invested in plastic piping division. And as you are aware, we are putting a new division of window where we'll be investing more than 150 crore rupees this year. Where we'll be making window at 2 sites, one at Kanpur and second at Kharagpur in Bengal.
Okay.
Thank you so much, Mr. Taparia, for joining us and giving us details about how Q1 was and what do you expect for the rest of the year. Let's now slip into a short break. The management of Supreme Petrochem joins us next to discuss the Q1 FY25 results and the way forward for the company.
Journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Welcome back to Mid-Cap Radar. The Mid-Cap Index today is up 1.4%, comfortably outpacing both the headline indices as well as the Small-Cap Index too today. But we have management on the show. Supreme Petrochem is the next management. It reported a good set of Q1 numbers on a year-on-year basis, but sees a dip in EBITDA and PAT on a sequential basis. To discuss this and more, we have Rakesh Nair, the ED at Supreme Petrochem, who joins us now. Good afternoon, Mr. Nair. Thank you so much for joining us. First up, could you shed some light as far as Q1 is concerned, and could you explain the reason behind the softness that we are seeing on a sequential basis, both on EBITDA as well as on the profitability?
Thank you for having me on the show. In the quarter, if we look at the year-on-year basis, our volumes have increased by over 20%. Our domestic volumes are increased by 30%, but there was downfall as far as the exports are concerned because of the West Asia crisis, which led to the steep increase in the freights. As far as on a sequential basis is concerned, always the January to March are the peak months when the OEMs have a large demand. But then that has also resulted in the marginally lower volume growth in the quarter.
Okay, all right. So the quarter-on-quarter demand is lower, and that's the reason you've seen that sequential dip, which is not that big. But considering the YOY increase that we have seen, just wanted to understand what demand is looking like. Let's talk more about the export bit, Mr. Nair, because you did speak about how the freight rates going higher is impacting that business. What are the conversations with your clients suggesting? Will this go on for a bit? Because despite that, volume growth overall has been strong. So what does that mean for FY25 volume growth for you?
No, we hope to still maintain our 8 to 10% volume growth for the year. And that is the guidance we had given in the previous quarter. We still hope to maintain the same.
Okay, and the conversations with your export clients, are you seeing any delay in orders, or is it just the freight rates rising and that's why you're seeing a shift from a quarter to the other?
Yeah, that's right, because of the freight rates going up. So there is a little subduing in the exports because the prices, otherwise the landed cost goes up substantially high. So people are waiting and watching. But then some of the customers have reconciled to the idea of the higher freights. And so the exports are there, but it is at the reduced level.
Okay. Tell us about the CAPEX plan that you have for enhancing compounds as well as master batches. What is the kind of CAPEX you've committed over there? And typically in your industry, what is the asset turn that we can expect from this particular CAPEX?
See, we have right now currently the CAPEX on 3 fronts. One is on the mass ABS, other is on the second phase of our expandable polystyrene, and third is on the master batch and compound business. So as far as the overall annual CAPEX is concerned, we expect that we would be incurring on the ground an expense of around a CAPEX of 350 crores. Now coming to the asset turn, as far as ABS is concerned, we expect that the asset turn for the phase 1 would be around 2. And as far as the EPS is concerned, we would have an asset turn which would be closer to 3.5 to 4 times.
Okay, all right. You know, the other agreement that you've entered into is for license and basic engineering design with Versalis Chemicals Group for phase 1, where the capex is around 850 crore rupees. Give us more details on this. When does it get commissioned? What is the revenue potential here? What kind of nature of this agreement really is?
So this is an agreement which we had entered in the last year, and this is for our mass ABS project. And the mass ABS project goes on stream by the end of the current financial year, that is by March 2025. We hope that it will be commissioned. And Versalis is one of the leading companies in the petrochemicals, and there is no royalty element involved in it. It is just the one-time payment of the technical know-how as well as the basic engineering package. And that's what I mentioned in the earlier also, that there are 3 streams where we are spending money. One is the mass ABS, other is the second phase of the EPS, and also the master batch and compounds. And as far as the top line is concerned, once this project gets commissioned on a full capacity basis at the current market prices, it should be adding over 1,000 crores to our revenue.
Okay, so 1,000 crore opportunity is what you're seeing from this particular opportunity. Now, talk to us about how styrene monomer prices are moving currently. We understand that there has been an increase, and what is the quantum of the increase? What is causing the increase? And could you give us a sense of the current raw material pricing scenario?
The styrene prices have been stable, more or less in a range, but then there is a trend upwards there because the benzene prices, which is the raw material for styrene monomer, that has gone up. So that is the pressure on the styrene monomer. Otherwise, the availability-wise, the styrene has been very normal, and also the trend, this price is stable, but okay, it has increased by say $30-40 during the quarter. That's it.
Okay. All right, Mr. Nair, always a pleasure speaking with you. Thank you so much for joining us today and detailing these numbers. So that's the word coming in from Supreme Petrochem, but we'll slip into a break. As we do that, we strive to get you the best of market and macro voices ahead of the union budget. Tune into CNBC TV18, 9:05 a.m. onwards and budget day tomorrow. We'll be live from the National Stock Exchange with Morgan Stanley's Ridham Desai, Nilesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSE MD and CEO Ashish Kumar Chauhan. We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you. Welcome back. Still tuned into Mid-Cap Radar. There is some recovery that we are seeing from the lows. Nifty is back into the green, but it's quite flat as we speak. From the broader markets, we have some of these fertilizer names which are doing really well. And ahead of budget, that is the usual trade that you see anyway. NFL, RCF, we have Madras Fertilizers, Pact, all of them up anywhere between 7 to 12%. And in fact, this year itself, these stocks have done really well. NFL, for instance, is up 78%, RCF is up around 48%, and that trade continues as well. The mid-cap index, that's surging 1.5% higher. Bank Nifty has come off from the highs, so it's up around 45 points. But yes, still in the green for that one. And we keep getting numbers coming in. A while back, it was IDBI Bank, and now it's UCO Bank, which is up around 2.5% in trade. But with that, we'll do one thing. We'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return.
Big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector, the CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no clue. I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just. It's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. From a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will get more and more out of control until the markets revolt against it.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Hello and welcome to Your Stocks in the Mumbai News Studio. I'm Ekta Batra. Well, it's turning out to be a session where we are seeing some amount of consolidation ahead of the big budget tomorrow. However, we have the mid-cap index, which is managing to hold up, so up around 1.4% currently for the mid-cap index. We do have the Solara numbers on your screen. The net loss has reduced to around 13.5 crores versus a loss of 19.5 crores year on year. So that's the reason you're seeing the stock up around 2.3% on the back of that. But joining us today, we have Astha Jain, research analyst at HEM Securities, Richard Jain, who is following the technicals as well at 5paisa.com to answer all of your queries. Astha as well as Richard, welcome to the show. Well, Richard, before we kick it off in terms of queries, wanted your thoughts in terms of how you would approach today's trading session, especially ahead of the budget. Any specific stock-specific, sector-specific calls that you would be taking?
Yeah, hi, very good afternoon. So if we look at the markets, I think post the election results, we have already seen a good run up before this big event of budget. So we believe that more or less some much of the positivity which could be seen in the budget has already been factored in the market. Now technically, if I see on Friday's trading session, there was a bearish engulfing pattern which was formed on Nifty's daily chart, and the momentum readings, that is RSI oscillator, is also in the overbought zone. So Ekta, we are a bit cautious on the markets at current levels, and we are not advising to put any fresh investments for now. It's better to see the market reactions post the budget, and we would expect some sort of correction happening post the event. So I think these are good levels to book at least partial profits and take some money off the table and revisit the situation post the event for fresh investments.
Okay, all right. Well, let's get in some queries now. We have LG Gopal, who writes to us from New Delhi, holds 800 shares of Infosys, which he's bought at around 1,200 odd rupees. He's sitting on a good profit there. He wants to know what to do, whether, what his outlook on this particular holding would be. Astha, well, it was broad-based growth. The management has upgraded its guidance for FY25 as well. So that was the positive for Infosys. But nonetheless, how would you approach the stock, considering that, the person who's writing to us, Mr. LG Gopal, in fact, is sitting on a profit now?
Hi, good afternoon to both of you. Talking about Infosys, the results were good. And what was the eye-catching? The result is their deal wins, $4.1 billion around. So I think that was really fabulous. So deal wins were strong, and in fact, management has upgraded their guidance also. And going ahead, the kind of environment improvement we are seeing, especially in the North America and Europe, that will going to benefit the company, because we have started seeing some of the improvement in their verticals also, especially BFSI vertical. So if I combine all these points, I think it is signaling towards more upside from here. And that's why our call is hold on the counter with the immediate price target of around 1950.
Okay, immediate target of 1950. What about you, Richard? Technically, how would you approach Infosys? What would your target be on that one?
So the most wonderful part of this position is the buying price, because it's almost near to that lows which we have seen in this recent corrective phase in the month of April. And the good thing is that the worst seems to be behind is for most of the large cap IT, many of the large cap IT names. I won't say all, but Infosys, yes, it has started forming that high top high bottom structure on the a bit mid to longer term charts also. So I think in case of any correction also, now 1700, 1650 would become a very strong support for the stock. So I think it's a good it's a good buying level. So it's better to ride this trend on a positional basis. I think Infosys has potential to test its previous all-time highs, which was around 1900, 1920 kind of range. So better to ride this trend, and in case of any corrections, I think he has a good margin of safety to hold on in this in any kind of volatile times.
Okay, all right, got it. Anushri now writes to us from New Delhi, holds 50 shares of Tata Technology, which is bought at around 1,065. She's a long-term investor, wants to know what to do, whether to hold or sell this particular counter. She's sitting on a loss at this point in time. But from a long-term perspective, what would your approach be towards this, Astha? How would you approach Tata Technologies?
Although we have seen some sort of softness in these stock prices, but I think long-term is looking bright for this company, and we are recommending hold on this counter with a price target of around 1100. Talking about this counter, first of all, it is into the automotive R&D, that is engineering, research and development space. So, I mean, that is a very strong space to cater on. And now they have become a strategic vendor to 12 new energy startups. So again, now all these things are really helping the company in showing strong financial performance going ahead. So we are thinking that the future prospects are brighter for the company and hence recommending hold. Initial price target can be set at around 1,080 to 1,100 levels.
Okay, all right. And technically, Ruchit, what's your approach towards Tata Technologies? It's been, sluggish on a year-to-date basis. It's down and out. So what would your approach be technically?
So limited historical data, but no post-listing, we have not seen any kind of high top, high bottom so far in the stock. So the technical structure is not that positive, and even the recent pullback moves which we had seen had faced selling pressure, and we have not seen any kind of high volume-based buying coming in the stock. So my advice would be to keep a sell on the rise approach, and in case if we get any kind of pullback moves in the stock towards its recent swing high of 1,050, then it would be good to take an exit position from this position and make a shift to some other sector.
Okay, all right. The other query now we have is on IRFC. That one has been a multi-bagger. Praveen writes to us from Karnataka, holds 4,100 shares of IRFC, which he's bought at, I think, around 47 odd rupees. And he's asking whether he can hold for another 6 months or book his profits. Well, that's the key question for a lot of these PSU stocks, may it be defense, may it be within the railway space. And even a couple of these PSU banks, the key question is that people are sitting on a good amount of profits. So should one probably prudently take some money off the table? Or do you think that it's set up for more? Ruchit, you go first.
So Ekta, I think it's a good time to take some money off the table. We have seen a very good run up in many of the PSU names, such as defense is there, railways are there, and it's not that the trend is negative, but since the stocks have already seen a good run up before the big event, so I think there could be some profit booking once the event is over. That would, of course, not change the larger degree trend, but in case if anyone is looking for fresh buying, then the risk reward ratio is not favorable at current levels. And since he's sitting at good profits, I think it's wise to take at least partial profits off the table over here.
Okay, all right, fair enough. And what about the fundamentals? What would your approach be towards it, Astha?
So I would really like to see tomorrow's budget because the major factor which will play an important role here is the budgetary allocation to the railway sector. As we all know, it is the sole market borrowing arm of the Indian Railways. So we really need to see how this budget goes out for the railway sector, especially the budgetary allocation. But talking about other fundamentals of the company, it is a low risk cost model. So I think that is really working in favor of the company, and they are showing incrementally strong margins also. So we are positive on this counter, provided the budgetary allocation to remain strong as it was in the past. So tomorrow will be key to look out for this company as in particular. But I think meanwhile one can remain invested in the counter with the initial price target of 220 to 225.
Okay, all right. So you could probably remain invested in IRFC for now, but budget will become a crucial standpoint for this particular stock. Ashutosh Bose writes to us from Kolkata, holds 300 shares of Zomato, which he's bought at 68. Long-term investor wants to know the future prospects of this particular counter. Well, Zomato is sitting on a good profit at this point, and the buy price has been quite attractive as well. Astha, what is your sense in terms of Zomato? Numbers would be a key trigger, but nonetheless, as a long-term play.
So as a long-term play, it remains strong, and we are recommending hold as well as buying on dip strategy can also be applied since markets are volatile. So first of all, would like to give the target, which is around 240 to 245 odd levels. So hold as well as buying, both are recommended for this counter. Talking about this counter, I think there are some of the segments like Blinkit is really working very strong for the company, and the number of store additions will be a key growth driver going ahead for FY25 because company intends to double the store count. In fact, being a diversified player because they are into the various segments, the company has shown strong performance already in their financials. And going ahead also, we are expecting this counter to perform well because they are now planning to increase their penetration in the tier 1 cities also. So I think whatever the steps which company is taking right now will be definitely benefiting the company in future. Remain positive on this counter with the price target of 240 to 245 at the initial level. and hold as well as buy can be recommended for this company.
Okay, all right. And technically, it's given decent returns on a 3-month basis also, if you look at it. So what would your recommendation be, both short-term as well as long-term, Ruchit, on this particular counter, on Zomato?
Yeah, so the technical trend seems to be positive only because the stock has consistently been forming a high top, high bottom structure since last 1 year. Recently, post that last quarterly results in the month of May, we did see a dip in the stock towards 150 kind of levels, but again that dip was bought into, which clearly indicates that a strong buying interest is there in case of any kind of declines in the stock. For the short term, 245 is the targets as per the retracements of previous correction, which could be expected. So I would recommend to continue to hold on and take a review again once the stock approaches that 245 level.
Okay, all right. Well, that's on Zomato. That's given good returns as well. 66% return in the past just couple of months. Well, for the markets, it's just about holding flat at this point in time. The Nifty Sensex as well as the Bank Nifty absolutely flat. We have the mid-cap index, which is managing to hold up with a gain of around 1.3%. Advanced decline ratio in positive terrain, which stands at almost 2:1. But you'd have to say just a marginal gain at this point. Advances at around 2,200 stocks to declines at around 1,950 on the Bombay Stock Exchange. We'll take a break, but as we do that, we strive to get you the best of market and macro voices ahead of the union budget. So tune in to CNBC TV18 at 9:05 a.m. onwards on Budget Day tomorrow. We will be live from the National Stock Exchange with Morgan Stanley's Rhythm Desai, Nilesh Shah of Kotak KMC, Prashant Jain of 3P Investment Managers, and NSE's MD and CEO Ashish Kumar Chauhan.
Importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lad Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
Welcome back. You're still tuned into Your Stocks. We have with us Asta as well as Richard to answer all of your stock queries. Well, let's get in another question now. We have Anil who writes to us from Hyderabad. He holds 100 shares of Trent, which he's bought at around 1,500 odd rupees. He wants to know what to do, whether to hold or to sell at current levels. Well, this is a stock which, where the debates go on and on about, the kind of a multi-bagger it's turned out to be. So, Ruchit, I wanted your thoughts first on the technicals of the stock. What would your target be from these current levels of around 5,000 odd rupees, almost 5,200 odd rupees? What would your stop loss be?
So I believe that the stock has seen a good run up, and from that overbought setups, it has started correcting since last 3 or 4 trading sessions. So the stock may go through some time-wise corrective phase in next few months or next few weeks, where the stock would consolidate within the range of 4,700 on the lower side and 5,600, 5,500 on the higher side. So we expect the stock to show some consolidation within this broad rate, and since he is sitting on good profits, I advise to book partial profits over here, and for rest of the positions can keep a stop loss below 4,700, which is a crucial support.
Okay, all right. And technically, what would your fundamentally, what would your approach be on this one on Trent, Asta?
So we have seen strong financial performance from this counter, especially due to Zudio, because it has shown the stellar performance. Going ahead also, I think the company will continue to perform better, because what we are seeing that they have gaining the market share, continuously gaining the market share, especially in the retail apparel segment. In fact, their SSG, that is same store sales growth, is also strong. And going ahead also, we are expecting strong footprint addition in this counter. So we are expecting this counter to continue to perform strongly, and hence we are recommending hold. Initial price target can be set at around 5,700 odd levels.
Okay, 5,700 odd levels. When would you possibly expect those target prices to be achieved?
Maybe let's see the results first. So maybe the time frame can be set at around 2 to 3 months.
Okay, all right. 5,700 on the fundamentals is what Asta is looking out for on Trent. Well, Veer Matu now writes to us from Bhopal. He holds 20 shares of Dixon Technologies, which he's bought at around 12,600. So he's sitting on a loss. He wants to know what to do. What are the future prospects? Well, fundamentally, do you look at Dixon Technologies, and what would your call be on this, Asta?
Yes, we are recommending hold on this counter with the price target of more than 12,000 odd levels. So talking about this counter, Dixon Technologies has shown strong performance, especially their mobile segment, which contributes 50% of the top line, is working strongly. Going ahead also, the company will continue to show strong growth in their other products mix. So we are expecting a strong performance to be delivered by this counter in their results also. Recommending a hold with the initial price target to be set at around 12,000 to 12,100 odd levels.
Okay, 12,000 to 12,100 odd levels. It's given good returns, technically. It's up around 50% in just the past 3 months. What would your call be on the technicals of this counter of Dixon Technologies, Ruchit?
So that's what even I was noticing, that the stock had already seen a good run up, and the buying price I think is at higher levels. Maybe chasing the stock because of fear of missing out. But I would advise now to keep a fixed stop loss below 10,900 first, because the stock has entered some kind of corrective phase which could last for a few weeks from current levels. If it's a long-term position, then there is no doubt that the long-term trend remains positive, but the momentum readings are getting corrected from that overbought zone. So for next few weeks, do not expect any significant run-up in the stock. One should keep stock below 10,900, and in case of any pullback moves at higher levels, the resistance would come around 11,800 to 12,000, where one should again take a review whether to take an exit over there or not.
Okay, well, we have another stock which has seen a good run-up, and that's the next query that we have. We have Dinesh, who writes to us from Hyderabad. He holds 1,050 shares of Infibeam Avenues. He's making a loss on it, but nonetheless, the stock has given good returns. He wants to know what to do, whether to hold or sell at current levels. He's looking at a 3-month horizon. So this is just up your alley in terms of the technicals. Ruchit, what would your recommendation be?
technical structure for short to medium term is not that positive. Before we see any kind of next leg of up move, I think the stock would see some more correction towards 25, 24 and a half kind of levels. So my advice would be to take an exit from the stock at current levels and review the stock if you want to enter again if the stock comes in the 24 to 25 zone.
Okay, all right. If it comes back into that 24-25 zone, Astha, what about you on NVB? I know it's a 3-month horizon, but fundamentally?
So we are keeping our eyes on whatever plans the company has mentioned in the previous con calls. So they have plans to expand internationally, especially in the Saudi Arabia, UAE and US. So that is a good thing to, look after the company. Their strategic acquisitions, we really need to look after how that will be working. And most importantly is the net take rate. That is net take rate. Companies aiming to double net take rate by FY25. So we really need to see how the company is performing on all these parameters in their results, upcoming results. So meanwhile, one can stay invested in the stock. If everything goes well according to whatever management is guiding, I think company can, stock can show the price momentum towards upside with a price target of 31 to 33 at the current level.
Okay, all right. Well, we now have Velu, who writes to us from Tamil Nadu, holds 10 shares of Polycab, which he's bought at around 4,584. So he's sitting on a profit there. And he wants to know the prospects of the investments. Well, this one's seen a little bit of a volatile ride. But nonetheless, year to date, it's still given decent returns of around 15% odd. So let's start with the fundamentals. Astha, what would your approach towards Polycab be?
So what we have seen in the financial results gone by that there was a drop in the revenue. Maybe their international business was not working in the favor of the company. The reasons given by the company was that transition to their US model. So I think it will take another 1 year to stabilize. So that was one of the reason. What we are thinking that their domestic business is still working well, and the organized cable and wire market is continuously gaining market share. It is now their market share is at around 22 to 25%, which was earlier 20 to 22%. So it was now in the Q4 of FY24, it was on the higher side from 22 to 25%. So they are gaining the market share, and going ahead also on the basis of improved product mix, we are expecting company to deliver strong performance. Maybe this coming quarter, maybe not that strong for the company, but going ahead, maybe H2 of FY25 will really work in favor of the company. So keeping in mind the time period of 6 months, we are recommending a hold. Initial price target can be set at around 6,700 to 6,800 levels.
Okay, all right. And what would your target be on the technicals of the stock, Ruchit, Polycab?
So in last 1 month, the stock has already seen some correction from 7,300 to 6,300. And it's now very close to its support zone of 6,200 to 6,100. Even on the elections day results, when most of the stocks formed a decent short-term bottom, the support was taken around 6,140. So I think it's trading around its support. It's better to hold on to the stock at current levels. But yes, do keep a stop loss below 6,100 on the existing long positions, which if gets breached, then that could lead to some decent price-wise correction. So book profits either if 6,100 is breached or on any kind of pullback move towards 6,900.
Okay, all right. So that's on Polycab, which has given returns of 45% in the past 6 months. But that's all the time that we have on the show. Ruchit as well as Astha, thanks very much for joining in and giving us your perspective. Do remember, you can email us all of your questions. We'll address them with our experts. Stay tuned. Closing Bell will take you through the last hour of trade.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial market.
The weakness continues, and that is something that we can see in the Asian markets as well. Focus in the economic survey is going to be on India's growth story. On a consolidated basis, the revenue growth has come in at 11.5% year on year.
PCE data this week in the US, which will be very important.
Starts in the red. Let's see whether or not at some point of time we see an intraday recovery.
HDFC Bank has beaten our poll with respect to their P&L, both the ANA and the PAT.
24,410 or so is where we are starting.
1-2 year basis, I am not negative on the market. And
we expect now the prices to remain range bound.
अमृत काल का एक महत्वपूर्ण बजट है.
The big morning dip and the Nifty has recovered more than 200 points.
A lot of it has been the first order and second order effect of regulatory changes that have happened in the past.
India has been fairly resilient when we talk about what is happening as far as the global scenario is concerned.
So the Nifty absolutely flat with some negative bias. It's down 15 points.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, last hour of trading coming up. This is a fresh new edition of Closing Bell, and it's the last hour of the day as well. A day before the union budget tomorrow. We're coming to you as always from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues Rima and Surbi here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. In the morning, we got that dip being bought into, but thereafter things have been on the quieter side. But we're going into the big event very resilient. A 12% rally on the Nifty and the Sensex. The mid-cap index has seen a 23% up move since the beginning of the year. So fairly firm.
No, absolutely. And actually, global markets to an extent, if you're looking at Europe right now, there's a lot of green out there because markets will now start reacting to the changed political landscape in the US with, President Biden stepping out of the race. So perhaps that's adding to some some kind of exuberance over there. But I suppose for us, even today, mid-caps are almost already celebrating the budget ahead of the event, right? Large caps still a little range-bound.
No, I think that is absolutely right. But also, on that point, I was just thinking before walking in, we had the election results, right? Markets were positioned absolutely one way.
Yeah.
And so there was a bit of a shock. Not a bit of a shock, there was a large shock. So I think, that memory is fresh. So you don't want to preempt too much also.
Yeah.
We've heard from everyone it's a non-event and budget is mattering less and less. And all of that is true, but it's an event and you need to kind of sort of trade through it. So I think that is a sensible way to look at things. Just a few more points before, we bring in our guests, etc. Nifty is flat. It's not a bad market, actually. Nifty is absolutely flat, but it's largely because of some specific stocks, and that's on the back of earnings. Reliance, Kotak, and Wipro. These are large names which are down. Reliance is down 3%. Kotak is down. Wipro is down much more. So, you know, it's that kind of a pressure which is coming through. Single stock driven by earnings. On the upside, HDFC Bank is adding about 50 Nifty points. So there is a fair bit of pull and push happening. Mid caps and small caps, strong recovery. These indices sold 2.5% on Friday. Today they are up about 1.5%. PSUs within this mid cap broader market, PSUs as a pack stands out, and they're doing well. Overall market breadth is positive. 1,500 up, 1,000 down, and of course budget tomorrow. So this from a market perspective, yeah, sure. I mean, we'll get the big picture in terms of what the government wants to do over the next 5 years, and we'll see this some measures for this sector, that sector. But I think because markets have done so well, stakes are high, and I think the number one thing to watch will be whether there'll be any changes on or even review as far as taxation on equities is concerned. So some quarters, some fear, but broad expectation is that they will not tinker too much, at least not right now.
I never thought that retail speculation will take such center stage, right? You had the Reserve Bank of India, you had SEBI, and today's economic survey. I mean, it was like almost 4 paragraphs devoted to how it could be akin to gambling and, you know, it's not right, over-financialization is not good. It caught me by surprise. I don't expect that from that document, but, well, that's what we got.
Well, looks like collectively some action may come through now that all the parties are talking about it. But just a quick word on the way the large caps are moving today. So on the way down, it's Reliance Industries with a 3.5% cut, and that's at the low point. But that's pretty much the cuts of the losses from Reliance Industries are pretty much getting offset by the strength in HDFC Bank, which is up nearly 2%. Outside of that, Ultratech Cement, Grasim, M&M, NTPC is coming for some amount of buying. Wipro is the big laggard today, and ITC is subdued ahead of the budget tomorrow. Nigel.
Well, that's right. Well, let's get cracking then, and let's find out how do you trade the final hour of trade. We have our expert, Mitesh Thakur, who joins us. Well, Mitesh, for those who went ahead and bought the intraday dip, they're making some good money, both on the Nifty as well as on the Nifty Bank. And earlier today, we had pointed out that 51,800 mark is very crucial on the Nifty Bank. We bounced off that 51,850. What do you do right now? Do you take money off the table, or would you, recommend that those who have bought, they continue to hold on?
See, I think the index, has managed to hold on to the lower support levels, especially the Bank Nifty around this 51.9, 59.30 mark. So I think we got an intraday low slightly below that. But then for an index which is at 50,000 levels, 50-60 point intraday dip below support levels is not very important. So I think today's low becomes the pivot now. As long as that doesn't get taken out, I think it's all is okay. But typically as a trader, we would tend to avoid the event. So we're going very light into the event. And that is something which I would recommend for most of the traders as well. Event will come with its own set of uncertainty, and therefore, you don't know which way it will play out. And that's much more difficult to guess. But on some stock-specific basis, there's good action. So maybe focus there. PI Industries is breaking out. Buy here with a stop at about 39.70. Look for a target of around 4,200 to begin with, and then maybe even higher levels. And on the other side, I think there's some reversal happening on the charts of private sector banks. HDFC Bank, you're highlighting AU Bank and HDFC Bank, both are in focus. AU Bank is now nearing the 200 average. I would want to see the stock get past 665 and then take a long trade with a 12-13 point kind of a stop. Look for targets of 690.
Okay, thank you very much for that. Let's talk about Indian Hotels. That's moving higher as the company reports a resilient performance in an otherwise seasonally weak quarter. The management commentary on the July pickup and hotel openings also excites the street. Mangalam joins in with the details. Mangalam, 8% gain now.
8% higher in today's trading session, and that's largely because, the company's posted a resilient performance in what was a seasonally weak quarter. Remember, in the first quarter, we had the elections, and as a result of which, there was the code of conduct that took away a lot of business from all these hotels. At the same time, there was the big heat wave, which prevented people from traveling as well. And add to all of this, the large contributor to the hotel business, which is the weddings, we had lower number of wedding dates as well. So 25% lesser revenue coming in on account of, lesser wedding dates from that part of the business for the company. Despite that, what is it that the company did? Reported a record performance in the first quarter when it comes to absolute numbers. So there was a 5.5% growth on the top line. They managed to hold on to their costs, and as a result of which, margins improved by about 100 basis points to 29% as well. And the net profit reported a double-digit growth around 11.7%. Add to that, there was a slight increase in domestic occupancy by about 1% to 76%. And average room rates also increased by about 2% to just shy of the 10,000 mark. 9,900 rupees is what the company reported. But in light of this 5.5% top line growth, the company did continue to maintain their double-digit revenue growth guidance for the full year because now things are improving. They said that post the first quarter, there was a jump in demand in July itself. In fact, speaking to CNBC, Puneet Chhatwal said that July 2024 so far has actually been 20% higher over last July. That's not all. This year, they are poised to opening 25 new hotels, and they will open at least 2 to 3 new hotels outside of India as well, including a trophy asset in Frankfurt, Germany. So all these things, along with increased wedding dates in the second half, makes the outlook very good for not only the travel industry, but I'll also be watching out for what, something like the other Tata Group company, Titan or Kalyan Jewellers or Senco report in terms of the second half for the wedding jewelry as well. If wedding is supposed to be the driver of hotels, then jewelries would definitely benefit a lot more.
Okay, thank you very much for that. Dipan Mehta from Elixir Equities is with us. Dipan, the entire hotel industry has been in that hospitality upcycle. Barring the seasonality that we've seen in Q1, earnings have been strong. But the question is, at current valuations of 45 times forward multiple, what is the headroom available for Indian hotels for an investor to enter fresh?
Rima, good afternoon and thank you for having me on your show. First of all, the disclosure that we and our clients are invested in Indian hotels. And yes, I think valuation is the only compromise you have to make when you're buying such a high-class, high-growth company like Indian Hotels. And clearly, I think since Mr. Puneet Chhatwal has taken over, the growth trajectory has just gone to another level. And balance sheet quality also has improved significantly. And the company is focusing on improving its return ratios by going in for more and more management contracts. So I think the growth will sustain for several more years, considering the dynamics of the industry and the position of Indian hotels. But yes, valuations are also on the higher side. So I think investors who are invested like us, we remain invested. It's a hold, but fresh purchase only when there's a 15-20% type of a correction.
Okay, all right. Hi, Dipan. Good afternoon and good to see you. What about Ultratech Cement? The numbers are a little bit disappointing, but clearly I think the street is sending out a message. They want to be with the larger players now because consolidation is going to be taking center stage. And you don't want to risk it with buying some of maybe these small or mid-cap stocks because you don't know who's ultimately going to get folded up. What do you make of the stock? It's already had a big run and valuation-wise not as cheap as it was, say, 3 months ago when it was more than 20% lower.
Yes, good afternoon, Nigel. We can continue our discussion on commodities as usual. But I'll point out these 2-3 things. Look at Reliance's numbers, oil to chemical, commodity business. Look at JSW steel business, how the numbers have gone. And look at Ultratech also, which is a commodity business, and what the numbers have come through. So this is the reality of investing in commodity businesses. I've been doing so since the age of 16 and watching these cycles. Commodity businesses per se very easy to understand and kind of invest in them. But these cycles no one can understand. And unless you're really a long-term investor with a 5-10 year type of a view, only then you should touch these stocks and hope that they can sustain volume growth. So this is part and parcel, and none of these stocks, neither Reliance nor Ultratech nor JSW are really cheap compared to their global peers or what the historical multiples are. So from that point of view, I want to avoid all commodities and look for secular growth stories that has been the real wealth creators in India. And all these 3 companies, including Ultratech, I just want to wait and watch and maybe avoid at this point of time, be a little underweight.
Right. No, got that. That's essentially the chief economic advisor, who's of course just presented the economic survey, and we will sort of listen in just a bit from him. I think there's an opportunity for Q&A, the interaction on, of course, what their reaction is or what the perspective was, because I mean it's really strong words coming through as far as speculative trading is concerned. I mean, essentially saying that speculative trading is no place in a developing country like India. I mean, these are some of the strongest words we've heard from a sort of government body, government agency yet. I think there'll be a fair bit on that, and we'll sort of touch upon that as we go along as well. Let's come back to the market. We'll cut to the CEA in just a bit, but Wipro and Persistent are also in focus on the back of fresh brokerage calls. Earnings came through. One is up, the other is down. Rima, tell us more.
Well, let's start with Wipro. 2 reasons. One, the stock had run up a lot. In June, at the beginning of June, the stock price was 440. As of last week, the stock price exceeded 570. So in a span of 45 days, the stock had moved up 30%. So that's the backdrop of the stock price performance. Then came the earnings disappointment. Q1 marked the 6th consecutive quarter of an earnings miss. The expectation was that things are reviving, but it hasn't shown up yet. And even the Q2 guidance at -1% to +1% suggests that at least as of now, there is no recovery in sight. Kotak says valuations are expensive. It's trading at 21 times forward multiple, no margin of safety. UBS says the Q2 guidance suggests delayed conversion of large deals, which will remain a drag on growth, resulting in Wipro dragging peers. But then there are the believers. It's always a bull versus bear. And on the bullish side, you've got Nomura with the target price of 600 and CLSA at 588. Now, if you remember, Persistent was the big casualty on Friday because the street was concerned about the margin performance and the outlook there. But today, the stock has bounced back. Motilal Oswal has upgraded the stock to a buy. Now they're saying the valuations of Persistent are at 40 times. But they believe that there is still valuation upside from here. And according to them, the target price values Persistent at 50 times forward multiple. That, according to them, is the fair value for Persistent, 50 times forward multiple. And it's the EPS growth of 25% which justifies the premium valuation. But Kotak has downgraded Persistent Systems to a sell. Their target price is all the way down, 4,140. They say the sharp movement in the stock price over the last few weeks has led to the stock trading at lofty valuations close to peak levels. So it's the valuation argument both ways. Motilal Oswal believes there is still some upside for valuations to re-rate. Kotak says valuations are at a peak and therefore might come down. Dipan, come in on Persistent Systems. And what about Wipro? There was so much hope built up in the stock price in the run-up to the numbers.
Yeah, Rima, I think you analyze these companies so well that maybe I should be asking you questions in the other way around. But look, I think that large cap IT offers a better risk return profile than something like a Persistent or a KPIT, Tata Technologies or Tata Elxsi, and all these last 4 mid cap companies have been really high growth companies, and their growth rates have been superior to the industry for several quarters. But these kind of growth rates are not sustainable. Even in case of Persistent Systems, the growth rates have come off a bit. Whereas in the large cap IT, right from Wipro, HCL Tech, Infosys, TCS, from the base at which they're operating just now, I do think that in a couple of years' time, they should get into that double-digit or high teens type of growth rates. And from that perspective, their multiples are attractive. So I'd prefer to be overweight large cap IT stocks, although we're not looking at selling Persistent or Tata Elxsi or any of these companies, because you could get a surprise on growth numbers over there as well. But from a fresh investment perspective, I think more should be deployed toward the large cap IT stocks. Just the risk return profile is favorable and industry is looking up. So if once the volumes start to pick up over there, then you could be surprised on the kind of numbers which come through from these large cap IT companies.
All right, Dipan, I wanted to ask you about some of these divestment candidates, so to call it. IDBI Bank, Concord. During the budget and I think post that as well, some of these stocks will be in focus. Fundamentally as well, things are looking good. If you look at IDBI Bank, Abhishek is just telling us that the NPAs is the lowest net NPAs in the banking space at around 0.2%. So fundamentally as well, things looking good. Even Concord, they are guiding for better times ahead in FY25. And also they have that divestment argument. Anything you prefer from here that could be looking at a potential privatization and also has fundamentally strong business?
No, Nigel, I don't think so. I think IDBI Bank, yes, I mean, that could get privatized, but valuations are fair. I don't think you'll get a much higher premium than these amounts, than these valuations. Concord, I think it seems more or less off the table, because if they had to do a Concord privatization, they would have done it by now, but it's just getting postponed and postponed. And I think it's a pretty valuable company, a strategic asset, and could face some political backlash as well. So I would say that Container Corp cannot be bought on the expectation of privatization, and IDBI Bank is pretty much well priced. The real, I think, surprise in this year's budget could be the disinvestment figure and actual follow through over there, because there's lakhs of crores that the government can raise by selling off a lot of the PSU stocks and taking their stake down to as low as maybe 51% or so. And there's good appetite for PSU stocks as well, even PSU banks for that matter. And I hope the government doesn't miss the bus this time round.
Okay, that is the whole sort of expectation around PSUs. Just going back to the market, looking at mid-caps, and quite a few are moving around to discuss, of course, Indian hotels. Some of the good result reactions on the mid-cap, small-cap screen include an Oberoi Realty today, Dodla Dairy. These are stocks that have done well. Even Patanjali Foods, for that matter, about 2% on the higher side. Dipan, hi, good afternoon. Speaking of Oberoi Realty, of course, this is all numbers driven and they had a fantastic quarter. How would you look at some of these larger real estate players, a DLF or an Oberoi or a Godrej for that matter? They've had a good run, but do you think that the earnings or maybe even budget announcements could provide a fresh leg up?
Good afternoon, Surbhi. I think Oberoi came with an exceptionally good set of numbers, and it's there in hospitality, it is there in rental business, and that's commercial rental, and very focused real estate projects, mainly in premium locations. And from that point of view, I think this company, I would rate it far higher than some of the larger real estate companies. Godrej property of corporate governance and pan-India presence, but I would rate Oberoi Realty higher than even DLF for that matter. And consistently, they have grown even when the industry was pretty much under stress. Oberoi Realty was doing pretty fine. They kept the balance sheet quality pretty much clean. And they're very selective when it comes to projects. So it's a well-managed company with a very low risk profile. So from that point of view, and valuation-wise also, I think there's scope for multiples to move up over there. So we prefer Oberoi Realty amongst the large, in the large cap real estate companies. I think that looks to be the best bet at this point of time.
Okay, well, we'll take a quick commercial break here. Deepan, thank you very much for joining us and running us through sort of your perspective on things. We come back in just a bit, but we are striving to get you the best of market and macro voices ahead of the union budget. So tune into CNBC TV18 at 9:05 a.m. onwards on Budget Day tomorrow. We will be live from the NSC with Morgan Stanley's Rhythm Desai, Nilesh of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSC's MD and CEO Ashish Kumar Chauhan. That's coming up tomorrow.
Of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Big US tech companies have huge cash balances, so they're getting 5% where they would get before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment grade corporate sector, the CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment grade bonds do not mature until after 2029. So those, I think, are the the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key is, so maybe it's going to be a 3-year capex cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point, in early 2025, one's going to have to take a view. But it's not just. It's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge?
Welcome back. Here with us on Closing Bell. Well, let's now go across to Shireen, who is in conversation with Anish Shah, Group CEO and MD at the Mahindra Group, to talk about expectations from the budget and, of course, the economic survey that has just been tabled. Shireen, over to you.
Well, thanks very much. Yes, we now do have the fine print of the economic survey, which is a precursor to the budget announcements that will follow tomorrow. But let's go across to Anish. Anish, many thanks for joining us here on CNBC TV18. Let's start with what the survey highlights in terms of the growth projections. Sanguine on growth, also sanguine on inflation, saying that growth is steady and inflation is under control. 6.5 to 7% is what the survey assumes as far as growth forecast is concerned, which is on the lower end, on the more conservative side. How do you read this, Anish?
Shireen, good afternoon. We do see this as conservative as well, but from a budget standpoint, it's good to be conservative. We feel that it will likely come out higher than that. And we see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher, and that's something that is fairly significant. We see unemployment down from 17.8% to 10% at the youth level. And as we look at our demography and our job situation, that is also a very positive indicator. So I see a number of positives coming out in this survey.
Well, speaking of positives, but also trying to extrapolate what we could perhaps see in the budget, I want to talk about what the survey highlights in terms of India's vision of becoming Atmanirbhar. Over 1.28 lakh crore rupees of investments being reported until May 2024, which has led to production or sales of 10.8 lakh crore and employment generation, both direct and indirect, of over 8.5 lakh under the PLI scheme. The ask from industry is that there be more PLI schemes that are rolled out, at least as far as labor-intensive sectors are concerned, Anish. Is that the expectation that you go into the budget with? If yes, any specific sectors that you believe deserve to come under the PLI net?
Shireen, jobs is clearly going to be a big focus on the budget. And our view from an industry standpoint is that capital formation, investment is the way to go to create a long-term economy and not something that's done for the short term. We like PLI schemes that have come out so far. And the key factor always is that the incentives that are given should have a meaningful and lasting impact. So in that context, we would probably expect fewer PLI schemes than we've seen before. But what we would ideally like is a greater investment in infrastructure, a greater investment in capex formation that will be positive for the economy in the long term.
Yes, there is a whole chapter on infrastructure, Anish, as you pointed out. But, you know, the indication is that perhaps the government has done a lot of the heavy lifting, especially in the last few years, with record numbers being allocated there as far as public capex is concerned. And now the ask is of the private sector to do its bit. In fact, the survey talks about targeting 35% of private investment to GDP. You know, what do you go into the budget with? Do you expect that it will perhaps do a little bit better than the interim budget in terms of public capex?
We feel that it will. And you're also right that private capex has to step up. It hasn't so far. FICCI's manufacturing survey shows higher capacity utilization across industries and also shows that 47 to 48% of companies are looking at investing over the next 12 to 24 months. And that is something that will help private capex grow significantly.
Anish, you talked about jobs, and the survey highlights that we have seen an improvement as far as the unemployment number is concerned. The survey also talks about the fact that India needs to generate an average of nearly 78.5 lakh jobs annually till 2030 in the non-farm sector. I mean, this is a pretty daunting task, daunting ask to Anish of the private sector, which will need to in many ways do the heavy lifting when it comes to job creation, will it not? Is this doable? Is it feasible?
Daunting but possible, Shireen, because as we look at the Viksit Bharat goals, manufacturing has to grow multifold. Today, India has 3% of global manufacturing. Our target is to get to 12%. If we look at manufacturing as a share of GDP today, it's 16%. And we will need to get to somewhere between 20 and 25%, likely on the higher end. If we get to 25%, it means manufacturing has to grow 16 times in the next 23 years. And for that, India has to be the manufacturing hub of the world. A number of actions are being taken to make that happen, and which is again why we harp on government focusing on long-term aspects for the economy, putting in the capital that's required to add to what the private sector does as well. And that partnership, I think, will help us get to those manufacturing numbers and to those jobs that come with it.
You talked about the manufacturing aspiration, Anish, and the survey throws up an interesting idea or an interesting thought. It's asking for a review, essentially, of the policy with regards to China and saying that in light of this China +1 diversification, India should allow FDI from China to come in so that we actually integrate into the supply chain and ensure that what we're now seeing, with business going to Malaysia and Vietnam and Indonesia, that isn't the case. So the survey calling for perhaps a more pragmatic view of the policy with respect to China. I want to understand how you as industry see that.
So the China policy has been driven by geopolitics. And that's an area that we will leave to the experts to think about. The one area that we will highlight is that across many industries, we are seeing cheaper imports coming in from countries that have high capacities. And we've seen the US and Europe starting to raise tariffs in certain areas as well. So that's one thing that will impact our focus on India being the manufacturing hub of the world, and something that the government will have to look at in terms of how it moderates it.
So, Anisha, the final countdown has begun now for the 7th consecutive budget that the finance minister will present. There's a long wish list of asks that's come in from industry. But if I were to ask you to whittle it down to one or two things that you believe will ensure that this is a budget that is appreciated, it's a budget that will continue to amplify and build on the growth momentum, what would those one or two things be?
So more on long-term economic growth and investment in capital expenditure. Second is less of populist schemes because we need more towards the long term. And third is a focus on jobs and manufacturing.
On that issue of, this business of that the budget could deviate from the recent past and be more populist, is that an expectation that you have? And on the back of what you've seen, for instance, in the survey, and not to suggest that the survey it's only an indicator of what the budget may or may not do, but do you get that feeling that this is likely to be a departure from the recent past with more populism, so to speak?
Actually, the political realities do point towards some element of populism, at least. We were very pleasantly surprised last year when the government did not go down the populist path in an election year and focused on a budget that was long-term and that was good for the country, and a lot of credit to the government for that. But again, there are political realities that have to be balanced.
So finally, from an auto sector's perspective as well, Anish, and the question mark on the FAME subsidies and what shape or form FAME 3 can take. But outside of that also, confidence building measures, so to speak. What would the expectation be, the 2 or 3 things that you would watch out for in the fine print?
We would essentially want to stay the course in terms of where we are right now. I feel that we have got a good set of subsidies. Yes, FAME 3 is essential as a replacement of FAME 2 because FAME 2 has done a lot in terms of having the impetus for change to electric, especially in electric three-wheelers. And that impetus needs to continue for another 3 years for FAME 3 and then stop there. We don't need it beyond that. But that is important for it to continue. So therefore, I would just say stay the course. The rest of the incentives are in place. It's up for industry to now deliver.
Stay the course. That's the message coming in there from Anish Shah, the Group CEO and MD of the Mahindra Group. And I think that's the message that the economic survey is throwing up as well. The steady as she goes, that's chapter 1 of the survey. And that clearly seems to be the indication that the chief economic advisor is handing out by way of his second economic survey. Anish, always a pleasure. Many thanks for joining us today and look forward to seeing you tomorrow bright and early as we get ready to listen to what the finance minister finally delivers in her budget speech. Guys, that's the economic survey. That's the industry reaction. Back to you for now.
All right, Shrini, thanks very much for that. And of course, all eyes on what actually does come out. But interesting conversation there with Anish. Vaibhav Sanghvi is now with us. He's CEO at Ask Hedge Solutions. Vaibhav, good afternoon. Great to have you with us here on the program. I trust you heard some of what Anish Shah at Mahindra and of course leader at FICCI was telling Shireen on some of the expectations. I mean, your own thoughts. I think from a market perspective, what corporates are expecting is one thing, but I think from a market standpoint, stakes are high because, we've rallied hard, we've done very well. It is a completely different scenario in terms of retail participation now as compared to the last couple of years. The higher you go, you start to wonder a little bit more as well. And I think the number one issue is taxation. Are you expecting anything at all, Vaibhav, or you think it'll be status quo?
Yeah, I think, from a taxation perspective, a lot of conversations are around your capital gains aspect and also, around that uniformity of taxes, across investment vehicles. Now, if you see currently, each of those vehicles enjoy a different kind of tax treatment. Say, for example, mutual funds have a particular, fund base or a tax which is in the hands of the investor from a long-term and a short-term perspective. PMS is in the hand of the investor because it's a pass-through. AIF is at the fund level. So all of them kind of having different system of taxation. So from a capital market perspective, we do think that if uniformity of taxation, the way it's being calculated and the way it's being charged to an end client, will go a long way in terms of developing the whole capital market reforms. That's on the one side. But on the other side, also there are a lot of conversations around the F&O market, and especially on the option side where, there's talk of, again, STT kind of, pulled up, or probably, we have, rather than on the premium, you charge it on the notional value of the options and so on and so forth. So a lot of talk around different taxation, but at the end of it, it's currently all speculative, and probably we'll have to wait and see tomorrow how it comes forward from there.
Absolutely. And any tinkering, if it is not in sync with the market's mood, then we know what kind of an impact it can have. Vaibhav, good to have you in the conversation. But, that's really the next question. We are at very elevated levels, right? So potentially, apart from tax, is there anything else? Let's assume nothing happens on taxation, at least from a capital market standpoint. Is there anything else that could derail the party? How do you expect, let's say, life to be Wednesday onwards if there's nothing dramatically different on taxation?
See, if there is nothing dramatically different from a taxation perspective, my sense is basically looking at the budget and what the Honorable Prime Minister had to say today, ahead of the budget session, in terms of his vision towards 2047, and also laying a path for the next 5 years in terms of the policy direction as well. In all probability, I think the commentary is going to be pretty strong. So barring, these taxation reforms, if nothing comes up there, then my sense is basically market will, have a sigh of relief. And apart from the normal kind of reaction to any of those budgets, I think we should continue the way we have been in terms of the market. Of course, as you rightly mentioned, should be right at the beginning, that valuations at the levels they are, any slight negative, from any quarters, I think can have a disproportionate reaction on the negative side as well. So, and it might be just normal and it might just be healthy as well.
Hi, Vaibhav. Good to see you in. It's been a while since we chatted. What about positioning ahead of this event? How have you all altered, say, your long-short book in the last few weeks? Because as you said, valuation-wise, we're not cheap, and we have seen a good run as well. So anything that, any kind of disruption could call for a sharper correction. Your take?
See, in our view, or as our thesis goes, or as our DNA goes, I think in a long short fund, when we are focused on absolute return, ahead of any big binary events, we are highly hedged. So at this point in time, if you ask me, we are close to about fully hedged in terms of our books. We don't take any call ahead of any big events. Let the event pan out, look at what's coming from there, what the outcome there, and then reposition our portfolios. But having said that, while we are extremely cautious investors because of our hedge mandate, my sense is basically, as I said earlier, at the level of valuation, the scope of disappointment is very, very less. If there is some amount of disappointment, then the correction can be pretty sharp.
Let me ask Prashant this actually. Prashant, so obviously this is all speculation. Hypothetically, if there's no bad news on tax tomorrow, then what? Just a relief rally, all-time highs once again.
I mean, how much? I mean, I think we were 1.5%, 2% away.
About just 1.5% away from it, so another high.
That's possible, right? I mean, that's absolutely possible. But think about it another way. We were talking about the interim budget, which was presented in February. Now this is the full budget.
Yeah.
But now this is it's happening in July, which means
February. It's a 6-month budget.
Exactly 6 months. You'll have another budget, right?
Yeah.
So, would the government want to really do something big and dramatic in terms of, rejigging the entire taxation regime when you have a full budget in 6 months' time?
Yeah.
I think that is another thing to ponder. But I mean, if the taxation bit does not, I don't think there is widespread expectation it will come. Actually,
I think there's just fear-mongering, a lot of fear-mongering in the last couple of days.
Actually, if you had to sort of count the number of people, which you can't do, but I think it'll be in the minority. There are only few who are expecting something will come. The majority is saying, well, I don't think, but at the margin, of course, that the thing is always there. So maybe, as you say, maybe a little bit of a relief move, but we're almost there, right? I mean, the market's pulled back hardly anything. 1.5%, 2% or so. So who knows? Just a quick word, Weber, on telecom as a space, especially in names like Indus Tower. Actually, Indus Tower, because I mean, others you've got to take an individual call, but Indus, of course, caters to the entire telecom market ecosystem in that sense. I was reading a note from Citi, which is just out, and they're talking about the next leg of price appreciation for the stock. They're saying the price target, they're calling a price target of 500 rupees, lots of triggers, which will be positive for underlying telecom stocks as well. I mean, for example, the curative petition in the Supreme Court, tariff hikes starting to come through. They're expecting the company to present an update on tenancies, etc. Do you own it? Stocks up 100% this year, to be sure. Weber.
Yeah, I think, Prashant, I mean, from a business opportunity perspective, from telecom, side, I think nobody debates in terms of the long-term opportunity which is there. Till now, what has been happening is basically because of the high capex, the commensurate free cash flows was something which everybody was missing from the whole sector. Now that post-tariff hikes and in the whole ecosystem getting pretty healthy, my sense is that every decline or every dip, this is a sector which would be bid into or bought into. So while the business opportunity is fantastic, valuations are slightly richer compared to your averages, but as I said, just that because all the headwinds, are out of the sectors, and now we are looking at some amount of tailwinds in terms of tariff hikes, and balance sheets can, getting in proper shape by reduction of debt. I think this is a sector will continue to get, constant interest going forward as well.
Okay, all right. Vaibhav, appreciate you joining in and filling us in with your quick take on the markets. Looking forward to chatting with you post the event. Well, for the time being, though, let's keep an eye out on a few stocks that are moving around. At the bottom of your screen, you have that City note on Indus. They're talking for the next leg in terms of an uptrend on Indus Star. So that stock has moved to the high point of the day. V-Mart, all of a sudden, volume spurt out there. And that stock as well has moved to the high point of the day. I think it's up close to around 10%. And the other one is Vedanta. The stock has seen a correction post that QIP. It went to around 440 rupees odd. There was rather strong demand, but it's underperformed for the last week or so. So that one as well has made its way to the high point of the day on rather large volumes. But a good time to get to our favorite segment, T-Street Chatter. Nimesh joins us. Nimesh, what are you picking up in terms of today's action?
And Nigel, it's a wait and watch. But before I talk about the markets, a word on Vedanta, I guess the stock will get out of the FNO ban as well. I guess that's the reason why you're seeing a bit of a up move there. Okay, broadly on the markets, it's a wait and watch ahead of the big budget announcement tomorrow. I think everybody's waiting and watching on the maybe if there is a taxation on equities. That's a big debate point, right? But if that doesn't has to come, then you might see a bit of a pullback rally as well. Largely because the positions are on the lighter side. A lot of funds have raised cash levels. A lot of HNI investors whom I know, they are sitting on the sidelines and waiting for a dip. So if there is no big negative surprise in the budget, you might see a bit of a pullback rally in the overall markets as well. So that's something to watch out for. Having said that, the broader markets have relatively outperformed today. The index is up nearly 1.5%, and that's largely because of the retail flows, and that was missing on Friday. We saw a sharp correction in the broader market stocks on Friday on the back of the global outage, and a lot of retail participants couldn't participate or buy. That seems to be not the case today, and hence you're seeing a bit of retail inflow back into broader market stocks today. From a larger institutional point of view, it's quite muted is what I understand. The flows are quite muted. There is not much activity both from the FIs or from the DIs, and rightly so, because if you look at the large cap names, most of the earnings over the weekend in the large cap basket has relatively underperformed or have been a disappointment, right? So earnings would be a big trigger to watch out tomorrow, but post that, I guess the bigger reactions will come on the individual earnings, and that's going to be a big trigger to watch out for. So earnings will set the tone, but I guess if there is no big negative surprise in the budget tomorrow, you might see a bit of a sharp pullback rally as well.
No, that's right. No disappointment is something that we're looking forward to. And I think, Nimesh, a couple of points. The retail flows have been solid. The FI flows into India in comparison to other emerging markets has been good. And that piece you put out as well, that the mutual funds have raised their cash levels from around 90,000 crores, I think it was 1.2 lakh crores as
Absolutely.
well. So ample liquidity waiting to come in.
Exactly.
If there's no.
So what I put out was only mutual funds. If you add to it the SIP flows, if you add to it the kind of cash levels the PMS are sitting on, there is ample liquidity in the system. So my sense is if there is no negative surprise in the budget, you might see a bit of a buying squeeze as well.
All right.
That will be something to watch.
Let's get to the interesting part then, Nimesh. Individual stocks.
Well, there is a lot of, while the earnings are going on, there is still a lot of chatter around large block deals. So the first name is Sula Vineyards. That stock has been in a very narrow range for the last many months now, been largely consolidating. But now I understand there could be a clean out trade very soon in Sula Vineyards. The global investor, one of the large global investor, is a likely seller there. They've sold a large chunk in the last 1 month, and now there could be a clean out trade. So that's something to watch in Sula Vineyards. The second name is Root Mobile. While the stock is under pressure after Q1 earnings, even there the chatter is that there could be a large block deal in Root Mobile very soon. Remember, the promoter holding is at 83%, and they need to bring it to the minimum public float norm. So the large block will come from the promoters, and now that the earnings are over, that's likely very soon. The third stock is PI Industries. Big move in that stock and large volumes as well. Largely because I understand the selling pressure from a leading FI is largely over. There was a small block in the morning, and post that, we've seen a big reaction there. And the last one is ICICI Lombard. Post earnings, we've seen a bit of a positive reaction on that name as well. The volumes are on the higher side. I understand there is a very strong buying interest from larger FIs. And Morgan Stanley had put out a tactical buy as well in the morning, and they'd raised the target price as well. So on back of that, a bit of up move in ICICI Lombard as well.
Okay, got that. Thanks very much, Nimesh, for all of the buzz out there. Markets absolutely flat, just 15 points lower. And HDFC Bank, Lever, which is reporting numbers tomorrow, and Infosys. These are 2 or 3 strong stocks that are ensuring that there is no wider decline. These are the top movers on the way up in terms of the top weightages. Let's take a break on that note. We'll come back on the other side, and we'll get you some final trading calls with Mitesh.
AI capabilities going on devices. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether, whether it's going to become monetizable. From a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Okay, welcome back. 20 points lower on the Nifty. 24,500 is where we are at right now. Now, the economic survey, which came through earlier, is parsed for any hints on what the budget may actually present. Lata is here with some of what she picked up could be markers for tomorrow. Lata, over to you.
Well, first up, everyone looks for what is their growth forecast, because if the growth forecast in the budget changes, I mean, if it becomes higher than expected, then automatically the percentage of the fiscal deficit will look smaller without you having to do anything. But that kind of a hint is not there. It's a very moderate, middle-of-the-road kind of assumption of 6.5% to 7%. If you add the 4.5% CPI forecast of Reserve Bank and probably around a 3% WPI forecast, inflation is actually lower. So the 10.5% that they have gone with in terms of nominal GDP growth in the interim budget, there's no reason to change it. Even the tax buoyancy, which we were all expecting would get worked into the new numbers, if you're very modest in your growth aspirations or your growth expectations, I'm not even sure that the tax assumptions are going to be scaled up much. So if anything, the bond markets, after that initial enthusiasm, is back to where it was before the survey. There isn't so much expectation that there will be a huge cut in fiscal deficit. There is still the one-off RBI dividend. What they will do with it remains a question mark. But there is no extra assumptions that, oh, we can do welfare and we can do capex and we can cut deficit. That enthu has gone down a bit. With respect to stock markets, the big worry was about what do they think about the surge in stock prices. And there, The CEA leaves you in no doubt that he is worried about it. I'll read just 2 quotes, but I can pick 5 or 6, just at the snap of a finger. One quote, very serious warning on, the quote, the financialization of economies has not ended well, even for advanced economies. And then there are many, many examples. Another quote, all stakeholders, capital markets, regulators and government must ensure that capital markets play their theoretically assigned role of directing savings to their most productive investments. It is not just in the national interest, it is also in their selfish interest. So here again, saying what the SEBI chairman said, they must go for capex and must not go for speculation. And I'm only picking 2 points again and again. So clearly something will come now, whether it will come in the form of taxes or whether it is a directive from the government to tell SEBI, you better be a nanny regulator, we don't know. So that still leaves a question mark, but we are not in doubt that the F&O volumes and the market surge in general has not been taken too kindly by the government. And finally, there is some mention of inflation targeting. Remember now the current inflation targeting framework targets 4% headline inflation. But there is a small paragraph which says that maybe we need to review that targeting and exclude food because that can't be impacted by interest rates. And it is coming in a context where they want to encourage farmers. I mean, among the many things you can do to farmers is don't take off options trading at the first hint of, some commodity price going up. Don't ban exports at the first hint of a price rise. And the third thing they say is maybe you remove food from the inflation targeting scheme altogether and make the Reserve Bank target a food excluded inflation target. Well, I don't know if this is a very serious suggestion or it's just one of the many, but this is something the bond markets will chew over. It's not immediate, but we will have to wait and see. Those, I think, are the key takeaways. Okay, there's one on China, if you wish. On the external sector, when they discuss, they say that geopolitics, of course, dominates even our relationship with China. But rather than get into the China-dominated supply chains, which is what many nations aspire, let us look at encouraging FDI from China because clearly exports out of China and imported into the US could be threatened sometime soon. And, if the Chinese money is routed through India in the form of a manufacturing investment, that may be one way to look at. Of course, this is subject to all geopolitics, but that's just a suggestion.
All right, Lata, thank you very much for that. So that's a nice, tight wrap out of what the economic survey really puts out. And all eyes, of course, now on the budget tomorrow. Mitesh Thakkar is with us. There is, I think 10 minutes to go for market closing. We're around about 20 points. So just treading water, neither here nor there. But to be sure, Nifty is down because Kotak is down, Reliance is down and Wipro is down. I mean, so it's not a broad-based sell-off. Broader markets are doing well. Mitesh, actually the story of today has been the bounce from the lows, not the subdued, flattish kind of price action. So how would you take it and what are your trades now?
As I said, I think, Prashant, the idea could be that before the event, even the short traders may not be very aggressive and they would want to hold their horses. I think it's a market which will take some kind of directional movement post the event tomorrow. But for the timing, so therefore trade with light volumes, even if you are trading. On the BDSC side, I think Sun Pharma is what I would recommend. Keep a stop at 1580. Look for targets of around 1600 plus here. And an STBT on telecommunication with a stop just above 1795 for targets of 1760.
Okay, all right, got it, Mitesh. Thank you very much for that. We do have to take a very quick break. Very quiet on the Bank Nifty and the Nifty. HDFC Bank is doing really well, 2.5% up. But the rest of the large cap screen is very, very subdued. We'll take a break, come back, and then get into the last leg of today's trading action.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.
Welcome back. You're with us, and we are in the last chapter of today's trading action. Just looking at some of the Nifty winners, I mentioned HDFC Bank, where there's a sigh of relief. Remember, the stock really sold off once we got the quarterly update. So the fact that there is hardly any business growth, that was known, but I think it's the margin expansion that the market has really latched on to. Ultratech Cement is recovering from the blows that it received on Friday. There's some buying on Tata Steel, Hindalco as well. Some of the metal stocks are also bouncing back. Anand Tandon is with us. Anand, okay, I'm going to ask you one of those questions. Budget, right? So it's that time of the year. Let's say, if you were to go beyond taxation and if you were to look at 1 or 2 stocks or 3 stocks which could remain key beneficiaries of the overall policy direction that the government is expected to take, then which would those be? I'm not asking for a budget trade for tomorrow, but in general, a play on favorable policy.
Well, the first question is, what do you determine as favorable? Because, by and large, given the fact that you leave a bunch of bureaucrats in a room, the only thing they can come up with is to mess up whatever goes right. So from that context, you have to assume that they will do something to stop the market from performing better from here on. Which brings you to the question about which sector to look at. I think the one sector that they may not end up doing badly with is the banking sector, because that is key to many of the plans that the government may have in terms of being able to grow. And that's been a relative underperformance. So, you can continue to be overweight perhaps on that sector.
Okay, no, I've got that. Anand, any specific hopes from the budget tomorrow?
Well, as I said, the best would be to say business as usual, not to do too much. The reality is that that's not likely to happen. So we are going to get the first 40 minutes about farms and how we should be increasing productivity with no difference other than the fact that, some allocations will be increased to farms. There may be something in it for the urban poor, I'm not sure. If that happens, that could increase the kind of coverage that you have for the weaker segments of society. And given the kind of noise that we are talking about in terms of options, etc., there is bound to be something disastrous there. So, either it will be tax or it will be increasing the size of the contract or any of the above, which will make sure that that market actually collapses from here.
Well, that's you're pretty certain of it, Anand. I don't know. We'll see what comes of it. But one hopes that it's measured, right?
So I'm not sure what exactly is the motivation, because if you were to put it down and say, okay, the reason we are interfering in it is because the retail investors or traders are losing money, well, then there are lots of other things to do. You can actually put a UTI 64 scheme back in the action. The reality is that the market is meant to allow people to express their views, and if that means that they will speculate, so be it. If you want to get people to speculate, let's give them in the markets, give them other alternatives. The Hong Kong horse racing was the biggest thing which helped the Hong Kong University set it up and make it one of the largest and the best performing universities in the world. So horse betting is a great idea. And, instead of stopping that, you should perhaps allow that.
Anand, you're in a mood. Anyway, thanks for that. But, I'm going to come back to you in just a bit. Let me just wrap out things here. We are up, we're down about 15 points, but we're up quite a bit from the day's lowest point on the Nifty. That's the closing, those are the closing rates, 24,515. You've got the Nifty Bank, which is up about 65 points. We're at 52,330. The Sensex is largely flattish, unchanged. Mid and small cap indices, though, have staged a recent recovery. Friday, those indices were down 2%, more than 2% today. You got about a 1% odd gain on each of these indices. Market breadth is positive, and I think about 1,500 stocks are higher, 1,100 stocks are lower on the NSE. And you also look at, the PSUs. I think the PSE index, the CPSE index, these are some of the stocks sectors which did well. I mean, large earnings-specific reactions, right? You look at Reliance, the way that's, which was, of course, a big drag on the index. There was Kotak Bank, and of course Wipro, not that large a weight, but Wipro, of course, in absolute terms, saw the largest price damage after the earnings. HDFC Bank was pulling the other way, and it was doing, I think it added about 50 odd index points with a 2% gain, more than 50 points actually by close. So 1642 coming through on HDFC Bank. So that's essentially the session that we had. It's a wrap on the session of Closing Bell, but stay right here. Rima and I'll get you Markets Forward, which will come up in just a bit from now. Stay with us.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Stock markets tread with caution a day ahead of the union budget. Sensex and Nifty end a choppy session with small losses but off the day's lows.
The budget session of the parliament kicks off and the finance minister tables the economic survey, projects GDP for this fiscal between 6.5% to 7%, says real GDP is now nearing pre-pandemic levels.
SEBI chairperson Madhabi Puri Bush flags the growing risk of retail participation in the F&O segment. Economic survey equates derivative trading to gambling and calls for careful consideration on the rise in participation in this particular segment. Hello and welcome to this fresh new edition of Markets Forward, your go-to show where we aim to get you everything you need to know as you gear up for the next session. Today, of course, was absolutely flat, and tomorrow, 11 o'clock, we have the Finance Minister laying out the Union budget for FY25. I'm Prashant, with me, my colleague Rima. Rima, hi.
Hi, so prepping up for the big day tomorrow, but not without a lot of market activity. The mid-caps did exceedingly well. But here's what we have for you in the next 20 minutes on the show. All the big news, the key developments in Dalal Street, the top corporate voices through the day, and the big events for tomorrow. But first, the market action.
I mean, off the lows, Rima.
Off the lows. And that happened in the first 30 minutes.
In the first 30 minutes or so. And I think it was actually not a bad session at all, because the reason why we were down also was because of specific stock-related reactions, earnings-related reactions like Reliance and Wipro and Kotak, the three big drags that we had. And otherwise, I mean, you look at the broader market, the mid-caps, small caps, after Friday's 2.5% cuts, those indices recovered about nearly 1% each. Market breadth was positive overall. PSUs, which has been kind of the flag bearer for the retail participation and the enthusiasm, that pocket was doing just fine. So it was, more earnings-related cuts which sort of dragged the market lower. The budget tomorrow, I think there would be some nerves in the market and, some in the market saying, well, all of this talk with the RBI governor, the SEBI chief, now the economic survey talking about, the huge speculation in futures and options, especially on the option side, means that something could come on taxation front. I don't know. The SEBI chief has made it clear that something will come. There is a committee which has been formed and, but that's not tax related. That could be operational issues, regulatory measures which would come post the budget. But will we see something in this regard from a capital markets point of view as far as tax is concerned? I think that at the margin for some is a bit of a niggling worry. But I don't think there is widespread fear in that sense. It didn't show in prices in any case because broader markets, etc., were just fine. Absolutely okay ahead of a big event for the markets to pause a little bit. Rima.
Well, the widespread expectation is that she will be able to balance fiscal consolidation, prudence, and welfare spending. But if you look at the market action today, as we pointed out, the index ended absolutely flat. And that's because the two heavyweights pretty much cancelled each other out. If you pull up a contribution plate, Reliance Industries was under pressure post its numbers. It took away about 82 points on the Nifty, and HDFC Bank, with the up move today, added about 60 odd points. So largely cancelling each other out. So that was the big story on the frontline indices. PSUs continue to come in for buying. So the Nifty PSC index ended with a gain of more than 1%, up 1.8%, inching towards a 2% rally. CPSC is higher in trade. Mid-caps did very well. The mid-cap index outperformed, strong advance decline ratio, and we are going into the big event with a year-to-date gain of 12.5%, 13% on the Nifty and the Sensex, and about 22.5% for the mid-cap index. But here's what we have for you on our show. We tell you the top movers and shakers of the day. Hormus is standing by. Wipro was the stock of the day after a weak set of Q1 numbers. Kotak Mahindra Bank, Indian Hotels also in focus after reporting Q1 numbers. We'll decode all the earnings reaction, and we'll talk about the day tomorrow and what you should be watching out for. But first, to the top, the first segment of the day with Hormus, with the top stock movers of the day.
Well, we highlighted earlier this morning that a lot would hinge on the two index heavyweights as to where the Nifty moves today, be it Reliance Industries or HDFC Bank. Well, both moved in opposite directions today, and the result was that the Nifty went nowhere at the close of trading. And there you can see Reliance and HDFC Bank, both of them ending on the opposite side of the spectrum. But as you mentioned, Wipro, the stock of the day, 9% lower. The biggest single day drop since April of 2013 is the one that Wipro has seen today. And Dodla Dairy earnings came out today. 7% higher there as well. And Canfin Homes was down around 3% towards the close of trade, but then saw a sharp recovery and ended just 0.5% lower. PSUs were the one that did well today and led by the shipbuilders. They've had a quiet last 3 to 4 trading sessions, but then they have had a bit of a rebound today. Cochin Shipyard, Garden Reach both gaining around 5% each, and HAL also snapped a 3-day losing streak today, and NBCC also ending the day with gains of close to 8%. Fertilizer stocks had a good day ahead of the budget presentation tomorrow, so hopes for some positive announcement there as well. Chambal, Fact, RCF, NFL, all of them gaining anywhere between 4 to 10% in today's trading session. Some of the other broader market losers, then Tejas Networks was another earnings reaction, if you can call it that, almost 7% lower there as well. Phoenix Mills was one of the other real estate names that didn't do well, as did Raymond, a 5% lower circuit there. Blue Dart and Intellect Design also not having a good day at the office. And lastly, Indus Towers, and towards the close of trade, you came out with Citi coming out with a positive catalyst watch on the stock with a 500 rupee price target. The only brokerage now to have a 500 rupee target on Indus Towers, ending 3% higher at the highest point of the day. Back to you guys.
Okay, Citi's argument is that even after the stock moving up so much, and it's up 110% from the beginning of the year, over the last 5 years, the stock has still underperformed the broader markets by nearly 30%. And plus, there are positive triggers on the horizon. But thank you, Hormus, for that. Let's invite Anand Tandon once again. He's been with us on Closing Bell too. And Shilpa Rao, the Prabhudas Leeladhar on the show. Thank you for joining in. Shilpa, first, how did the market look to you? What's the setup for tomorrow?
Arima, talking about market, we saw some nervousness, just before the budget. Also, the last week closing Friday, also we saw that nervousness, looming over. But however, the levels are quite strongly held on to. The correction that we have seen, just a profit booking, it has not breached the crucial levels of 24,200 yet. So till that levels are held on, I believe there's nothing to worry about. The upside trend is intact. Probably tomorrow after the budget, some clarity will come in and we might see some aggressive movement on either side. Either we breach 24,200 and move towards 23,700 to 23,500, or we go and make new all-time highs.
Anand, of course, the near term, perhaps the budget will have a say, but what is your view? Short term, near term markets?
The markets are still in their upturn, so you just have to play with the momentum. Clearly, you cannot argue for it from a fundamental or an earnings basis. But overall, the market continues to show signs of robustness. There is some incremental nervousness in the US market, but after Biden stepping down, I don't think that will sustain either. Today's market play will be interesting to watch from that point of view, because that was beginning to show some signs of a trend break there. But if that doesn't happen, then that is also a market that may probably resume its upward journey. The key thing you have to remember is that when we argue, for example, that the US is overpriced, therefore money will move out, you have to take a simple case. Take HDFC Asset Management Company. One number that will help you to put it in perspective. It trades at roughly 12 to 13 times AUM as percentage of AUM. BlackRock, which is 10.5 trillion, and therefore, and by the way, HDFC AMC is 90 billion. This is 10.5 trillion, trades at 122 billion, which is like 1.1 or 1.2 times percentage of A. That's the kind of difference. We're talking about 100 times bigger size, 10 times more valuation. So India is actually very, very expensive in most areas.
Okay, let's talk about individual stocks. And one stock where the momentum was broken today was Wipro. Down 10% today. It was down 2.5% even on Friday. This is after reporting disappointing set of numbers. But remember, the stock has seen a fantastic run-up over the last month and a half when the stock price rallied from levels of 440 all the way to 575. Q1 was weak, lower than street expectations in the top line, 6th consecutive quarter of a revenue miss. Q2 guidance is also not very exciting, in fact, lower than expectation, and it leaves the door open for another negative growth quarter, -1 to +1%. In terms of brokerage opinion, Kotak on Wipro, they're saying the valuations are expensive at 21 times forward multiples, so there is very little margin of safety. UBS says we're seeing a delayed conversion of order wins to revenue, and that will keep the growth rate pressured, and therefore Wipro will continue to underperform its peers. But on the other hand, you've got a Nomura and CLSA, both of them still very bullish on Wipro. And Nomura has put a target price of 600. CLSA stands at 588. Anand, anything on Wipro? Even Persistent rebounded after Friday's loss. You want to come in on the earnings reaction?
Wipro has surprisingly been not performing. I mean, they have tried whatever they could. They've regularly changed their leadership. And every time there is leadership change, there is some hope that, somehow that will put some, momentum in terms of their earnings. But it has flattered to deceive. So, the last time around, we had the same issue. The sustenance of the share price movement upwards was for a longer period. This time it looks like, it has taken hardly a quarter before it has decided that, not much is changing and the numbers are not showing anything. Persistent, on the other hand, did exactly the same. A few years ago, changed the management, brought in professional management, and the promoter stepped back from trying to, manage the sales cycle. And the results have been dramatically good. But again, look at the valuation for all these companies. At this stage, I think, the frontline companies are looking a little better and perhaps even cheaper, with perhaps better growth trajectory, given the constraint that overall the sector itself is not growing very well. But at least the frontline companies have come back to the game, whereas the smaller mid-cap companies have perhaps run up too fast.
No, got that. By the way, Shilpa, any thoughts on these stocks, IT names?
IT, yes, talking about Wipro. Wipro is breaking supports again, and below 500, you will see that stock again sliding in and going below 480 to 470 zones. So that is one stock, I would keep on radar. It could be, it is a sell for me with a stop loss of 520 from here for targets of 470. So that is one from the IT bank.
Okay, let's get to the banking picture then. HDFC Bank up 2%, while Kotak Mahindra Bank slumped post the Q1 numbers. Abhishek joins in with the details. Abhishek.
Well, tale of two cities, right? If you take a look, one has improved their net interest margin, rewarded by the street, and one has seen decline in its net interest margin, and that has been bashed by the street. So take a look at HDFC Bank. They have beaten our poll. The NI beat is of 0.9%, while, PAT beat is more than 3%. Net interest margin improved by 3 basis points on a sequential basis. Now, analysts were pegging a flat net interest margin on a quarter-on-quarter basis. Other income was down 41.3% quarter-on-quarter. Last quarter, they has a treasury gain of close to 7,600 crores. Operating profits declined by 18.4% quarter-on-quarter. And if you remove the treasury income, the operating profit is a growth of 9% on a sequential basis. Provisions declined by almost 81% quarter-on-quarter. Asset quality did deteriorate in this quarter. That is largely to do with the fact that it's seasonal in nature, that their agri portfolio sees rise in NPAs in Q1 versus Q4 numbers. So gross NPA in absolute value increased by 5.9%, while net NPA in absolute value increased by 17.5%. Gross NPA ratio and net NPA ratio remained at 1.3% and 0.4% respectively. A calculation shows that the PCR has fallen to 71.2% versus 74% in the previous quarter. And now take a look at Kotak Mahindra Bank. Net interest margin is at 8-quarter low, despite the fact that their credit deposit ratio has improved. So net interest margin has come in at 5.02%, which is a decline of 26 basis points on a sequential basis and about 55 basis point decline on a YOY basis. Deposits have grown by 15.8% YOY and they have declined by 0.3% sequentially. YOY, the deposit growth is the lowest in last 6 quarters, and sequentially, first time their deposits have shrunk in last 16 quarters. Healthy, advances growth. However, operating profit was very weak, growing at 6% YOY, which is the weakest in last 8 quarters. Provisions shot up and they had an exceptional gain of about 3,500 odd crores. So the NI was below our poll. However, PAT was ahead of our poll. In terms of asset quality, gross NPA and net NPA increased by 3.8% and 8.3% respectively. Back to you.
Thank you very much for that. The other stock on our radar is Indian Hotels. The stock surging 8%. Good Q1, positive management commentary. Mangalam joins in for more. Mangalam.
Well, it was a seasonally weak quarter for the hotel industry, and in that, Indian Hotels actually reported what was a resilient set. So, despite there being the election code of conduct, and as a result of which lower revenue coming in on account of that, the severe heat wave which disrupted travel plans, and also lower wedding dates, which resulted in 25% lower wedding revenue for the company, they managed to go ahead and report 5.7% growth in the revenue. They controlled costs well, so margins improved by about 100 basis points as well, and the net profit reported a double-digit growth, so making it yet another record first quarter for the company on the whole. And as a result of which, the pent-up demand that was there, the management told CNBC-TV18 that July has done well for them. In the first 17-18 days of July, they've actually seen 20% growth, and as a result of which they've also maintained their growth target of double-digit for this entire year. Occupancy improved by 100 basis points, average room rate improved by 2% as well, and importantly, they are pretty optimistic about opening 25 hotels this year, along with a couple of properties in overseas as well, which includes a trophy property in Frankfurt, Germany.
Mangalan, thank you very much for that. Anand, I think the travel and leisure space is something you've liked. Any thoughts on Indian hotels?
Well, yes, that's a space that has actually done remarkably well after COVID and continues to do reasonably well. The hotel business, unfortunately, is very capital-intensive business, and therefore the ROEs always suffer. But among that, obviously, Indian Hotels is the biggest brand, and therefore, given the fact that they have now gone back to expansion and perhaps looking at a little more carefully at their asset turnover numbers, this is a company which has done extremely well and will likely continue doing so. If you look at purely the valuation, I think some of the smaller hotel companies are looking a little cheaper, and especially those at the business end. So from a fresh investment perspective, that could be something one could look at. But Indian Hotels itself will probably do better from next quarter onwards, given the kind of guidance they put out.
By the way, Shilpa, the banking names, I don't think we got a chance to talk about. Kotak and HDFC went in opposite directions today. What are your thoughts here?
Kotak has been underperforming quite for some time, Prashant, in comparison to the peers. The Kotak Bank now below 1740 is very weak, and it can do, maybe 1680 as well. On the other hand, HDFC Bank is holding on to this 1580 to 1600 zones. So as long as we are doing that, HDFC Bank has much more potential to see the levels up against 1750 to 1780 zones. So the bet would be more on the longs for HDFC Bank.
Anand, Shilpa, thank you very much for joining in. We need to get into a short break. We'll come back with the top corporate voices on the other side and the big events for tomorrow.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details, and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your investing.
Okay, welcome back. If you missed a lot of the commentary that we had through the course of the day here on CNBC-TV18 in terms of corporates we spoke to, don't fret, here it goes. We had a few top managements join us today, and I'll start with JSW Steel. And this is the first company we're going to put out in Corporate Corner. We spoke with them. The management told us that, after first quarter earnings, margins will be supported as costs are cooling and realizations are stable. JSW Steel also said that they're interested in Vedanta's mining assets, but not steel assets. The company is also pushing for government action to adjust steel imports into India before they become a bit of a worry. We also had the management of credit access, Grameen. Here there was a little bit of worry on the slippages in the first quarter numbers. The management is estimating higher risk in the coming future. The MD told us that growth will be slightly lower this year because of elections and restrictions which impacted the MFI sector. On MFIs, they're expecting about a 20-odd% growth in assets. Dispersals, beg your pardon. The company has also reduced their guidance as far as the MFI segment goes. And last not but the least, ICICI Lombard was also someone who we spoke with. Mixed first quarter. Management said that net earned premium will grow by between 16 and 17%, which is between 100 and 200 basis points higher than the industry average. The company is expecting to see an overall improvement in underwriting performance. On the pricing front, it is not looking to hike prices in the health portfolio and believes that the price hike is needed in third-party motor insurance.
And before we wrap, we get you some of the key market events to watch out for. Vamakshi joins in. Vamakshi.
Well, absolutely. The big event tomorrow is, of course, the union budget. All eyes will be on FM Nirmala Sitharaman. She will be presenting the union budget in front of the parliament at 11 a.m. tomorrow. And stocks that are placed on rural consumption, infrastructure, as well as some others will be in focus tomorrow. But apart from that, lots of stocks in focus on the back of their numbers. From the Nifty pack, we will be watching out for Bajaj Finance and HUL. Some others will include ICICI Prudential Life, Mahindra & Mahindra Financial Services, SRF, Torrent Pharma and United Spirits. As far as some important board meetings are concerned, keep an eye out on Apollo Microsystems. They will be considering a preferential issue. SpiceJet board is expected to consider raising fresh capital, and the company is exploring the possibility of raising funds via QIP. SRF will be considering issuance of NCDs up to 750 crores, and Tata Consumer, a meeting of the capital raising committee is expected to discuss various matters with respect to the rights issue. Keep in mind that the company had, in fact, the board had given its nod to rights issue up to almost 3,000 crores back in Jan 2024. Now, lastly, we will be focusing on Baiju as well. Baiju's case is likely to be taken up by NCLAT tomorrow, so watch out for that one as well.
Okay, all right, Vamakshi, thank you very much for that. Well, that's looking ahead, but that also brings us to a close as far as this edition of Markets Forward is concerned. From all of us here, the entire team, goodbye. Thank you very much for staying with us, but more news and updates on the other side of this break.
This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you've earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Big US tech companies have huge cash balances, so they're getting 5% where they would get before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key, those are the the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So the key, so maybe it's going to be a 3-year CapEx cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to be lead to monetization. Frankly, I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just, it's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable. From a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar.
He wants a weaker dollar, yes.
Yeah, but I also just think, because basically the US fiscal situation is essentially out of control. And we have neither political party remotely interested as at the moment in fiscal retrenchment. So in my view, you should assume it will remain get more and more out of control until the markets revolt against it.
Hello and welcome to this special broadcast. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The budget session of Parliament kicks off. The Finance Minister tables the economic survey, projects GDP growth for the fiscal between 6.5% to 7%, says real GDP is now near pre-pandemic levels, expects inflation to remain largely under control, says it could be worth exploring if the inflation targeting framework should exclude food inflation. The economic survey calls on the private sector to take the baton on capital expenditure, highlights that private capex has grown by just 80 basis points from FY19 to FY23. Also bats for FDI from China, saying it can help increase India's participation in the global supply chain. After warnings from RBI and SEBI, the economic survey red flags the rise in derivative trading volumes on Dalal Street by equating it to gambling, calls for careful consideration on the rise in F&O participation, but stops short of suggesting specific measures. As Parliament reconvenes, the government faces the heat from opposition on the NEET controversy. Rahul Gandhi says millions of students are convinced that the Indian examination system is a fraud. Education Minister Dharmendra Pradhan hits back, blames previous UPA governments for failing to bring in a law to curb cheating in exams. Stock markets tread with caution a day ahead of the union budget. The Sensex and the Nifty end a choppy session with marginal losses. After days of speculation, US President Joe Biden withdraws from the upcoming presidential race, says it is in the best interest of his party and the country, endorses his deputy Kamala Harris. All 50 state Democratic Party chairs endorse Harris as the presidential nominee. The Supreme Court orders a stay on UP government's directions that made it mandatory for eateries along the Kawar procession route to display the names of the owners. Notes that the state police tried to usurp power it didn't have by issuing directives. However, clarifies that eateries should disclose the kind of food being served. Well, it is the eve of the Union Budget. Finance Minister Nirmala Sitharaman tabled the economic survey as the budget session of Parliament kicked off. Now, the survey projects GDP growth for FY25 between 6.5 to 7%, with the risks evenly balanced. The survey also noted that real GDP is now near pre-pandemic levels. On inflation, the survey is largely sanguine. While the headline inflation rate is under control, there are concerns over specific food items. The survey has called on the private sector to take the baton on capital expenditure. It's highlighted that private CapEx has grown just 80 basis points from FY19 to FY23. The survey has also made a pitch for allowing FDI from China, saying it can help increase India's participation in the global supply chain. After warnings from RBI and SEBI, the economic surveys also red flagged the rise in derivative trading volumes on Dalal Street. It calls for careful consideration on the rise in F&O participation, but it stopped short of suggesting specific measures. Here's the Chief Economic Advisor.
Real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered. Households are not in distress. Households actually are investing in financial assets which have done very well. Capital market participation by retail investors is a very healthy and a very welcome thing. The issue is in what kind of capital market participation that they are engaging in. Speculative trading in futures and options is something that I have commented upon earlier, and that's exactly the point that we are driving at, because they are not exactly benefiting either the households or the purpose of capital formation in the overall economy.
Well, that is the Chief Economic Advisor. Joining us now to take this discussion forward is Sanjeev Puri, the President of CII and the Chairman and Managing Director of ITC. Sanjeev, always a pleasure. Many thanks for joining us. Let's start with the headline growth number. A very prudent 6.5 to 7% being put forward by the Chief Economic Advisor in the survey, much lower than CII's own forecast of where you believe growth will be for FY25. You know, whether or not the budget takes other ideas of the survey into consideration, it usually does take the growth number into consideration, Sanjeev Puri. You know, this big difference between how the government views growth and how industry like CII is viewing growth.
Okay, first of all, thank you, Shireen, for having me on the show. Always a pleasure. So I think, you know, I would say it's a cautious estimate, and it's, I think, prudent to be a little cautious because that does impact the projections on revenues, etc. Now, let me say, you know, why CII is more buoyant, besides the fact that our internal surveys are more optimistic. You see, what we are seeing is a significant improvement in particularly in the agriculture sector, which was over 1% last year. We expect that to be closer to 4% because the monsoons are expected to be better. Second, we do expect services to actually go up by over 1%, the growth rate, because we do believe that discretionary tech spendings can in the later half start improving. So those are two areas we find improvement. And you know, the merchandise trade globally has been on the negative territory in the last year, is expected to be in positive territory this year. The delta is about over 3%. And hopefully with better crops, you know, the sticky part of the inflation today is food. That can be, that should be better. And hopefully that will also lead to easing of interest rates. So factoring in all these positives is where I think this CII has concluded that, or really what we are saying is that based on these factors, the potential is definitely there for 8%. And there are you know, strong reasons to believe that we can do it.
Right, Sanjeev, you know, let's talk about one of the headwinds that the CEA spoke of, which was the monsoon. But you're saying that as per CII's estimates and the feedback that you're getting, you believe that the monsoon is actually going to deliver the goods, and that's what is propelling you to up that forecast on agriculture from 1% to 4%. So again, I'm trying to understand, you know, the divergence of view between how the government is viewing monsoons and the impact on agri-economy and industry?
Yeah, you see, as far as monsoon is concerned, July is supposed to be a much better period. It's supposed to be above the average. And the recent latest data shows that we have caught up on the sowing. So the broader understanding amongst membership is that, by end of July, if all the sowing catches up, then we will be in a better position. Having said that, let me also say that today's situation of the climate emergency, the weathers tend to change in unanticipated ways. So those risks remain. But based on the available information, we believe we'll have a better crop this year. That's the anticipation, definitely.
Okay, so that's good to hear. But let's talk about private sector investment. And when we last spoke, Sanjeev, you were also talking about the fact that you see private sector investment picking up. It has already picked up, something that the chief economic advisor also alluded to, spoke about the recovery that we are seeing in private capex, but also making it clear that now the baton has to be carried by the private sector. How confident do you feel about that, Sanjeev Puri? While we are seeing this recovery and a pickup, what about the pace of private investment going forward from here?
See, as I said in the beginning, the indications from internal surveys in CII is pretty positive. So we do see that momentum continuing. Yeah, there are, and very clearly there are many sectors where there are opportunities. So we do expect the momentum to continue. And we of course do see the risk of the external factors bringing in some challenges, particularly areas where China has overcapacity, and you do find cheap imports coming in. So those areas are a concern, and that is where policy instruments to deal with that would be useful. And the other thing to really see is how can we provide further impetus to investments. So one area we've recommended is that to look at areas that have high labor intensity, areas like apparel, toys, footwear, tourism, etc. So can we be looking at an ALI? That's the kind of thing we spoke about earlier. And then the other set of reforms. Yeah. There are many factor reforms. All of those, ease of doing business, cost of doing business. So all of them will provide further tailwinds and strengthen the investment climate, and therefore we will see more investment. Overall, I think there's fair amount of optimism on investment going forward. I think the question is to not only sustain, but see how we can build on it and accelerate it by a set of further policy interventions.
Yes, in light of what you just said and what we also heard from the chief economic advisor, is there now a tempering of expectation on further heavy lifting by the government to drive investment by way of capex, which is the ask of industry?
No, I think it's important that public investment continues, because it is required for many sectors of the economy to make it competitive. And it is also doing the work of crowding in private investment. You do find a lot of sectors that are indexed to infrastructure doing well. And I think that momentum should continue. There's a lot of investments required in many areas also pertaining to, whether it's the rural areas. And that's the area where we have said that it would be useful to index the public capex more towards rural areas, because that's where non-farm jobs need to be created, and investments in infrastructure could be the fastest way of doing that. And then there are many investments as far as logistics related are concerned, whether it's ports, more needs to happen on airports. Lots have already happened, but I think the journey has to continue, because there is a lot more that the economy would like to see happening as far as India is concerned. The potential is much greater. So it should very much continue. And all of this is definitely adding to competitiveness of the economy by improving the cost of logistics.
One of the aspects that the survey highlights is perhaps the need for review and recalibration as far as our China strategy is concerned. And the survey suggests that it is perhaps time to review the FDI policy when it comes to China and actually draw in foreign direct investment from China to ensure that India does add on this aspiration of being part of the global supply chain. CII's view on what the survey says.
Well, CII has been, saying also a similar, has been suggesting a similar approach in the past. Of course, when we say that this should be looked at, we are not saying just a blanket everywhere. We can look at it in a more focused and targeted fashion. Which are the sectors that would be useful for the Indian economy? Which are the sectors that can also create productive capacity and jobs? So it should certainly be looked at selectively, yes.
You talked about jobs. The survey has put out an estimate saying that the Indian economy needs to generate an average of nearly 78.5 lakh jobs annually till 2036 in the non-farm sector. And of course, the expectation is that the private sector will do a lot of this heavy lifting. Do you believe that this is a doable number? Is this a realistic number, Sanjeev Puri? And what will ensure that we actually get to this number?
See, if you go firstly as per past data, and there are multiple sources of data today available, and all of them do suggest that jobs are getting created in a significant fashion. Now, to accelerate that, I think we need to look at certain sectors where the labor intensity is higher, and I alluded to some of them. If we can provide impetus and look at a resurgence in sectors like apparel, footwear, toys, tourism, furniture, wood-based industry. These are the kind of industries that have a high employment intensity. Even food processing also has a good employment to capital ratio. So these sectors, once they get greater impetus, I think these are where a lot more jobs can be created in future. And this is over and above, the sectors that are already creating jobs. Even as far as the tech services is concerned, I think in the recent past, the situation has been a little weaker because the discretionary spends on technology services have been muted globally. But that has to turn around because everything is requiring technological investments to be competitive. You can't kind of put it away for too long. So we do believe that it will turn around sooner than later.
Sanjeev Puri, finally, before I let you go, what's going to be the one number that you're going to be watching out for tomorrow when the budget is presented?
Well, we will look for, the investments in public capex. We will look at the fiscal, glide path being adhered to. We will look at the investments in social infrastructure. And we will look at also the infrastructure, the investments in the rural economy. I'm sorry, it's very difficult to put one number because one number won't be able to explain the story.
Yes, well, those will be the numbers to watch out for. Sanjeev Puri, we look forward to seeing you again tomorrow with your take on the fine print as the budget is revealed. But for today, many thanks for joining us with your perspective on what the economic survey has highlighted. We will head into a break, but up next, there's plenty more. We get more on the economic survey and the budget right after this. The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
We now do have the fine print of the economic survey, which is a precursor to the budget announcements that will follow tomorrow. But let's go across to Anish. Anish, many thanks for joining us here on CNBC-TV18. Let's start with what the survey highlights in terms of the growth projections. Sanguine on growth, also sanguine on inflation, saying that growth is steady and inflation is under control. 6.5 to 7% is what the survey assumes as far as growth forecast is concerned, which is on the lower end, on the more conservative side. How do you read this, Anish?
Shireen, good afternoon. We do see this as conservative as well, but from a budget standpoint, it's good to be conservative. We feel that it will likely come out higher than that. And we see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher, and that's something that is fairly significant. We see unemployment down from 17.8% to 10% at the youth level. And as we look at our demography and our job situation, that is also a very positive indicator. So I see a number of positives coming out in this survey.
Well, speaking of positives, but also trying to extrapolate what we could perhaps see in the budget, I want to talk about what the survey highlights in terms of India's vision of becoming Atmanirbhar. Over 1.28 lakh crore rupees of investments being reported until May 2024, which has led to production or sales of 10.8 lakh crore and employment generation, both direct and indirect, of over 8.5 lakh under the PLI scheme. The ask from industry is that there be more PLI schemes that are rolled out, at least as far as labor-intensive sectors are concerned, Anish. Is that the expectation that you go into the budget with? If yes, any specific sectors that you believe deserve to come under the PLI net?
Shireen, jobs is clearly going to be a big focus on the budget. And our view from an industry standpoint is that capital formation, investment is the way to go to create a long-term economy and not something that's done for the short term. We like PLI schemes that have come out so far. And the key factor always is that the incentives that are given should have a meaningful and lasting impact. So in that context, we would probably expect fewer PLI schemes than we've seen before. But what we would ideally like is a greater investment in infrastructure, a greater investment in capex formation that will be positive for the economy in the long term.
Yes, there is a whole chapter on infrastructure, Anish, as you pointed out. But, you know, the indication is that perhaps the government has done a lot of the heavy lifting, especially in the last few years, with record numbers being allocated there as far as public capex is concerned. And now the ask is of the private sector to do its bit. In fact, the survey talks about targeting 35% of private investment to GDP. So what do you go into the budget with? Do you expect that it will perhaps do a little bit better than the interim budget in terms of public capex?
We feel that it will, and you're also right that private capex has to step up. It hasn't so far. FICCI's manufacturing survey shows higher capacity utilization across industries, and also shows that 47 to 48% of companies are looking at investing over the next 12 to 24 months. And that is something that will help private capex grow significantly.
Anish, you talked about jobs, and the survey highlights that we have seen an improvement as far as the unemployment number is concerned. The survey also talks about the fact that India needs to generate an average of nearly 78.5 lakh jobs annually till 2030 in the non-farm sector. I mean, this is a pretty daunting task, daunting ask to Anish of the private sector, which will need to, in many ways, do the heavy lifting when it comes to job creation. Will it not? Is this doable? Is it feasible?
Daunting but possible, Shireen, because as we look at the Viksit Bharat goals, manufacturing has to grow multifold. Today, India has 3% of global manufacturing. Our target is to get to 12%. If we look at manufacturing as a share of GDP today, it's 16%. And we will need to get to somewhere between 20 and 25%, likely on the higher end. If we get to 25%, it means manufacturing has to grow 16 times in the next 23 years. And for that, India has to be the manufacturing hub of the world. A number of actions are being taken to make that happen, and which is again why we harp on government focusing on long-term aspects for the economy, putting in the capital that's required to add to what the private sector does as well. And that partnership, I think, will help us get to those manufacturing numbers and to those jobs that come with it.
You talked about the manufacturing aspiration, Anish, and the survey throws up an interesting idea or an interesting thought. It's asking for a review, essentially, of the policy with regards to China, and saying that in light of this China +1 diversification, India should allow FDI from China to come in so that we actually integrate into the supply chain and ensure that what we're now seeing, with business going to Malaysia and Vietnam and Indonesia, that isn't the case. So the survey calling for perhaps a more pragmatic view of the policy with respect to China. I want to understand how you as industry see that.
So the China policy has been driven by geopolitics. And that's an area that we will leave to the experts to think about. The one area that we will highlight is that across many industries, we are seeing cheaper imports coming in from countries that have high capacities. And we've seen the US and Europe starting to raise tariffs in certain areas as well. So that's one thing that will impact our focus on India being the manufacturing hub of the world, and something that the government will have to look at in terms of how it moderates it.
So, Anisha, the final countdown has begun now for the 7th consecutive budget that the finance minister will present. There's a long wish list of asks that's coming from industry. But if I were to ask you to whittle it down to one or two things that you believe will ensure that this is a budget that is appreciated, it's a budget that will continue to amplify and build on the growth momentum, what would those one or two things be?
So more on long-term economic growth and investment in capital expenditure. Second is less of populist schemes because we need more towards the long term. And third is a focus on jobs and manufacturing.
On that issue of, this business of that the budget could deviate from the recent past and be more populist, is that an expectation that you have? And on the back of what you've seen, for instance, in the survey, and not to suggest that the survey it's only an indicator of what the budget may or may not do, but do you get that feeling that this is likely to be a departure from the recent past with more populism, so to speak?
Actually, the political realities do point towards some element of populism, at least. We were very pleasantly surprised last year when the government did not go down the populist path in an election year and focused on a budget that was long-term and that was good for the country, and a lot of credit to the government for that. But again, there are political realities that have to be balanced.
So finally, from an auto sector's perspective as well, Anish, and the question mark on the FAME subsidies and what shape or form FAME 3 can take. But outside of that, also, confidence building measures, so to speak. What would the expectation be? The 2 or 3 things that you would watch out for in the fine print?
We would essentially want to stay the course in terms of where we are right now. I feel that we have got a good set of subsidies. Yes, FAME 3 is essential as a replacement of FAME 2 because FAME 2 has done a lot in terms of having the impetus for change to electric, especially in electric three-wheelers. And that impetus needs to continue for another 3 years for FAME 3 and then stop there. We don't need it beyond that. But that is important for it to continue. So therefore, I would just say stay the course. The rest of the incentives are in place. It's up for industry to now deliver.
India's largest startup platform. It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Hello and welcome to this very special CNBC TV18 Market Town Hall. A market holiday, I reckon, is the perfect opportunity to reflect and take stock of where we are and where we go from here. A little bit of crystal ball gazing is what we have in store for you. Now, to be sure, the gazing is going to be done by one of the foremost global equity strategists, Christopher Wood of Jefferies. Chris started writing his famed Greed and Fear note back in 1996. I personally have been reading it since 2004. It really still is the best take you will get about diverse investment opportunities, topics, and different markets week after week.
Oh, yes, absolutely. That was around the time I started looking at the markets here in India as well. Wow, it's a long, long time ago. Now, market lore about greed and fear. The note is that Chris writes this note usually in the country in which, he's traveling. So he's probably going to be in a different country every week or maybe a different city every week. But that's the folklore really surrounding greed and fear. Chris has been a big believer of India for some time now. Christopher, thank you so much. Let me welcome Christopher Wood, global strategist at Jefferies, to come up here on the stage and please join us.
Thank you.
Chris, thank you very much for being here.
Thank you.
Great to have you with us, as always. So I read out a bunch of statistics and I could have gone on, which showcases the performance of India. It's been extraordinary. I mean, when we report on markets day on day, we sometimes have to pinch ourselves and really ask ourselves, is this really real? I mean, or are we in a dreamlike state? You've been bullish on India for a long time, for a few years now. Are you still as bullish? Is India still your favorite market?
No, yeah, India's still, basically I've taken the view really, I suppose since the start of the century, that India is the best long-term equity market in the world. Clearly the US has done fantastically well. But in the emerging market Asian context, India to me remains the great domestic demand story. You have this very emerging equity culture. But what, as you rightly have just highlighted, is amazing is the dynamism of the local asset management industry and the growing retail participation. And actually everybody, I've been in Mumbai 2 days, everybody from the financial industry, I think, is staggered by the resilience of the market following the surprise election result. Myself
that was a surprise, that was a shocker.
Yeah.
And I think, I don't think anyone here in the audience as well thought the market will do what it did. One day there was a fall.
One-day fall, that's it.
And bounced right back to new highs.
No, I am staggered that the market only corrected one day. But what's interesting is that the domestic fund managers, the stockbrokers, I think have exactly the same view, and I suspect that a lot of them sold stocks that day, and the retail bought it off them. So it's a very unusual set of circumstances.
Chris, before I ask you market questions, what about the Mumbai monsoon? How have you managed to brave that? I think you got in over the weekend?
No, I have not been in the monsoon since I was an undergraduate. When I was an undergraduate, I lost my passport in Bombay in the monsoon.
Oh, now that's a story. That's a story, right? Okay, more of that in a bit. But, to get back to this fantastic market we've had here, and it's good to get a perspective from someone who's watching so many global markets, right? Because we sitting here sometimes feel that, is it getting excessive? We've not had a meaningful correction. Corrections are so shallow. They last 300, 400 points on the Nifty, and that's it. There's this gushing domestic liquidity that Prashant mentioned. What do you make of all of it?
Well, I think fundamentally it's extremely good news that you have growing domestic participation in the equity market. So I think the positive story is to see this as the beginning of an emerging sort of an equity culture. And if you go back to take the US example, between 1980 and 2000, we had a huge growth in equity investing in the US with the arrival of the 401k portable pension plan. So my understanding in India is you've got these emerging savings schemes which encourage equity investments. So I think that's just a long-term positive story. But in recent months, you've had growing direct retail participation as well.
Yeah.
So to me, when I was asked what the biggest risk in the Indian stock market was before the election, actually the biggest risk to me wasn't the election result, because I had the wrong view on the election result. I was looking at the potential for capital gains tax increases. Either an increase in the levy or the extension of the period where you have to hold a stock before you are considered a long-term investor.
You said that was a view you had before the election result.
Yes.
Now you don't worry there'll be a tax increase?
Well, I've got no idea, but I'm getting the sense from talking to local market participants, they think that risk is less likely. I mean, more likely to have action on this whole option.
on the options.
On the options, futures and options.
And we'll get to all of that in just a bit. But, just to go back to the market reaction and how retail came in, I mean, is that also a buffer to anything adverse which may or may not come out of the budget? I mean, we have the recent experience, 4th of June, when, it was a negative outcome from a market perspective. The market bounces back. So same thing could happen on the 23rd.
Well, I think there's a real rise in capital gains tax that would hit the market more than what happened after the election. But it seems like it's not good. It seems like the possibility of that has been reduced.
I mean, it's a thing which comes up before every budget, right? Rationalization of capital gains taxes. And so far, and I think at a philosophical level, governments all over the world also want markets to do very well, right? I mean, I think it's, and that's worked. There's a huge wealth effect. Why would you want to spoil it?
No, I know personally, many markets, there's no capital gains tax. In Hong Kong, there's no capital gains tax. And so there's actually, personally, I think you should have no capital gains tax, from my own personal opinion. But if you are going to have a capital gains tax, it makes sense to encourage long-term investment and have a big difference between long-term and short-term holdings.
You said that it will be more meaningful as compared to the election result if something were to come through. I mean, just elaborate on that a little bit more.
Well, no, because that just increases the risk-reward ratio of investing in stocks.
Chris, before we start talking about what you've liked in India, and you've been a big bull on property here, and I think maybe even ahead of the curve, ahead of many others, because you've got that spot on. But before we talk about what you've liked, or what you like, or what you're changing, again, just to understand the kind of domestic liquidity that's hitting the market, it's unprecedented. We've not seen it before. So what are the examples we can draw from global markets when this kind of money started coming through? Because the fear here is that going to create a bit of an asset bubble? And will we sort of have to deal with absolutely elevated, price to earnings multiples? So
the best example is that US example of the 401k driving growing equity ownership. And my understanding, obviously, the excess valuations in India, or the perceived excess valuations of the small mid-cap area, but my understanding in recent quarters, they've had the best earnings growth too. So it's not completely divorced from underlying fundamentals.
So you don't sound too worried?
No, to me, the where you see the risk of excess is in the direct retail participation, as opposed, because a lot of the money has been direct retail participation as opposed to the installment flows.
Mutual fund, the SIPs.
For our viewers, just to complete that point, you sort of compared the situation here, the local money coming into the US example. What happened then in the US?
It was a long-term bull market.
How many years? And I mean,
that whole equity count has been driving, started off in 1980 and basically ran until 2000. Then we had the NASDAQ. But essentially, it's been a benign cycle in the US and the households own equities. And that's one reason for the resilience of the US economy during this current monetary tightening cycle.
And once that money started coming in the US, was there a big difference how markets behaved post the 80s and before the 80s in the US?
In the 70s, the US stock market went nowhere because of inflation. It was just flat.
No, I'm saying, was there a structural sort of lift and buffer to the US stock market?
Yeah. So fundamentally, it's extremely healthy if the Indian stock market is driven by domestic flows and not dependent on what the foreigners are doing.
Okay, so that's out of the way. I think you've made it very clear that you don't see that as a risk. In India, locally, looking at things, and we've discussed capital gains, which could be a risk. Apart from that, anything else that kind of worries you or kind of tickles you at all?
No, the only issue, the risk in India is simply that some of these stocks are very high valuations, so there's a risk of earnings growth disappointments.
So earnings will have to grow into prices in that sense.
So, like, to give an example, the real estate stocks I've had in my portfolio for Greed and Perth portfolio a long time, but last year I would have added energy and more capex plays. So the capex plays have done very well. So obviously, if the order flows don't come in, that would be a risk.
Where are the foreigners? I mean,
well, on the foreign, so this is extremely interesting. The very bullish, the big point for your viewers to understand is the foreigners are remarkably underinvested in India. So we believe that the global emerging market funds, who are the prime investors in Indian equities, are barely neutral in India, partly because the neutral weighting of India has gone up because it's outperformed, and partly because they haven't really been able to get into the market because the local money has kept it at valuations where they're not comfortable with. But there's another point. Most foreign portfolios are still strongly influenced by what I would call legacy positions because they have big holdings historically in IT services and banks, which are a big part of the traditionally of the MSCI India Index. And while these are perfectly okay stories, they've not been where the performance has really been coming from. So what we're seeing is foreigners gradually capitulating and reducing the holdings in banks and IT services and adding to these hotter areas. But, you know, they're basically behind the curve.
You know, what we'll do is we'll take a quick commercial break. Ramesh and Utpal and others are all here. And we will continue this very interesting sort of back and forth discussion, interaction on the other side with all the D Street stalwarts and Christopher Wood of Jefferies. Stay with us.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18 embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more.
Welcome back to this special CNBC-TV18 Market Town Hall. We are in conversation with Chris Wood of Jefferies. We also have Ramesh Damani and Utpal Seth, market veterans, the Lal Street market veterans here on the stage now with us. Thank you all once again. And of course, we've got a wonderful audience here. Once again, I'd like to thank all of you for being here and being part of this. Utpal bhai, if you can sort of, I'm just here to facilitate the conversation. I think it was flowing beautifully. So I'd urge you to sort of, share your perspective.
Thank you, Prashant, and welcome, Chris.
Thank you.
The 401k parallel that you drew, I think was very fascinating, and that was the driver of a structural and secular bull run in the US. It will be great if you could share with us what percentage of the pension funds eventually have exposure to US equities, and given that in India we've barely reached about 12% or so right now.
So 12%
of the pension funds
assets in equities.
Of assets are in equities.
Oh well, they could get a 50%. That wouldn't be outlandish. So we're just in the very beginnings. This is just extremely the very early days. And obviously, you just need the tax incentives to encourage people to invest in equities. But my understanding, they exist. So to me, we're right at the beginning.
And a lot of it, of course, will also depend on how the economy itself does, right? When people have, as the country gets prosperous, and that's what happened with the US as well. Because, I mean, one could make the argument that those who can invest in equities and those who have the disposable income are already here. And now the country's got to get richer for more and more of the population to get into equities. I mean, would you?
Yeah, but from my understanding, these pension schemes are recently conceived, right? With the tax incentives.
The NPS.
Yes.
Relatively newer company.
So to me, if it was like the test match analogy, you're at the first morning session. It's really very early days. So obviously, in the long run, you're right. That's an issue, but I wouldn't. That's not that to me, we're right at the beginning of this whole development.
How much of just to take
but
off?
you also have a history. You have a tradition of a stock market here. You see, in China, you didn't have that tradition. You didn't have the legal infrastructure for a stock market. So India's had a long tradition of a capital market, so that helps it as well.
Got it. Ramesh Damani here, as I was saying earlier, was one of the early backers of public sector stocks, defense stocks, and those have been the clear leaders of the bull market. Ramesh, I just want you to share your latest thoughts and perspectives on it. I mean, Chris earlier was saying that he would bet tactically on consumption, but the big story still remains infrastructure, and a lot of it is sort of conducted through public sector enterprises. So just your thoughts.
Yeah, Prashant, Chris, I mean, what I have noticed over various bull markets, I've been in India for 30 years, is that bull markets always have leadership. In 90s in India, the cement stocks led, 2000, the tech stocks led. This time it is the public sector stocks leading, which was the most unloved, unknown, under-owned sector, which of course is a prerequisite for it to become market leadership. And a lot of people are left out feeling because they didn't enter it, and they're saying, first it was, oh, I'm not going to buy PSU at any point, no matter how cheap it is. Now they're saying, oh, it's too expensive, that's why I don't want to buy it. But the fact is the stocks are about up 20x, 30x in between that time. So I believe that this leadership will continue because of better corporate governance, more government expenditure. And, eventually all bull markets end, and so will the bull market in public sector stocks, I'm sure. But till then, I think there's a party going on. What do you think?
No, I agree. Now, the defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks, but the problem in India is what not to own. Right. So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say, in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
You talked about energy, Chris, though. Would you bet on the old fossil fuel energy, the oil, coal, because you think there's still a long way to go before energy transition? Or would you say, I'm going to avoid that and bet only on solar, renewable, etc.?
No, I've got the traditional energy sectors. To me,
actually performed well.
Yeah. So no, I believe that's a hedge. That's been a hedge. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy.
Energy.
And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return, dividends. They're defensive, but they could be like tobacco stocks. Tobacco stocks the last 20 years have been good performers. So
Absolutely brilliant performance, surprisingly.
Yes, I would make the analogy with tobacco energy stocks. And also, the reality is fossil fuel is going to be around for a long time yet. Obviously, there's been an ESG constraint on some investors to own these stocks. But I'm not sure how big. I'm not sure ESG is not really big in India, right?
It's getting there.
Yeah, so ESG, in my view, peaked as a movement in the fourth quarter of 2021. There's always been a big belief in ESG in Europe. In the US, ESG only really started to exist in recent years, but it's now become part of the political divide. So for one side of the political factions in America, ESG is like a villain. The other side, they believe in it, so it's become politicized. And in Asia, ESG has never really taken off, as far as I can see.
It's there in every balance sheet as a disclosure of what they do for ESG. But Chris, I want to take up another point. You talked about inflation. Do you think the G7 will get inflation back down to the 2% rate that we enjoyed? And will it continue at 2%? What are the risks to that?
Now, my base case has been that inflation in the US is likely to end up a bit higher than where it's been, maybe 3-4%. Because my base case is when push comes to shove, the Fed will prioritize the economy and the labor market over inflation. The surprise to me, though, I have to admit, is how resilient the US labor market has been. I would have thought we would have seen more clear weakness of the labor market by the start of this year. I think the Fed wanted to see labor market weakness because the Fed wanted to start cutting rates earlier, because I would have argued 2 or 3 months ago that the Fed wouldn't want to cut rates after July, because their concern would be that they would then be attacked by Donald Trump and be politicized. However, I've now changed my mind on that. I now think but as of data up till today, I think the base case is the Fed cuts rates in September after the Jackson Hole meeting. And I think the political constraint on the Fed's been removed, because the reality, even before someone tried to kill Donald Trump, the Biden health issue basically has meant that Donald Trump's in a very strong position, and all Donald Trump needs to do right now is to do something which is not naturally easy for him, and that is to stay quiet and be the unifying candidate, because so attacking the Fed would be crazy for him to do now. Right. And so basically, I think the Fed can cut rates in September based on data right now, and that's why you're seeing the US equity market, getting more risk on again.
Chris, sorry.
Go ahead, please.
Chris, if you could throw some light on the difference in the performance of the small caps versus the large caps in the US and the other way around in India.
Well, I would have to tell you, India is the only stock market I'm aware of right now where the small mid-cap sector is doing way better than big caps. Absolutely unique. And it's driven by this domestic phenomenon. This is not replicated in any other market right now. On the US stock market, the consensus view at the start of the year was that the US has achieved a soft landing and the US equity market would broaden out. The exact opposite's happened. So the US stock market's become narrower, which fundamentally is not healthy. However, it's not a speculative bubble, because I can show you a chart, and the Magnificent Seven earnings growth is just way superior to the broader market. So, yeah, this.
But in the last week, it's been broadening out. Yeah. The Dow and the S&P has been broadening.
That's because the market now is getting more optimistic on a rate cut.
Rate cut, absolutely.
But obviously, if the rate cut reflects a weakening economy,
that's not good.
Yes, so, but that's why it's broadening out. But the key point is NVIDIA performance is so far fundamentally supported by phenomenal earnings and revenue growth on the part of NVIDIA, which is obviously the star stock.
I think on a forward basis, it's still trading at whatever, 35, 40 times, right? And
so I actually started a global equity portfolio recently, and I started at the worst possible time. I started it 2 days before the Microsoft purchase of GB Chat. Now, the irony is the most important development in world stock markets last year was nothing the Fed did. It was the Microsoft purchase of GB Chat, because that gave the biggest sector in the world's biggest stock market, the US tech sector, a new story. And I had about huge percentage, like 18% of my global portfolio in India, which is about 8. But luckily, I got positioned for the AI story during April after I talked to someone who explained to me in simple English why NVIDIA is in this unique position.
I have two questions. One, will Fed cuts matter? I mean, they not hurt us when Fed was hiking interest rates. So will Fed, because we keep talking about, well, when will Fed cut rates? Will that matter in a significant way for markets?
Well, for emerging market asset class in general, it matters hugely because the Fed cutting rates allows all these central banks in Asia to start cutting rates, because all the Asian central banks could cut rates, including the RBI, by the way, could cut rates for their own domestic demand reasons, because the inflation is lower than in the West, but they've been holding off because they don't want to undermine their currency. So I think for emerging markets, it matters a lot. I think it matters less for India because India's in this amazing bull run anyway.
It's a fantastic discussion, and I think all of us would like to do this again, and we hope that we're able to get this gathering back again once we have the budget. And you were telling us earlier that you were going to come back after the budget. So,
maybe.
So we'll invite you here once again. But thank you very much. Enjoy the rest of your stay here in Mumbai, Chris. And thank you for dropping by here into our studios. Rameshji, Utpal, great to have you with us here and kind of sort of facilitate the conversation. Lots of learning, and thank you very much, all of you.
Celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. The budget session of Parliament kicks off and the Finance Minister tables the economic survey, projects GDP growth for this fiscal between 6.5 to 7%, says real GDP is now near pre-pandemic levels, expects inflation to remain largely under control, and says it could be worth exploring if the inflation targeting framework should include food inflation. The economic survey calls on the private sector to take the baton on capital expenditure, highlights that private capex has grown by just 80 basis points from FY19 to FY23. Also bats for FDI from China, saying it can help increase India's participation in the global supply chain. After warnings from RBI and SEBI, the economic survey red flags the rise in derivative trading volumes on Dalal Street by equating it to gambling, calls for careful consideration on the rise in F&O participation, but stops short of suggesting specific measures. As Parliament reconvenes, government faces the heat from the opposition on the NEET controversy. Rahul Gandhi says millions of students are convinced that the Indian examination system is a fraud. Education Minister Dharmendra Pradhan hits back and blames previous UPA governments for failing to bring a law to curb cheating in examinations. Stock markets tread with caution a day ahead of the union budget. Sensex and Nifty end a choppy session with marginal losses. After days of speculation, US President Joe Biden withdraws from the upcoming presidential race, says it is in the best interest of his party and the country, endorses his deputy Kamala Harris. All 50 state Democratic Party chairs endorse Harris as the presidential nominee. The Supreme Court orders a stay on Uttar Pradesh government's directions that made it mandatory for eateries along the Kanwad procession route to display the names of the owners. Notes that the state police tried to usurp power it did not have by issuing directives. However, clarifies that eateries should disclose the kind of food being served. All right, it's the eve of the union budget. Finance Minister Nirmala Sitharaman tabled the economic survey as the budget session of Parliament kicked off. Released a day ahead of the union budget, the survey is a comprehensive report of the government on the Indian economy. However, the recommendations and suggestions made in the survey are not binding on the budget. The survey projects GDP growth for FY25 between 6.5% to 7%, with risks evenly balanced. The survey also noted that real GDP is near pre-pandemic levels. On inflation, the survey is largely sanguine. While the headline inflation rate is under control, there are concerns over specific food items. The survey also called on private sector to take the baton on capital expenditure. It highlighted that private capex has grown by just 80 basis points from FY19 to FY23. The survey also made a pitch for allowing FDI from China, saying it can help increase India's participation in the global supply chain. After warnings from RBI and SEBI, the economic survey also red flagged the rise in derivative trading volumes on Dalal Street. It calls for careful consideration on the rise in F&O participation, but stopped short of suggesting specific measures.
Real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered. Households are not in distress. Households actually are investing in financial assets which have done very well. Capital market participation by retail investors is a very healthy and a very welcome thing. The issue is in what kind of capital market participation that they are engaging in. Speculative trading in futures and options is something that I have commented upon earlier, and that's exactly the point that we are driving at, because they are not exactly benefiting either the households or the purpose of capital formation in the overall economy.
For a long time, review of our direct tax code has been pending, and what better time than the start of a fresh administration, a new government. I think simplifying the tax code is frankly more important than giving away SOPs, although I know that will be all of the attention in the pink papers when once the budget has been presented.
I would say it's a cautious estimate, and it's, I think, prudent to be a little cautious because that does impact the projections on revenues, etc. What we are seeing is a significant improvement in particularly in the agriculture sector, which was over 1% last year. We expect that to be closer to 4% because the monsoons are expected to be better. Second, we do expect services to actually go up by over 1%, the growth rate. Really what we are saying is that based on these factors, the potential is definitely there for 8%.
We see a number of other positives in this survey. Inflation being under control is a significant positive. And then as we look at some of the real numbers that have been shown for F24, capital formation is 9% higher, and that's something that is fairly significant. What we would ideally like is a greater investment in infrastructure, a greater investment in capex formation. That will be positive for the economy.
Lata Venkatesh joins us with the editor's take. Lata, how are you reading into the economic survey? Any telling signs for the economy?
It's a very moderate, middle-of-the-road kind of assumption of 6.5% to 7%. If you add the 4.5% CPI forecast of Reserve Bank and probably around a 3% WPI forecast, inflation is actually lower. So the 10.5% that they have gone with in terms of nominal GDP growth in the interim budget, there's no reason to change it. Even the tax buoyancy, which we were all expecting would get worked into the new numbers, if you're very modest in your growth aspirations or your growth expectations, I'm not even sure that the tax assumptions are going to be scaled up much. So if anything, the bond markets, after that initial enthusiasm, is back to where it was before the survey. There isn't so much expectation that there will be a huge cut in fiscal deficit. There is still the one-off RBI dividend. What they will do with it remains a question mark. But there is no extra assumptions that, oh, we can do welfare and we can do capex and we can cut deficit. That enthu has gone down a bit. With respect to stock markets, the big worry was about what do they think about the surge in stock prices. And there, the CEA leaves you in no doubt that he is worried about it. I'll read just two quotes, but I can pick 5 or 6, just at the snap of a finger. One quote, very serious warning on, the quote, the financialization of economies has not ended well, even for advanced economies. And then there are many, many examples. Another quote, all stakeholders, capital markets, regulators and government must ensure that capital markets play their theoretically assigned role of directing savings to their most productive investments. It is not just in the national interest, it is also in their selfish interest. So here again, seeing what the SEBI chairman said, they must go for capex and must not go for speculation. And I'm only picking 2 points again and again. So clearly something will come now, whether it will come in the form of taxes or whether it is a directive from the government to tell SEBI, you better be a nanny regulator, we don't know. So that still leaves a question mark, but we are not in doubt that the FNO volumes and the market surge in general has not been taken too kindly by the government. And finally, there is some mention of inflation targeting. Remember, now the current inflation targeting framework targets 4% headline inflation. But there is a small paragraph which says that maybe we need to review that targeting and exclude food because that can't be impacted by interest rates. And it is coming in a context where they want to encourage farmers. I mean, among the many things you can do to farmers is don't take off options trading at the first hint of, some commodity price going up. Don't ban exports at the first hint of a price rise. And the third thing they say is maybe you remove food from the inflation targeting scheme altogether and make the Reserve Bank target a food excluded inflation target. Well, I don't know if this is a very serious suggestion or it's just one of the many, but this is something the bond markets will chew over. It's not immediate, but we will have to wait and see.
Right, thank you, Lata, for those comprehensive updates. On to the market action of the day. Dalal Street treaded with caution ahead of the union budget. Nifty and Sensex ended a choppy session with marginal losses, while the Nifty Bank ended flat. Mid-caps bucked the trend to end over 1% in the green. Now, days after warnings from both the RBI and SEBI, the economic survey has also red flagged the rise in derivative trading volumes on Dalal Street by equating it to gambling. It has called for careful consideration on the rise in FNO participation, but stopped short of suggesting any specific measures.
Market participants to understand where they are at on this particular subject. So I'm going to just quickly put out these views. Nilesh Shah of Kotak Asset Management Company told us, and I quote, I think the SEBI chairperson is absolutely right in stating that F&O activity is both a micro as well as a macro issue. From a macro point of view, there's the issue of savers becoming speculators rather than investors, resulting into misallocation of savings and low capital formation. From a micro point of view, it adds, there is the need to create a level playing field between local and global participants in the F&O segment. Sarup Mohanty of Mirae Asset Management also weighed in. He said the number of people who have started this return chasing is scary. While the market cap and the number of available stock and free float seems to have widened, what does not change is the liquidity status of the market. Everything is okay, he said, until inflows are higher than outflows. The day that changes, it can go totally in a very wrong direction. Radhika Gupta of Edelweiss Mutual Fund also weighed in. Regulators have rightly pointed out that most such people don't make money and the potential for losing disproportionate money is high. I do hope the issue is addressed through regulatory interventions. Ravi Dharamshi is a prominent investor, runs Value Quest. He said, we can expect measures such as an increase in STT on non-delivery trades, stricter regulations on derivative trading, enhanced investor protection programs, and improved market monitoring and surveillance. Deepak Shenoy of Capital Mine says that option premium is about 60,000 crore rupees per day. All of it goes into bank accounts. According to him, the speculation in F&O doesn't cause a banking problem. It's a social issue, but it's not about liquidity. Rajesh Baheti of Cross Seas Capital recommends changing of lot size or increasing lot size to between 20 and 25 lakh rupees, which according to him would be the most effective step to control retail participation in F&O. He says rather than changing a multitude of variables at once and damage the market more than intended, SEBI should change the lot size variable, wait for new data and then assess if further steps are warranted at all. As I said, lots of views coming in and markets really anticipating some measures from the market regulator in the days ahead. Back to you.
Thank you, Prashant, for that. Meanwhile, opposition parties sparred with the government over irregularities in the NEET fiasco. Congress MP and Lok Sabha leader of opposition Rahul Gandhi expressed concern over the integrity of the Indian examination system. He added that the education minister has refused to take accountability. The minister countered the allegations, saying that no paper leaks had occurred on his watch. He then hit out at the previous UPA governments for failing to bring a law to curb cheating and unfair practices during examinations.
It's obvious to the whole country. It's obvious to the whole country that there is a very serious problem in our examination system. This is not just a question of NEET, it is in all the major examinations. Now, the minister has blamed everybody except himself. Right? I don't even think he understands the fundamentals of what is going on here. The issue is that there are millions of students in this country who are extremely concerned at what is going on and who are convinced that the Indian examination system is a fraud.
अध्यक्ष महोदय, ये सरकार किसी और का रिकॉर्ड बनाए ना बनाए, लेकिन पेपर लीक का रिकॉर्ड जरूर ये सरकार बनाएगी। पूरे देश के छात्र इस पे आंदोलित थे। लगातार अखबार और सीबीआई की जांच के बाद चीजें सामने आ रही हैं, लोग पकड़े जा रहे हैं, जेल भेजे जा रहे हैं। अध्यक्ष महोदय, मेरे आपके माध्यम से एक ही निवेदन है कि बिना ये मंत्री जी रहेंगे तो न्याय नहीं मिलेगा बच्चों को।
सर, जिन्होंने रिमोट से सरकारें चलाई है, 2010 में 3 बिल आया था सर शिक्षा सुधार के लिए। उन्हीं की पार्टी के नेता आदरणीय कपिल सिब्बल साहब 3 बिल लाए थे। उसमें से एक बिल था एजुकेशन, उसमें एक बिल था प्रोहिबिशन ऑफ अनफेयर प्रैक्टिस बिल 2010, जिसकी उद्देश्य एजुकेशन इंस्टीट्यूशन में माल प्रैक्टिस को बंद करना। क्या मजबूरी था कांग्रेस पार्टी की, क्या मजबूरी था नेता प्रतिपक्ष की? उन्होंने उस बिल को उल्टा किया, किसके दबाव में उल्टा किया? क्या निजी मेडिकल कॉलेज की दबाव में, उनकी घूसखोरी की दबाव में उन्होंने उस बिल को उल्टा किया था?
Moving on, the Chandrababu Naidu-led Andhra Pradesh government has sought a special package worth 1 lakh crore rupees from the centre. Remember, the Telugu Desam party, which registered a thumping victory in the assembly elections to storm back to power, is the BJP's largest ally at the centre. Now, Jude Saneth joins us from Vizag. Jude, the budget will be presented in less than 24 hours. Fingers crossed for Naidu?
With just a day to go for the union budget, the state of Andhra Pradesh and Chief Minister Chandrababu Naidu has requested for a total corpus of 1 lakh crore rupees by way of that much hyped special economic package for the state. Nearly 50% of this, that's 50,000 crore rupees, Chandrababu Naidu added, must be allocated or set aside towards building his ambitious greenfield capital of Amravati. The justification really is that a corpus along these lines by way of the package will be required to quote-unquote rebuild Andhra Pradesh after what the state claims was an unjust bifurcation of the state back in 2014. Another project of interest is the Pallavaram project, which the state says should see an allocation of approximately 12,000 crore rupees. Now that's what the state government wants. Let's also take a look at what the industry wants by way of that special package. First up, specific focus on 3 sectors: pharma, steel and infrastructure in the state of Andhra, even as central guarantees, the industry said, must be required insofar as investor sentiment and investment policies are concerned, especially given that 2 governments came and went, but little moved on the ground back here in Andhra Pradesh itself. But it's not just that. Incentivization of investors and interest really insofar as the greenfield capital of Amaravati is concerned, even as the industry wants ease of doing business to be implemented both in letter and spirit across the state. So in a nutshell, that's the long and short of what the industry and the government wants from that special economic package for the state of Andhra Pradesh.
The special package, what the state is looking as perceived by the state, is that for Pallavaram project and construction of Amaravati and so many central universities to come into the picture, and some specific sector specific incentives or initiatives. But as far the industry is concerned, the industry naturally will get benefited if all these special packages come, and there will be a lot of economic activity coming through these packages, like be it Pallavaram project or capital Amaravati or a special zone like railway zone, and particularly Visakhapatnam steel plant.
And some of the special incentives, which can spur industrial growth in the region, especially like the petrochemicals. You may have heard about the BPCL announcement recently. So that can create a whole lot of vibrancy. And green energy is the second area of focus, and data centers, and again IT, electronics, semiconductor manufacturing. So we're expecting that Finance Minister would make some good announcements. She would be judicious, rational, and rather maybe empathetic to truly help realize the state's true potential.
The union government has reiterated that Bihar will not be granted special category status. The Bihar government lead Chief Minister Nitish Kumar has been demanding a special status for the state for a while. The state government had also reiterated this demand during the all-party meeting on Sunday. Opposition party Rashtriya Janata Dal has demanded Nitish Kumar's resignation. Remember, under the current provisions, special status cannot be granted to states. All right, it's time for a short break. Coming up next, after days of speculation, US President Joe Biden has withdrawn from the upcoming presidential race. Details when we return.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
Welcome back. Here's a quick look at the other headlines we're tracking. The Supreme Court has stayed Uttar Pradesh government's order directing eateries on the Kanwad Yatra route to display owner details. The interim stay will also apply to the Uttarakhand government's directive, which mandates similar disclosures. However, the court did clarified that eateries should disclose the kind of food being served. It will hear the matter again on the 26th of July. Bangladesh's Supreme Court has scaled back the High Court's controversial government jobs quota order, which has been at the epicenter of weeks-long unrest in the country. At least 150 people have reportedly died in the clashes with police. The Supreme Court, in its order, cut down the jobs quota for descendants of veterans who fought in the 1971 war from 30% to 5%. 2% will be set aside for members of ethnic minorities and transgenders and disabled people. The Supreme Court said that remaining 93% of government jobs to be allocated on merit. At least 39 Palestinians have been killed and dozens injured after Israeli troops launched a fresh assault on Khan Yunis, located in eastern Gaza. The air attacks and artillery shelling came minutes after the IDF gave an evacuation order to people in the region. Meanwhile, Israeli Prime Minister Benjamin Netanyahu said Israel will dispatch negotiators to start stalled captive exchange talks this week. US President Joe Biden has dropped out of the presidential race. He has endorsed Vice President Kamala Harris as the Democratic Party's nominee. Biden, in a written statement, said his withdrawal was in the best interest of the party and the country. The move came after weeks of pressure on Biden to drop out after his debate with Donald Trump in June raised concerns over his age and mental fitness. CNBC's Iman Javers joins us now. Iman's Biden bows out, makes way for Kamala Harris.
Kamala Harris, you'd have to say at this point, absolutely the front runner, but has not clinched the Democratic nomination. That process will be official, we're told, and will start on Wednesday of this week with a meeting at the DNC, which will be televised and available on YouTube for everybody to watch. So some fascinating behind-the-scenes moments last night. One indication that those phone calls were starting to pay dividends is the fundraising success that Kamala Harris had overnight. The campaign, Barack Obama, for example, nothing from Nancy Pelosi. The big names in this party have not moved behind her definitively, and that leaves a little bit of room open for somebody who might want to challenge her. The question is whether there's anybody in the party now who wants to try to do that.
Right, with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV18. Stay tuned.
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab.
Hello and welcome to this special pre-budget broadcast. I'm Parikshit Luthra. Nirmala Sitharaman is set for a date with history this coming Tuesday. She will become India's first finance minister to present the union budget for the 7th consecutive time. It is going to be a tightrope walk for the finance minister. On the one hand, the government would want to tread on the path of fiscal discipline. On the other, the industry is hoping for more measures to boost growth, and taxpayers are assigning some sweeteners. So what should one actually look forward to when the budget is presented? Lata Venkatesh is here with the big numbers.
Well, let's talk about the big numbers in the budget. This is the first time that the standout feature of the upcoming budget is that the government has more money than it expected. It has higher tax and non-tax revenues. Firstly, the government has got a 2.1 trillion rupee dividend from the Reserve Bank, whereas the interim budget had estimated only 80,000 crore dividend. So overall non-tax revenues are going up by 1.3 trillion rupees. Finance Minister Sitharaman may also estimate the tax revenues higher by about 40,000 to 50,000 crore. One, because the final receipts of FY24, that's last year, show that the government collected 27,600 crore rupees more than the interim budget estimated. That's partly why, if you remember, the fiscal deficit had fallen to 5.6% from the estimated interim budget number of 5.8%. Secondly, tax revenues in the April to July period are on an average 12 to 22% higher than last year, showing that the economy is perhaps more buoyant than expected. So the interim budget estimate of a 12% rise in direct taxes can easily be upped to 14 to 15% given the performance of the first quarter, especially direct taxes. All told, Sitharaman may raise the gross tax revenue from 38.3 trillion to 38.7 trillion. After transfers to states, the net tax revenue may jump from 26 trillion to 26.4 trillion. Adding the non-tax revenue advantage, total net revenues to the centre may rise from 30.8 trillion in the interim budget to 32.5 trillion approximately when the final budget comes. Given that we expect government revenues to be at least 1.5 to 1.7 trillion rupees higher, how will the government use it? Now, economists estimate that capex may be increased by about 40,000 crore and revenue expenditure may be increased by 60,000 crore. Some say capex won't be raised much and revenue expenditure via programs for rural development and agriculture may be upped by maybe the entire 1 trillion rupees. The rest of the excess may be used to bring down the fiscal deficit from 16.9 trillion rupees estimated in the interim budget to probably 16 to 16.34 trillion rupees. Hence, the fiscal deficit can fall from 5.1% in the interim budget to 4.9 or even 5%. Now, if the deficit indeed goes down, the government may have to borrow less from the market, probably about 50-60,000 crore less. Now, this lower borrowing by the government can push down bond yields, and that will mean the cost of capital for companies also comes down. Of course, the government may choose to spend more and keep the deficit at 16.9 lakh crore or at 5.1% of the budget, but a fall in the fiscal deficit can mean a huge leg up to a possible upgrade of India by the rating agencies, which will mean a paradigm shift in borrowing costs for India and for Indian corporates. So much hinges on this budget.
Better access to credit and ease of doing business. That's what MSMEs want from the upcoming union budget. CNBC-TV18's Shilpa Ranipeta reports that the MSMEs in Maharashtra also want the government to ensure better implementation of schemes announced during the budget.
India currently has 6.33 crore MSMEs, which together employ over 20 crore people. But the sector continues to face a multitude of problems and hurdles, from a lack of credit access to an unfavorable business environment to high costs. These enterprises are now looking to the Modi 3.0 government's first budget to offer a solution to some of these problems. Their top requests: continue the rule mandating payment within 45 days from a date a product or service is delivered, and expanding the NPA classification period from 90 days to 180 days.
See, I am pursuing this NPA 90 days to 180 days to be changed as definition for last 2 years. I had a meeting with the two RBI deputy governors where we have also discussed this point that 90 days is very less period for any company to become NPA. They should not change the definition of 45 days payment to be receivable from the corporates and PSB or any PSU. This is a strict, we have recommended to the minister that should not change at all. Because of that, so many SMEs are dying. They are not getting their trade receivable.
Access to credit is a hurdle MSMEs have been grappling with for years. The government has announced a few relief measures like the credit guarantee scheme. But MSMEs say the compliance burden and actually getting the funds under these schemes are problem areas.
Wherever the MSME approaches banks and they don't get any loans without collaterals. Okay. So the collaterals plays a very important role, whereas the MSME doesn't have that flexibility to bring in a collateral and take the loan facilities. So it really doesn't work that way.
We have recommended that the MSME sector should be given in sort of an priority sector. The banks should give them at a lesser interest, and by which the manufacturing can be encouraged. Correct. Government intent is there, but the banks are not really in the ground level. It is not happening.
Data from the government shows that 11.65 lakh guarantees worth over 1 lakh crore rupees were approved in FY23 under the credit guarantee scheme, and under the Pradhan Mantri Mudra Yojana, which offers collateral-free loans of up to 10 lakh rupees, total disbursals stood at 5.2 lakh crore rupees as of FY24.
While access to credit and capital is critical for MSMEs, many of them say that support in terms of technology, capability building and upskilling is equally critical for them to grow from micro to small to medium to eventually large enterprises.
For this, they hope the budget will allocate funds towards upskilling and reskilling enterprises.
Besides having technical understanding of the business, entrepreneurs and their organizations needs to understand management science also along with it. Management science plays a vital role in the growth or transformation of any organization.
Infrastructure is another area in which the sector hopes the government will help.
Providing reduced electricity for the MSME exporters, because many areas are landlocked countries and they don't have any port facilities. So we have requested to provide dry port facilities. We have requested to increase the basic custom duty of the value-added products, because what is happening is presently the FTAs are not having that reciprocity. So if you are importing these low-end substandard products, the domestic industry is going to be affected.
MSMEs account for over 45% of the country's exports, and so the hope is the government will come up with more measures or enhance existing ones to boost exports.
Budget may see the announcement of the setting up of a global trade body. This, experts say, is good news for the industry, as it not only gives smaller enterprises exposure to international markets, but will also help boost exports and reduce India's rising trade deficit. In Mumbai, Shilpa Rani Petra.
From Lakpati Didi to the Ujjwala scheme, the budget is likely to focus on women-centric welfare schemes, both in terms of new schemes and also better allocation for existing ones. CNBC-TV18 Sandhya Gora takes a look at the schemes that could see special focus and also the government's rationale behind it.
Women empowerment and upliftment has been a pillar of the BJP dispensation since it first came to power in 2014. When it first came to power, it announced schemes like the Ujjwala scheme, which promised access to cheaper cooking gas for BPL women, and the Beti Bachao Beti Padhao, a multi-layered program on women's health, improving the sex ratio and girl education. Both schemes have been successful. Under the Ujjwala scheme, for instance, the government has provided over 10 crore free gas connections so far and has consistently allocated a high budget to this scheme. A much newer scheme which was introduced in the BJP's second term is the Lakpati Didi scheme. It aimed to provide vocational training, interest-free loans up to 5 lakh rupees and other assistance to 2 crore members of women's self-help groups aiming to push their incomes above 1 lakh rupees annually. In the interim budget, Finance Minister Nirmala Sitharaman said the scheme had 1 crore Lakpati Didis and increased the target to 3 crore Lakpati Didis by the end of 2026. So experts say this scheme could see more allocation in the upcoming budget. Now, one reason experts believe these women-centric schemes could see a higher focus is that BJP has long considered women voters a critical vote bank. According to Lokniti CSDS survey, 36% of the women voters in 2024 favoured the BJP, the same as in 2019, but higher than the 29% in 2014. Now it has 4 state-level assembly elections coming up and it does not want to lose this momentum. So it's not just the center-level schemes that are expected to see a higher allocation in the budget. At the state level also, women-centric schemes that can be availed in addition to the central schemes may be on the anvil. NDA-ruled Maharashtra, which goes to polls in October, has already announced such a scheme. The Mukhyamantri Ladki Bahin Yojana promises financial assistance of 1,500 rupees per month to underprivileged women in the 21 to 65-year age group. The BJP is also aware that a few other states have already implemented their own women welfare schemes, many involving a cash handout, like Madhya Pradesh's Ladli Bahin Yojana, West Bengal's Lakshmi Bhandar scheme and Assam's Ornoday scheme. Tamil Nadu, Telangana, Karnataka and Delhi also have similar schemes in place. So new schemes in BJP-ruled states that don't yet have such women-centric schemes cannot be ruled out completely, especially with more states going to polls in the coming years.
All right. Thank you, Santya, for joining us with that report. Time now for a break. But up next, from higher investments in artificial intelligence and green energy to higher outlay for education, Young India has its priorities in place when it comes to the budget. The CNBC-TV18 budget box travels to college campuses across the country. We get you the students' wish list up next.
AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
Big US tech companies have huge cash balances, so they're getting 5% where they would get before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector. The CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the two key, those are the the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. What I've done with AI, I'm viewing AI as a picks and shovels play.
Hi, you're watching CNBC-TV18. I'm Archana Solanki. The countdown for the budget 2024 has started, and we are traveling with our budget box across the country. Why? Because we want your voice to reach the finance minister. We want you to tell us what should be done in this budget. Today, I am at the Willingker Institute of Management, and I have with me some bright students who want to share their budget wish list with the finance minister. Let's get started. Hi, please introduce yourself and tell us what you want the finance minister to do.
Hello, so I am Kripali Patel. So looking forward to the upcoming budget, I would like to see more funding in the artificial industry. So where AI is booming a lot coming this year, so I feel that more of investment in the R&D in different sectors like healthcare, education, defense and agriculture is something like it should be mentioned in the budget. Also AI literacy is something very important. So more of institutions regarding to the AI and also like a partnerships with the academics and with the institutions and with the industries is something very important for enhancing AI as an profession. Also, the Startup India initiative is something very important. So this will help the AI startups to boost regarding incentives which they require, and for the startups, the incentives, infrastructures which they require for. Also, AI has two aspects which I feel that it's one of the data centers and the semiconductors. So with respect to the data centers, AI requires large data and to build its model upon. So more of infrastructure space with regard to the data and building upon that is something that should be looked after into the budget. With respect to the semiconductors, Taiwan is one of the leading semiconductor manufacturing across the world. So more of infrastructure in designing and in the research of having this is important into the budget. Thank you.
Hello, my name is Ananya. I'm a second year MBA finance student. So one of the major expectations I have from this budget is more investment in the research and development field. As we all know, currently it's just 0.6% of the GDP. So for any developed country to grow, R&D sector is one of the major backbones. So I feel that needs to increase. Also because it will aid in the Make in India initiative. And one of the major resources we have for a Viksit Bharat motto of 2047 is the infrastructure development. And although the infrastructure investment is significantly increasing, the pace of the infrastructure development is a little slow. That is because of the civil engineering R&D lagging behind if we take the example of major developed countries. So if we increase in the civil engineering R&D space also, it will aid in the infrastructure development of our country.
Hello, I am Aditya Chitai, student of Willingker Institute. As a youth or student of the nation, job is something I look forward to, and job creation is something I would be expecting from the government. There are sectors like production link schemes and everything schemes which can create jobs and prosper youth more. And as a part of working population of the nation, job is something which can help us to contribute more to the economy and boost the economy as a whole and help achieve India's $5 trillion economy dream very soon. So job creation will not only help India achieve its own growth but also help government reduce the unemployment rate, because post-pandemic of the year 2020 we have seen an increase in unemployment rate. So definitely job creation can reduce the gap of unemployment also and create more jobs to the country.
Sure. I'll come back to you. Let's come to you first. What are your expectations? Please introduce it.
Hello, I am Mokshi Cheda, and being a second year MBA graduate who is specializing in finance, it is very important to look at the new tax regime that we have in place. Given the fact that the right now, if we go to see income tax from individuals is about 30% of the total revenues that government is generating, and corporate taxes is only about 27%. So in that case, the individuals right now are feeling that they are being taxed more in this economy, and therefore some relief to them is required so that the taxpayers in India increase. Those reliefs and could be through few adjustments to the new tax regime. One of them could be that the income tax brackets for the new tax regime could be increased up to 20 lakh rupees to cover tax slabs of 15%, 10% and 20%. Another one could be reduction in surcharges, especially for that of the higher income bracket. And also we could also reintroduce the deductions under section 80, which could actually incentivize people to file their returns more. all of this will help us increase the disposable income of the individuals in this economy, stimulate consumer spending, and aid the economic growth. But given the fiscal deficit concerns that we have right now, any major tax cuts are not foreseeable, but moderate adjustments could be seen.
So income tax is a big concern, and I think every tax people look forward to some relaxation on that front. Yes, please go ahead.
Hello, my name is Aditya, and my expectation with this budget is more investment in development of quantum technologies. The last time the government of India invested was about 8,000 crores in 2021 budget. But looking at our competitive countries like China, US and Germany, that they are investing a lot more now, we should actually review the budget and include more budget for the development of quantum technologies, especially in quantum communication, simulation, and other things. This can really be helpful for our agriculture and manufacturing sector because they can boost from it. And apart from that, also a lot more investment in nuclear energy. We know that recently our Prime Minister had a deal with Russia for 6 more power plants. But I think the future after 50 years or 100 years is going to be nuclear energy. So we should ensure that more nuclear power plants should be created in this country. Thank you.
My name is Anagha. As a student who would very soon venture into the job market, my skills and employability are two things which plague my mind very often, as is the case for, I think, countless other students in India. So having said that, I feel like our government does a commendable job in terms of education for primary as well as secondary. But in terms of the skills that we require for the job market, I think that's where we somehow lack. And the 18 to 35 age group makes up about 42%. These are the numbers, I think, for 2023. So we have a huge number which could contribute to the coming sectors. And for the Pradhan Mantri Kaushal Yojana, which is the Skill India as well as the skill universities are developed under this scheme, we had about 60, so the 42%